Good morning. It is 9 a.m. on Tuesday, January 25th. This is Yahoo Finance Live. I'm Julie Hyman. That's Brian Sozzi. We've had some rest. We've had our coffee. We're raring to go this morning after yesterday's session. This even as we have futures head lower once again, pretty deeply in the red here with Nasdaq futures pointing to a loss of 2% at the open. S&P futures off 1.5%. Dow futures off 0.75%. But of course, anything could happen by the end of the day. Whipsaw, the biggest reversal in stocks in more than a decade. That's what we saw yesterday. We're going to walk you through what happened and what could happen next. Of course, after falling deeply into the red during the session, we saw stocks recover by day's end. Not helping matters this morning, though. Better than estimated earnings from the likes of IBM, Amex, Verizon. The outlier, a pre-spinoff GE. Those shares are off more than 4.5%. Revenue there falling short of forecasts. And a new trading platform launching with a crypto focus. This as Bitcoin bounces along with some other risk assets. We speak to Domain Money founder Adam Dell later this hour. But first of all, we got to dive into what exactly happened yesterday and we'll try to figure out why it happened. Let's take a look inside the Yahoo Finance Interactive, first of all, just to get a picture of what went on. And that was a very large reversal. This is the intraday action yesterday, where the S&P 500 fell as much as nearly 4% before rallying to finish the day by 0.25%. This is not something that happens often, folks, at all. It was a very unusual day yesterday, and that unusualness was summed up in a tweet that came to us from Bespoke Investment Group. They tend to come with really good stats on what happens in the market here. And as they pointed out, this was only the sixth time the Nasdaq in particular has reversed a 4% or more intraday drop to close higher, only the sixth time since 1988. And they highlight some of the other times this has happened. The most recent occasion was during the financial crisis in November of 2008. What Bespoke then also highlights is what happens after that. After that, on previous occasions, the Nasdaq saw a median decline of 5.5% 1 month later and a drop of 7.9% 3 months later. So that doesn't necessarily bode well for what we're going to see from the Nasdaq from here. Now, one of the other indicators, of course, that we continue to watch is the VIX. It is still at elevated levels here, 33, even as we saw it trend a little bit lower as stocks recovered yesterday. And one of the things we were watching yesterday, Brian Sozzi, record put option volume. So a lot of retail selling, retail participation is something also that some strategists were highlighting.
And let's be clear, Julia, I think you set it up very nicely as to be expected here. We have a lot of new investors that come into the market every day and they're on our platform. What we saw yesterday is completely not normal. And throughout the session, a lot of folks were telling me that you saw buyers step in here when the major averages hit certain levels on the S&P 500. So a lot of technical buying. But look, the VIX has risen for 6 straight sessions. And I went back and was toiling around on Yahoo Finance Plus a little bit, and the VIX is back at levels seen in October of 2020. What happened then? You saw a pullback in the S&P 500. The VIX is also back to levels in January of 2021. What happened there? So the S&P 500 pulled back, and you're still seeing just a lot of volatility, a lot of uncertainty in these markets, Julie. And it's indicative, I think, in some of the pre-market action. You see meme stocks under pressure here, GameStop, AMC. So that nervousness still in the markets here this morning, despite that stunning reversal.
Yeah, and nervousness, as you wrote about on yahoofinance.com, that people are starting to different. I mean, yesterday was wholesale selling and then not quite wholesale buying, but definitely the declines that we saw were across the board. But as you highlighted, there was especially acute selling in some companies that had been hot last year, but that don't make money yet.
Yeah, I wrote a story midway through the session looking at some of these companies that are losing money that powered the great bull market of last year. And then by the close of the session, it was a completely different story. But anyway, we saw big time pressure on the likes of Affirm, Coinbase, even Rivian. Affirm finished the session up 1% yesterday, despite being down double digits early on in the session. Rivian finished slightly in the red. after being down double digits in the session. Coinbase, too, was down double digits early in the session, finished the session down slowly. But just continuing that thread, Julie, what we were just talking about, the nervousness being sustained in the markets, all three of these stocks are down notably here in the pre-market. So to think that, because we see a big reversal in the markets like we did yesterday, things are back to normal. That's completely that is just not the case here. It's not the case.
Yeah, it usually takes a little while. Come back inside the Wi-Fi Interactive here because, as you point out, things are looking rocky again this morning. And I'm looking at the Nasdaq 100 in particular. For some reason, it's still showing the S&P 500, but I'm on my screen on the Nasdaq 100. Fancy that. Don't know what's going on there. In any case, we're seeing a lot of declines in the pre-market in large cap technology, stuff like Apple, Amazon, Tesla, Google, Microsoft, which reports after the close, by the way, Alphabet, Meta. All of these stocks are trading lower here this morning. Not all of them recovered yesterday, by the way. Apple and Tesla still finished in the red yesterday, but they are dropping, again here this morning. And then also something else where you continue to watch is what's going on in the crypto space. It's interesting there because maybe we can try the interactive again. I don't know. But we saw Bitcoin, of course, fall yesterday along with the rest of sort of risk assets, if you will. It recovered somewhat by day's end, and now we're seeing it trend higher this morning. So what has been highly correlated to stocks as of late, we're not necessarily seeing it correlated here this morning, Sas.
And Julie, I'll add too, just continuing here, that nervousness continues in the market. We're seeing an industrial stock takeover here on the Yahoo Finance ticker page. Some of the hottest tickers on our site today are companies that I think investors still view as safe havens. J&J, the top ticker on the Yahoo Finance platform. Of course, we'll talk about their earnings later, but that is the top ticker right now, followed by 3M. Pretty good earnings from that company. General Electric, which, newsflash, if you think GE is safe, really, you need to go pick up an investing playbook because GE is not a safe investment. Nonetheless, it's still viewed as a safe haven. Even IBM, after its earnings results last night, the fourth trending ticker on our site right now as people hunt for perceived safe havens and perhaps try to get a little dividend yield in this market.
Who thinks GE is safe? Somebody, if you out there think GE is safe, tweet at us, please.
I get people still think GE is paying dividends and it's a safe company, and it's not. I'm telling you, they still think this. It's true.
Have they been sleeping for the last decade? I don't understand.
I think they are. I think they are. It's ridiculous.
I don't find me those people, those alleged people. I don't believe it. I don't believe it. All right. The reason, at least the stated reason by some investors yesterday for the selling, was the Federal Reserve. But we know what the Federal Reserve is going to do, at least sort of, right? Brian Chung is joining us now. The Fed begins its two-day meeting today. I mean, nothing happened yesterday, per se. The Fed didn't come out and say, well, actually, we're going to raise rates by 50 basis points in March. So I don't know. But what are we expecting to hear from the Fed?
Yeah, I mean, a lot of people are freaking out and saying, oh, well, it's the Fed tightening. That is the reason why we're seeing this market volatility that began last Thursday. But it's important to remember that over the last 10 days, we've had no new Fed commentary. That's because of the customary Fed blackout ahead of any policy setting meeting. So is all this just in our heads? Well, we do need to know that the Fed is planning on raising the federal funds rate from the near zero target that it's been holding since the depths of the pandemic. And even though we're talking about, is it going to be 3 or 4 or 5 or 7 rate hikes this year, nothing is expected to happen at the conclusion of the policy setting meeting tomorrow at 2 p.m. And that's because of the Fed balance sheet. The Fed has said it needs to stop its program of openly buying assets like U.S. Treasuries and agency mortgage-backed securities before it then starts to raise interest rates. Now, the intricacies of that are a little bit complicated, but all you need to know is that the Fed will stop effectively buying those new assets as of mid-March, which means it won't be until that March meeting that we then start to see something more serious. And that's a reason why you see projected timelines like those coming from Goldman Sachs, showing you what the roadmap of this type of policy tightening might look like over the course of 2022. And they say that they're projecting 4 rate hikes in March and June and September and December, which appears to be the baseline now for 4 25 basis point hikes through the course of this year. And they're now projecting that the Fed will start to actively let its balance sheet shrink beginning in July. Now, again, I don't want to get into the intricacies, but basically the kind of street talk is that if the Fed can start its balance sheet run up runoff process earlier, that would actually allow the Fed to raise interest rates less to then quell inflation. The reason why is because as the Fed allows treasuries to roll off of its balance sheet, that could tilt longer-term interest rates higher, which could have the effect of further dampening inflation if longer-term borrowing costs are larger. Now, within the context of this current volatility, a lot of people saying, is the Fed going to step in here? Is there going to be a Fed put? Might the Fed not signal that it's going to be as hawkish this year? Keep in mind the story is all about inflation, getting that 7% year over year on the CPI down. In the absence of any sort of movement on that, it's hard to imagine the Fed looking at the S&P 500 and wanting to change course on that. Guys?
And Brian, you're the Fed whisperer here at Yahoo Finance. Let's just stay on that, what you were just talking about. There is this narrative this morning that perhaps because of this market volatility, Fed Chief Jay Powell says something in the press conference tomorrow to settle markets here. Do you anticipate any of that?
I mean, I could see something along the lines of a policy is not on a preset course and trying to alleviate to markets what might already be priced in terms of how aggressive they might want to get on their rate hikes. But keep in mind that tomorrow we're not expected to get any sort of new update on the Fed's dot plot projections. There's not going to be any new guidance in terms of how the 18 members of the committee see interest rates going over the next few years. And because of that, the Fed chairman probably won't want to bite on the specifics of, is it going to be 3 or 4 or 5 rate hikes over the course of 2022, which is going to be not so great for markets, which have been holding on to the dot plots that you see aside of you from mid-December as a crutch, because that telegraphed the likelihood of 3 interest rate hikes through the course of 2022. But guys, that was many, many weeks ago, 6 weeks ago to be exact, and a lot has happened since then, notably those high inflationary prints, which is a big reason why even the Dubs, think of a Neil Kashkari from the Minneapolis Fed, San Francisco Fed President Mary Daly, have also struck a more hawkish tone over the past few weeks with regards to wanting to tighten policy.
Although one investor we spoke to yesterday floated the idea of the Fed being more hawkish than even the market thinks, which I find difficult to picture at this point. I don't know. We'll find out. Thanks so much, Brian. Appreciate it. Coming up next, we're going to take a deep breath here and talk to Lori Calvasino of RBC Capital Markets. She's the head of equity strategy there, and figure out what investors should be watching here and whether we can be a little bit calm.
Investors are still trying to catch their breath after getting railroaded on Monday to a certain extent, even though we did see a rally into the close here. Let's check in with Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Lori, nice to see you. Look, let's start on yesterday's session here. As a veteran strategist, what are you thinking when you see that type of reversal into the close? And what are you thinking about markets here in the pre-market?
So I think it's really interesting that the market, we sort of got to that down 10%-ish, a little bit more, kind of peak to trough drawdown. And then the market decided, okay, maybe this is a little bit too much and tried to stage that reversal. And that's very important because the rule of thumb that we use is a garden variety pullback is 5 to 10%. Now, if you look back post-financial crisis, whenever we kind of move more than 10%, it ends up being about 15 to 20 aside from the recession scenario. And those 15 to 20% downticks or downdrafts rather have all been associated with growth scares, big changes in monetary policy. We saw these in 2010, 2011, 2018. And what I think is really interesting about late 2018 is that there was genuine recession fear that was brewing from the trade war. Now, there are challenges to growth at the moment, but I do think it's very different back from 2018. But I think the market kind of took a beat yesterday and said, maybe this is far enough. And we'll see if that holds. I wouldn't be surprised if it does. I wouldn't be surprised if it won't. We're going to have to take our cues from the market from here. But that 10%, the market saying and kind of pushing back a little bit was telling you that there is still some underlying faith in this economy.
Well, Lori, just staying on that, you think the market is trying to price in a potential Fed interest rate hike driven recession?
I think that there have been growth concerns. And if you go back to December, and I know it seems like ancient history at this point, but right after the December Fed meeting, but before Christmas, we did a survey of investors. And it was based on commentary I had been hearing from investors in my marketing meetings in December. And we asked people, what do you think the risk of in terms of Fed policy error is? And we didn't just ask about Fed policy error because there are two different kinds. We said, is the risk that the Fed is being too aggressive or the risk that the Fed is not doing enough? 29% said the latter, that the risk was that the Fed was not doing enough. Those are the people concerned about inflation. But 40% told us back then, and again, this is well over a month ago, but 40% told us that the risk was that the Fed was being too aggressive. I would guess that that 40% number has increased. And some of the things we heard and have continued to hear is why would the Fed be getting so aggressive at a time when inflation is likely to peak and moderate later this year anyway? Why would the Fed be getting so aggressive at a time when there's short-term economic disruption going on from Omicron? And I think those fears continue to be out there. I think ultimately the economy is going to be fine, but I do think that's a kernel, an important kernel of sentiment in the market right now.
Lori, couple questions for you. But first of all, let's look very short term. As you said, maybe encouraging that we bounced yesterday, but we're right back down this morning. So what does that, yes, things could change during the session, but what does that tell you? I mean, normally you would expect after seeing that kind of a bounce, maybe to have an extension of that bounce. That is not happening.
Yeah, and look, we're going to have to see where the trading day takes us. I will tell you what I heard from my traders yesterday was that a lot of the move late in the afternoon was hedge fund driven short covering. And that we were better to buy as a desk. So that is encouraging, but there was a lot of short covering going on in the tech space, the healthcare space, the industrial space. That is often the first step to stability, but it's not always a step to stability. I think it's important to keep in mind that we have an avalanche of earnings coming out this week and next week, well over 200 companies in the S&P. We've all been focused on the Fed, but we're going to be getting a lot of boots on the ground color from companies in the next few weeks. And that ultimately, I think, could either exacerbate this weakness or it could help add to some stability in the market, depending on what companies say.
So I want to go back to the Fed for just a second. Do you think that the market is overjudging the negative implications of the Fed here? Do you think that, it feels like there's an awful lot of pessimism after yesterday.
And I've been going back and forth with people about the lesson of 2018, because that was a year that started out with a lot of volatility to start the year. Then we had that massive drawdown at the end of the year. The reason that massive drawdown happened at the end of the year wasn't just because the Fed was getting tighter. It was because there was a view that the Fed was just going to keep policy on autopilot. And it was also because we had the onset of the trade war, which was a new, big, scary thing that investors really didn't understand what the implications were going to be. And post Labor Day in particular, there was a view that it could lead to a global recession that would drag the US economy down with it. Now, we were at the beginning of that story. We are hopefully getting to the tail end of this pandemic story. And I think that's really the key thing to keep in mind, that yes, we do have some short-term Omicron disruption here. It frankly may have been greater in the first quarter than anybody anticipated, but we are really kind of coming out of that. And I think that's going to be the key thing to keep in mind, regardless of whether or not you think this is a buying opportunity in the market. The market's grappling with it, but it does seem like we're at a very different place than what we were back then. And I keep telling people, if you look at consensus economic forecasts, they've been around 3.9% in terms of real GDP. Even if those estimates get cut, there's a lot of cushion in those views before we can really even be talking about the dreaded R word.
And let's talk about something else that maybe got lost in the shuffle with all of the Fed concern, and that's earnings. We're like in the midst of earnings season, right? Fast and furious. We got a bunch more numbers this morning. What's your read on what we've heard so far? And not just your read on what we've heard, but the reaction to what we've heard.
So if you look at the stock price reactions, and we haven't analyzed anything that came out today yet, we've really just gone through the end of last week. But companies that are missing are getting hit much harder than they have in prior quarters. And we're particularly seeing big, weak reactions on companies that are missing revenues. I think that's important because if you look at the demand discussion so far, it's not that the companies are saying anything bad at the moment. It's just that they're not waxing poetic about how fantastic underlying demand is the way they have been the last few quarters. So there's a real sensitivity around that revenue outlook. I'll tell you the other things, they're kind of my big takeaways so far, Julie, is number one, labor, labor, labor. It used to be supply chain, supply chain, supply chain. I am reading all about labor and compensation right now. I really, sort of struggle to find as much commentary on supply chains as I used to, but I find plenty to talk about on labor. The other thing is that we saw companies really offer a stark contrast to what they said post-Thanksgiving regarding Omicron. Post-Thanksgiving, the message was, hey, we got this. It's 2 years into the pandemic. We're going to manage around this just fine. We actually saw one company say last week, shame on us, because we didn't manage around the vaccine mandate very well, and we didn't manage around the quarantines that kept people out of the workforce. They said we simply did not plan adequately for that. And we heard echoes of that from a number of other companies as well. So I do think it's going to be really interesting to see what happens with 1Q numbers, where we've only got 6% growth baked in for this quarter. I think that's going to be a real sort of key to determining how this reporting season goes, is whether or not that 6% number holds up, and if it gets trimmed, how much it gets trimmed by.
Laura, you're so on the mark. I talk to a lot of executives. I'm talking to a lot of folks right now, and they are being surprised by the upside on labor prices, the cost to get labor into their offices, their virtual offices, wherever it might be. As one of the more level-headed strategists out there on the street coming into this year, I think your S&P 500 target was 50-50. And just given where we're seeing things on volatility, I mean, do you think you're going to lower that target? Do you think we'll actually see returns this year below your prior outlook of about 7%?
So if you look at the 50-50 number, it's basically a 6% return on the year. It's obviously higher from where we are now, but we came into the year, saying that we expected volatility to start the year. And we expected it to be a sub-trend kind of year. And I'll tell you, if you go back and you look historically at down years in the S&P, they are usually associated with the onset of a recession or a major crisis. And so the question is, do we think that we are getting that this time around? And again, we think that we're more at the tail end of this pandemic story. We do think we're going to get some multiple compression, most likely from the Fed. We think it's going to be a challenging, tough year, but I have been telling people I'm actually glad that we're getting a lot of this out of the way at the beginning of the year, because it does give us a good setup for later in the year. And I'll give you one other thought. If you look at the retail investor survey by AAII, net bullishness last week fell back down almost, I think it was minus 25.7%. It almost got back to March 2020 lows, which were around 28, 29%. And that's extremely important, because historically, when net bulls are below minus 10%, we're obviously far below that right now. Markets are up 86% of the time on a 12-month forward basis with a 15% average return. And if you go back to 2020, we saw net bullishness just really in the toilet for about 3 months, for about 12 weeks in a row. We were below that 10% threshold, but we got there in March, right around the market bottom. And it ended up being a very, very good signal in terms of keeping people in the market. So that is something that gives me a lot of comfort that even if we haven't seen sort of the downward move play out fully yet, that we are still going to make some modest gains in this market before the end of the year.
Certainly appreciate a little bit of optimism after yesterday's really just crazy session. Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. Always good to see you. All right, coming up, earnings season is officially in full swing. We're back with analysis on results from GE, 3M, IBM, and maybe 20 others. Stick around.
About 2 minutes till the opening bell on this Tuesday morning following a weird Monday session, an unusual, a rare Monday session where we saw stocks fall deeply and then recover by day's end. What could happen today? I don't know, but we're seeing indications of a lower open at the moment. We'll see if it stays that way. One of the stocks that's lower that probably maybe will stay that way is General Electric. That company coming out with revenue that missed estimates, $20.3 billion versus the $21.4 billion that analysts were predicting. And that stock's actually accelerating to the downside as we watch it this morning. Larry Culp, the CEO, saying in the statement, supply chain challenges, commercial selectivity, and uncertainty surrounding the U.S. wind production tax credit impacted our top line. Indeed, renewable energy sales there down by 6%. The company also giving an outlook for this year, organic revenue growth of the high single digits. What stands out to you here, Mr. Sazi, about these GE numbers?
So, Julie, I was reading this GE report, and the initial move higher in GE, initial move in the stock was higher, believe it or not. And I think investors just scrolled down to the middle of the press release and locked in on what Larry Culp said about free cash flow for this year, signaling it could hit $6.5 billion. But really, when you dig into this quarter from GE, it was really another stinker. The company missed revenue estimates in every single business segment. And then within the company's outlook, just like you mentioned, Julie, they're looking for earnings this year of $280 to $3.50 a share. The street was looking for about $4, a little over $4 a share on earnings. So GE coming out here with a below consensus outlook, and even looking under the hood of that outlook, Julie, just a lot of optimism for their business.
There's the opening bell on this Tuesday, and that negative open that we have been watching for after the big whipsaw in the session yesterday. We were just talking about General Electric here, and the thing about GE at this point is GE is more just GE than it used to be, obviously, right? It used to be that General Electric was this big bellwether, could tell us about what was going on in the broader economy. That is much less true at this point. And so I don't know that we can extrapolate from GE to the rest of the market, perhaps to some of the rest of the industrial sector. But really, it, as usual, or as has become usual, it seems to be more GE specific, Saz.
Oh, this was another incredibly just complicated quarter to get your hands around. If you like GE for whatever reason, let's keep in mind they announced late last year they're splitting up into various parts here, and that's a process that will play out through this year and ultimately crescendo with that split off, I believe, early next year. But look, I take issue with their guidance. I think it is incredibly optimistic, even though it is below consensus, to think aviation sales are going to roar back 20% this year, healthcare up low single digits, given supply chain concerns. It's a tall order. I think it's going to be a tall order for GE to reach that earnings guidance, which raises the next question: how much more in expenses does this company have to cut this year to reach that outlook?
Let's take a look at markets here now that we have opened up, and indeed we have opened up in the red. So that bounce that we saw late yesterday did not last, but we could see another reversal in today's session. That said, the Nasdaq is not opening up here at the lows of the futures seem to be pointing to when it was down 2%. It's off about 1.5% right now. The S&P 500 off 1.33%, the Dow off by 1%. Also want to talk about 3M quickly as we're talking about the industrials. A lot of them out this morning. 3M earnings coming out ahead of what analysts have been predicting. Net sales not much changed and coming out effectively in line to slightly better than estimated, but those net sales are up just 0.3%. And a lot of the different lines of business actually saw declines year over year, Saz.
Yeah, I think the consumer business for 3M looked pretty solid, but profit margins or operating income are under pressure in all the company's businesses. Also, 3M didn't come out with a full year outlook. They're saving that for an investor day in a couple weeks. But again, I'm looking forward to talking to 3M CEO Mike Roman in the 11 o'clock hour. We'll talk more about the quarter, the outlook, and the demand for mask sales. Mask sales are likely reaccelerating because of where we are in the pandemic.
Yeah, especially since we have now seen recommendations turn towards those N95, KN95, et cetera, and away from cloth masks. Finally, let's take a look at IBM. IBM, the best sales growth in 10 years for the company. Revenue coming in ahead of estimates, earnings per share coming in ahead of estimates, and that sales growth, by the way, was 6.5%. Effectively, what we've seen, the transition at IBM is a transition towards a more cloud-based business. They actually have a sort of hybrid cloud offering here. It helps clients put their data and stuff in the cloud, but they also offer a service component for that. And so that seems to be paying off to some extent. But analysts are sort of waiting and seeing if this is going to be a more sustained recovery for IBM. And a lot of them cautioning that comps for the latter part of this year are going to start to get trickier. Oh, I think we have a frozen Brian Sozzi this morning. And so we are going to turn it on over to Jared Blickery. Jared, what are we seeing?
Yeah, let's thaw out Sozzi here, but let's go to the Wi-Fi Interactive first here. Big hammer candle yesterday on some of these markets. The Nasdaq, everybody's noting that huge reversal off of that 5% low. You take a look at the Dow, it is a similar picture. You take a look at the S&P 500 right there with it. So the big question is Is this the end of the selling? Are we ready to get back into rally mode? Of course, the Fed being a huge catalyst, we have to wait for that till tomorrow. Probably not going to see much in the way of anything meaningful today, but we are going to chop around quite a bit. Probably going to have that continued volatility because we are in a low liquid market situation. And one of the trends I've been reading about and noticing, and I'm also writing about this today and the potential for reversal, is that retail investors were net buyers most of the year in heavy force, even on the declines. That stopped last Thursday. So there were net sellers Thursday, Friday. We had a big options expiration on Friday. Not going to get into the weeds on what it means to have be short gamma, but nevertheless, we're in a situation now where markets have to chase momentum. We have large players, whether you're selling options, whether you're CTA, there's a lot of reasons why the volatility is not going to abate. Let's go back to the Wi-Fi Interactive. I just want to chart the bond market real quick. Here's a 10-year T-note yield. We can see that's up about 2 basis points. Also going to take a look at the 5-year T-note yield, and that is up 2 basis points as well. And let's take a look at the Nasdaq 100. It looks like Apple is down 2%. Amazon, Tesla, Microsoft, each of those are down more than 1%. So the bottom line, I think until we see institutional capitulation, we're probably not going to be out of this just yet. Retail is capitulated, but we need the big players on Wall Street to also get a little bit more pain.
Oh, that sounds fun. All right, Chair Blickery, we're going to take a quick break. When we come back, we're going to take a look at what's going on in cryptocurrencies today. There, we are seeing some green. Interesting action. We'll be right back.
Bitcoin prices are climbing off their recent lows, but the buying hardly looks convincing. Yahoo Finance's cryptocurrency reporter David Hollerith is here. David, you continue to be on the pulse of all things crypto prices. What are you hearing this morning?
Yeah, I'm hearing, Brian, primarily that there's been a rebound that was sort of talked about over the weekend, and everything's sort of still hinging this week on what sort of the words that come from the Fed. So the market is heavily tuned into what the Fed's doing. You've heard this a couple of times already. There's a strong correlation with risk on equities. But seeing such a drawdown below 40K, I sort of over the weekend I started doing. I just spoke to a lot of different analysts and investors, and I got one forecast for BTC in the long term over maybe the course of the next year that was actually quite bearish. And so the analyst I spoke to is an independent analyst. He's had a fairly long career. He has not, he doesn't work in the crypto space, but he used Bitcoin's 4-year halving cycle based on past historical prices to sort of calculate where the bottom from peak is. So he made a few assumptions. One is that the Federal Reserve successfully combats inflation or central banks more broadly successfully combat inflation over the next year. Also, he assumed that Bitcoin is primarily seen as an inflation hedge by investors, meaning that an environment where inflation is being tamed will diminish its value somewhat. So although he is actually long-term optimistic about Bitcoin, he calculated just based on past historical prices from the past 2 cycles it's had, that the price could fall down to below $14,000. And that's sort of based on the past 2 drops, which are 80% from peak to bottom. So there are a few assumptions going on here, and I'm happy to sort of talk through it.
Well, Dave, I want to get your reaction to this. I talked to American Express's CEO, Stephen Squeri, this morning, and I would characterize him as not a Bitcoin bull. But look what he said. Look what he told us. Quote, "I've said from the beginning, cryptocurrencies are really an asset class like gold or silver. Look at Bitcoin, which is a good bellwether. It's down 50% in 2 months. How do you call it a currency?" Do you have, and when you talk to your sources, do you hear them saying that, maybe it's not an asset class or it's not a currency? You hear any just change in tone from them?
Yeah, I think that everybody is sort of bugged by the risk on correlation with equities because in the past, before such a high level of institutional adoption happened, that wasn't the case. So since the pandemic, there's been so much economic stimulus in the markets. It's sort of changed that trajectory a little bit, and whether or not that continues, I think we'll have to sort of see. But for Bitcoin, a lot of people view it as this store of value, inflation hedge, and obviously it's sort of changed because it's seen such massive gains. But it can be viewed in some ways, if it's an inflation hedge, it can be viewed sort of as a corollary for bonds, as odd as that sounds. I know Ray Dalio pointed that out a little while back. It's also sort of an asset that is potentially going further down the risk curve in terms of the level of adoption we're seeing. So these corporations and nations that are potentially putting it on their balance sheet, in some ways, there's an argument to be made that it's stabilizing the cryptocurrency more. So Bitcoin is very different from the other cryptocurrencies, and that's mainly due to adoption and how it's being viewed. But I think that at the end of the day, it's still sort of this. It's this asset where people will look to it, and it has certain properties, but essentially you can kind of make what you want out of it.
That much is for sure. All right, we'll leave it there. David Hollerith, thanks so much. All right, the losses in crypto are starting to pile up, as our Yahoo Finance stat of the day shows. Over the last 2 months, the virtual currency space has lost $900 billion in aggregate value, according to DataTrek. For some perspective here, that is more than the GDP of Switzerland or Facebook's market cap. Food for thought. All right, straight ahead, we'll chat with venture capitalist Adam Dell about his new trading venture, Domain Money. Stick around.
about 15 minutes or so since the cash open, and we are seeing stocks kind of bounce around here, but bounce around to the downside. The Nasdaq now at the lows of this very early session, off 2.4%. The S&P off 2%. The Dow off 1.5%, or more than 500 points. So the late day rebound that happened yesterday, will we see a repeat today? Tough to tell, but right now we are definitely seeing a mimicking of yesterday's session in that we are going down from the get-go. So something to continue to keep an eye on. We also, of course, are continuing to keep an eye on what's going on in cryptocurrencies. And there is a new trading platform where you can trade equities and crypto for that matter, and also get some ideas as to how to trade them through model portfolios. It's called Domain Money, and the founder and CEO, Adam Dell, is joining us right now. Adam, thanks for being here. First off, I would just ask why the world needs another trading platform. There's a lot of competition out there in this space.
Yeah, we think there are a number of investors out there who are looking for a more sophisticated platform to invest in both stocks and crypto on a single platform. We also offer the opportunity for investors to access our actively managed strategies that include both asset classes.
Adam, the platform has a large focus on cryptocurrencies. Has the plunge in values, how do you think that will play out on the platform?
Yeah, well, markets in the short term are voting machines, and in the long term, they're weighing machines. And as we look at the cryptocurrency market broadly, we see some incredibly powerful trends. DeFi marketplace lending has gone from less than $1 billion to over $200 billion last year. You see NFT volumes at 23 billion, up from virtually nothing just a few years ago. These all suggest that the cryptocurrency ecosystem is alive and well. I'll give you some context. Last year, Visa completed 10 trillion in transaction volume. Ethereum alone did 11 trillion. And so as I look at these trends, the scale and the volume of transactions happening in these marketplaces are quite profound and very healthy.
Adam, who do you see as the customer here that you guys are aiming for that's, as you said, not being served by the existing platforms out there?
Yeah, we believe there are investors who are looking for deeper signal and insights into the data related to these underlying assets. So we've developed a product called Signal, which gives investors access to things like flow of funds on exchange, which tracks on-chain and off-chain activity, social sentiment, where we're looking at the chatter of activity around individual assets. And that level of data, I think investors are looking for as they make decisions.
Adam, you spent a
Oh, Adam, I'm sorry. I think Brian's having some technical difficulty here. As you introduce the platform, it's funny that it's being introduced as we are seeing a really, I won't say unprecedented time of turmoil in crypto, because it's very precedented. There's been a lot of other periods like this in cryptocurrencies. But what does it do to sort of demand for these types of instruments when we have seen them sell off so much from the highs?
Yeah, well, over the last 5 years, there have been at least 4 bear markets in Bitcoin, and yet it's still up, in the thousands %. Our view is that there's a large group of investors out there who are done playing games around crypto and want to start to take this asset class more seriously. And they want to make decisions based on information rather than, just momentum. And so to provide investors with a platform that gives them a level of data they wouldn't otherwise get, we think serves the market. And more broadly, we think there are a class of investors out there who may not be as familiar with the underlying technologies that make up cryptocurrencies, and our managed strategies give investors the ability to access that asset class by buying a basket of assets.
I know, Adam, the existing platforms out there make their money in different ways, whether it's fees, whether it's payment for order flow, et cetera. What model are you guys basing all of this on?
Yeah, we don't charge fees for trading in equities. We charge 1.49% for trading in crypto, which is less than a number of our competitors. So that's how we make money.
And finally, Adam, I'm curious if you're invested in crypto. I mean, I know you're running the platform. You're not making personal recommendations about what people should do with their money. But I'm curious what you're in and where you see Bitcoin going in the short to medium term.
Yeah, well, again, our focus is on long-term, stable bets in the cryptocurrency ecosystem. The thing we're most focused on is protocols that are performing some fundamental market function. DeFi marketplaces where people can borrow and lend have exploded literally in the last 2 years. Those are examples of a real fundamental market function that consumers and investors are looking for. And so our investment focus is around the operating system of finance, which we believe blockchain technologies represents. If you look at the engineering community, they have voted with their feet. You can't find a technology company focused on the plumbing of our banking system that isn't focused on blockchain technologies. And so it's our focus to help build out the ecosystem of cryptocurrencies serving core market functions.
Yeah, very true regarding blockchain and big financial firms. Adam, thank you so much for being here. Appreciate it. Founder and CEO of Domain Money on the announcement of its introduction. Thanks so much, Adam. We're going to take a quick break. As we see the Dow sort of bounce around, but solidly to the downside, it's now up by 2%. Here are some of the biggest laggards within that index. Goldman Sachs, Home Depot, Cisco, Walgreens, and Dow Inc., the chemical company. So not really seeing rhyme and reason here in terms of a theme among the losers. Much like we saw in yesterday's session, there appears to be some wholesale selling here. We'll be right back. Another check on stocks here as we see stocks bouncing around, but bouncing mostly to the downside, particularly the Dow really experiencing a lot of volatility here. Right now it is off by 2%, the Nasdaq off by nearly 3%, and the S&P down by 2.4%. You know, something we were hearing consistently from traders yesterday is that options activity and a big expiration that happened on Friday perhaps influenced yesterday's session. That perhaps is making its way through the markets again today. So that's something we're going to continue to watch. And like yesterday, it is a broad-based sell-off that we are watching here. If you look at the sector ETFs and where we're seeing selling concentrated, though, where it's the worst, you've got tech and communication services there, the top and the bottom, ETFs off 3% and 2.5% respectively. Industrials off 2.8%, GE certainly a part of that, and consumer discretionary stocks also off 2.5% right now. When we're watching technology today, one of the interesting stats that I saw as I was making my way through the morning was that many of the companies within the Nasdaq 100, half of them, in fact, are down more than 20% from their 52-week highs. So when you see that XLC and XLK on the list, that represents many of those companies. There's another individual stock that I want to highlight as well, and that is Nvidia. A report this morning from Bloomberg that the company is preparing to abandon its purchase of ARM from SoftBank. Remember, it's a $40 billion deal, and it's had a lot of issues getting approval for that deal. Now, Nvidia has consistently said it doesn't need to do the deal in order to continue to grow, but it does seem like on this report that there is perhaps some disappointment being expressed in the stock, although, of course, it could also just be a factor of the general selling that we are seeing in today's session. We're going to watch that stock, we're going to watch this sell-off, and we're going to bring you much more coming up.
Welcome back to Yahoo Finance Live on this Tuesday morning. I'm Brian Sozzi alongside Julie Hyman. Markets are back under pressure after Monday's stunning late-day reversal into the green, seeing all the major indices solidly in the red as really investors try to figure out what happened yesterday and try to determine what should their course of action be today and for the rest of the week. And here are a few other things we're watching for you at this moment. Striking an upbeat tone on the consumer, American Express is out with better than expected quarterly earnings. The company's profit outlook for the year was shy of a few analyst estimates. American Express CEO Stephen Squeri told me he is not seeing any signs of more cautious consumers, citing travel bookings up 19% so far in January. And outlook slashing. While Amex sees a healthy consumer, the IMF is seeing a more muted global growth outlook. The IMF cut its global growth estimate this morning. We'll be live with IMF Chief Economist Geeta Gopinath for more on this one. But Julie, over to you. Getting some news, some breaking news, I should say, on consumer confidence.
Yeah, and it's better than estimated. So the Conference Board Consumer Confidence reading for January coming in here, 113.8. That is better than the 111.2 that was estimated. The present situations part of the index also ticking higher, 148.2. Although the expectations part of it falling month over month to 90.8. I'm just looking at the Conference Board statement here, which is really interesting on a couple of fronts. First of all, the Conference Board pointing out the proportion of consumers planning to purchase homes, automobiles, major appliances, and vacations over the next 6 months all increased. What's also interesting, concerns about inflation declining. They had hit a 13-year high the prior month in December, and now coming down, concerns about COVID-19 coming down as well. So all of that quite interesting here, especially given the last couple of days in the markets. Interesting to get this number that shows that consumers are feeling a little bit better here. Current business conditions, it looks like, are relatively strong here. Labor market assessment, though, are a little bit less favorable than they were in December, but overall, a relatively strong consumer confidence report, Saz.
All right, we'll take it, Julie. All right, switching gears, many pros are telling us there is a panic well underway in tech stocks, made worse by a subpar first quarter outlook from Netflix last week. The Nasdaq Composite is down about 14% or so on the year, but momentum names are like Affirm are down even more. In the case of Affirm, the stock has plunged 45% so far in January. Really a stunning move there. Let's welcome in Wedbush Securities tech analyst Yigal Arounian for more on this tech wreck. Yigal, nice to see you as always here. Now, you have a broad coverage list in tech, Meta, Snap, you name it. What is the appetite by your clients to step in here and buy this tech weakness?
Hey, thanks for having me. I mean, so far the appetite has not been that strong. What we've seen is a real major pullback in valuations, and the names that are the most expensive, even still, names that are maybe more capital intensive, are negative free cash flow, have a longer growth runway, meaning a lot more of the growth is further out in the future. Those are the names that have been hit the hardest. Certainly, there are people digging around, looking at valuations, names that have been hit too hard, valuations that might be trading, at troughs historically, trying to maybe position or get more active. But the appetite to really step in and get fully active right now, I think people are waiting a little bit longer to see how things shake out, or for the market to kind of settle down before they do that.
Yigal, I know it's tough to sort of generalize because, as Brian said, you have a pretty broad coverage universe within tech. But how much are higher rates going to be a threat to technology when all is said and done? Obviously, the perception is there that they're a big threat. How much do you think they will be in reality?
That's the golden question right now, and really the answer is it depends. We're still at historically low rates. Going back a couple of years, this level of rate is still very attractive. Still, you could still consider it kind of easy money. The problem is the Fed is tightening. Rates have the 10-year yield has started to move up quite materially. Just broke above 1.8%. Again, still very low historically. So I think part of what's spooking investors and people a little bit more right now is the inflation that's behind that. And we need to get an answer on inflation, it seems like, before people can get comfortable with where rates will ultimately settle out. I mean, if the Fed's going to raise rates 7 or 8 times over the next couple of years, that's going to put some real pressure on the 10-year yield. It's going to put pressure on borrowing costs, and then when you kind of look out at your 10-year growth and you're discounting back your cash flows, that impacts valuation. So right now it's about the pace of it, and we have some real inflation behind those numbers, which makes it hard to really fully get a feel for where things are going to go. And I think that's been part of the problem with why it's been so hard for things to settle down here right now in the near term.
And Yigal, really during this volatile period in tech, I think a lot of investors have forgotten there are company-specific factors, really with any companies and names you're trying to predict or buy, invest in, or sell here. And you highlighted this week, you downgraded Snap, I would argue, on some company-specific factors like privacy. Take us through that call.
Yeah, for sure. First, I think I'd just also highlight the consumer confidence topic leading into this is a huge factor also. I mean, part of what we're seeing here is rates rising, but also concerns about slowing growth in the economy, right? How the consumer feels. We had a ton of stimulus that drove a ton of spending last year. Retail sales were up above typical levels. Advertising was up. Digital advertising especially was well above normal levels. So we had a big year that was kind of pushed and fueled by stimulus, and we're not going to see that play out again this year. That's part of the call on Snap. On the digital advertising market as a whole, we have some real difficult comps as we kind of work our way through the next couple of quarters. For Snap and the space also in general, Apple's privacy initiatives have really created a big challenge in the ecosystem. It's really turned it on its head. It's become a lot harder to target consumer. It's become a lot harder for advertisers to target consumers. It's become harder to measure the effectiveness of that advertising. We saw Snap kind of be surprised by the impact on its platform last quarter. It's been a big impact for Facebook as well. And based on our work and our checks, there's still a lot of ground to make up there. It's a long-term evolution of the ecosystem that's going to take some time to play out and to resolve. That pullback of the IDFA, the identification for advertisers, it really changes how advertisers can work digitally to target consumers. And it's an impact for Snap, and we don't see it going away right away. That puts some pressure on Snap. And then again, just to finish up on that, we talked about valuations. Snapchat still at a premium level. To us in this kind of market, that means they need to execute to perfection, and there's just a lot of headwinds for them right now. So we're a little cautious on the valuation still here.
Hey, Yigal, on the IDFA question, whether it's Snap or Meta for that matter, how do they adapt to that change? Are there things they can be doing that they're not doing, or to your point, not doing quickly enough in order to adapt to those changes?
Everyone's trying to figure it out. The whole ecosystem is trying to figure it out, from Facebook to your Shopify advertiser. The pullback of the IDFA, which helped advertisers track users across the web, was by far the most effective advertising tool I think the advertising industry has ever seen. Really helped kind of find the right audience, target that audience, retarget that audience, and ultimately get them to make that transaction. There was a lot of visibility from all the way at the top to finding the right person, all the way to the end to the transaction, and now we've lost a lot of that visibility. So it's about putting in alternative measurement products to be able to track those conversions, so they can tell advertisers, hey, that this ad led to this sale. We lost a lot of color there. Those are things that will take time to put back into place. And even once we do, to get the level of visibility we had before IDFA, for pre IDFA, I think it is going to be a challenge. So it just takes some time. And then again, on the targeting side, everybody needs to put in alternative types of tools that can help target advertisers the way that everyone's used to. It's just really not that easy when IDFA was so powerful, and now it's not there.
So Yigal, you just downloaded Snap. You have neutral ratings on Meta and Twitter, but you do have an outperform on Pinterest. What are they doing right now that you like?
So we remain outperform on Pinterest. I will say it's, there is one very critical factor for them. The stock hasn't worked and won't work until they can kind of fix this. We think, or kind of hope that they have troughed this issue around user growth and engagement. They saw a really nice tick up in users during COVID. They lost all of those users in the U.S. And are now back to actually slightly below in 3Q. They were slightly below pre-COVID levels of users in the U.S. If they're not seeing improvements in engagement, if user growth continues to decline, and there's no way that the stock can work. That's really critical. We think they've troughed on that. We could start to see improvements there. If we start to see improvements there, this is when we talk about valuation. This is one that's trading at trough multiples. Stock's gotten very cheap. And if some of those fundamentals, return back to where they were, there's an opportunity to see estimates go up, to see multiples go up there. They're also a little less exposed on the IDFA front. They're still exposed, everybody is, but they are a little less exposed than Snap and Facebook is. The way people use the platform is different. So they show different kinds of intent. There's a lot of data that can help them kind of offset some of what they're losing on the IDFA side. So those are some of the factors. But again, without the user growth story turning to be a positive, it's going to be really hard for that stock to work too.
Wedbush Securities tech analyst Yugal Arunian, always appreciate you taking the time for us. We'll check with you soon. All right, before we head to break here, I have to look at the markets here. Another volatile session, to say the very least, on Wall Street. Seeing the Dow down over 700 points or so, really pressure across the board. Nasdaq, S&P 500, small caps are still getting waxed here. Despite that stunning reversal into the green into Monday's close here, the market clearly is still undergoing what many are saying is this corrective period. All right, coming up, Unilever is already responding to its new activist investor Nelson Peltz by firing people. Julie is back with the details next.
The FDA, or excuse me, the markets continue to sell off at this point, really in a narrow range, but consistently down here today. And a broad-based sell-off is continuing as well. Tech leading the selling, the Nasdaq off 2.5%, the S&P 500 off 2.2%, and the Dow off by 1.7% right now. We continue to watch this very closely and watch the movers within this sell-off. The FDA is limiting the use of two COVID-19 antibody drugs made by Regeneron and Eli Lilly. These two monoclonal antibody treatments likely ineffective against the Omicron variant, and the FDA says they shouldn't be used in the U.S. at this time. The authorization adjustment comes as the variant accounts for over 99% of U.S. COVID cases. Unilever announced its plans to lay off 1,500 management workers worldwide as the company faces pressure from investors. About 15% of senior jobs and 5% of more junior management roles would be cut in this restructuring, though factory workers are safe. The company is currently facing criticism over its failed takeover bid of GlaxoSmithKline's consumer health unit. It's attracting activist investor fire from Nelson Peltz's Trian. Music legend Neil Young, he's giving Spotify an ultimatum. In a since-deleted letter, Young demanded that Spotify remove his music from the platform because it continues to allow podcast host Joe Rogan to spread COVID-19 misinformation. They can have Rogan or Young, not both, he wrote, and urged Spotify to act immediately. And musician Bob Dylan has sold his entire body of work to Sony Music, beginning with his debut album and continuing through his 2020 Rough and Rowdy Ways album. Sony didn't disclose the details of the deal, but Billboard magazine estimates the recordings are worth about $200 million. There have been a series of this type of deals. We're going to take a quick break. When we come back, coming up, we're going to talk about the downgrade to the growth outlook for global GDP with Geeta Gopinath, IMF chief economist. Stay with us. We continue to see deep selling here happening, and the Dow off, as you can see, by more than 600 points, about 1.75%. Our Jared Blickray has been watching all of the action here today. Jared?
Well, let's crank up the Wi-Fi Interactive and cross our fingers here. We're seeing a lot of red on the screen. Ooh, it works. Great. J&J up about 0.9%. American Express up over 5%. IBM up 1.5%. A lot of these are earnings stories. Aside from that, we're seeing a lot of red here. Apple and Microsoft both down more than 2.5%. Disney down more than 3%. And the big question is, was yesterday's low a capitulation low that's going to hold? Well, the evidence is making that very unlikely right now. You can see the tech sector, that's XLK in the lower right-hand side, that is off nearly 3% after getting shellacked yesterday morning. Now, as we were talking about, or as I was talking about around the opening bell, it looks like yesterday was a huge short covering rally, and it was sparked by some put seller at the lows. Technical reasons doesn't really matter, but I think it just highlights the fact that this is a very much a liquidity-driven, event-driven market, and sometimes the event is just a technical event, not even any news flow. Also seeing industrials, materials, and consumer discretionary and communication services, all of those are down more than 2%. And I want to check out the travel sector just to get a barometer here. Seeing a lot of red, not dark red necessarily, but Airbnb down another 4%. That was a stock that was down 10% at its lows yesterday. You can see still down about 10% over the trailing 2 days. And let's take a look at the chip sector. Lots of red on your screen there. Nvidia down almost 5%. ASML, one of the biggest companies in the world, if not at least in China, that's down over 5%. Xilinx also down more than 5%. And in the software sector, not really looking that much better. We're seeing ServiceNow down more than 5%, Shopify down more than 7%. And so the carnage there just continues. Healthcare, maybe a little bit of a respite here. We talked about J&J before. Pfizer also slightly in the green. BioNTech up 2%. So some of the VAX stocks, which have also taken lots of hit recently, those are few of the green spots that we're seeing today. Want to take a look at the banking sector. Pretty similar story all around. Goldman Sachs and JP Morgan down 2%. And also the energy sector, the bright spot of the year, really not seeing a lot of love today. Exxon's down more than 1%. And some of the green spots, Royal Dutch Shell and BP, not even up 1% there. Well, if we're talking about high flyers from yesterday, not yesterday, but I mean yesteryear, we would see those in the EV space, but not today. We're seeing Lucid Motors down 3%, Rivian down 6%. By the way, someone just DM'd me asking for the market cap drop in Rivian since its peak. It peaked out about 155 billion. That was back in November, shortly after its IPO. And let me get a chart here. And since then, today it stands at about 53 billion. So got cut by 1/3, or got cut to 1/3 of its previous amount. All right. Also want to get a check of Bitcoin here. And finally, Bitcoin, lots of green here. So nice to kind of see this play out. Let's get a 5-day view. We saw that big drop down yesterday along with stocks. Is it holding? Yes. So Bitcoin kind of bucking the trend here, along with the other cryptocurrencies that we're tracking from the general market.
And really interesting there to see that correlation breakdown between Bitcoin and stocks as well, tech stocks in particular, which has really been in force as of late. Jared, something else that we've been watching, as we talk about all the contributing factors to these declines, one of the things that we talked about yesterday a little bit were increasing tensions between Russia and Ukraine and the implications for the globe. How are we seeing that play out, if at all, in the markets?
It's interesting, Julie. I was noticing Friday when we saw the market take another leg down, it seemed to be off of some headlines regarding the Ukraine. President Biden seemed to be green-lighting in one of his speeches the Russian invasion. So markets are reacting to it. And when it comes to these geopolitical events, usually they're not big market movers. Even 9/11, which happened in the middle of a tech bubble bursting, there was lots of other surrounding factors there. Even that, the old lows or the old highs were recovered pretty quickly. So I think in this circumstance, and I'm going to go to the energy sector. Actually, let me get a chart of crude oil here, because I think that's really what this comes down to, is the fact that Russia is a swing producer of crude oil. It's a member of the OPEC Plus faction. And let me see if I can get a crude oil quote. Not really seeing the ticker. There we go. It is actually up 1% today. So in the midst of this market volatility, crude oil still holding on to the 84 level, I think is pretty bullish for it. And what happens if Russia does get out of line? They're going to face crippling sanctions. There's going to be trade disrupted with Europe. And just the fact that they are that swing oil producer, I think it might be a little bit more meaningful than some of these other geopolitical events that we talk about. But we'll have to wait and see how this all plays out, Julie.
Hey, Jared, can you do me a favor and throw up natural gas there as well? Because I bet there's some implications there because there's been this sort of fight over the pipeline that comes from that area of the world. There we have it. You can see it's actually down today, but up over the past 5 sessions. But that has a lot of implications for inflation in Europe in particular, but here in the US too.
Yes, it does. And Russia has been playing some games with Europe. There's a brand new pipeline that the Europeans were counting on to deliver liquid natural gas to them for heating purposes. And Russia's just kind of been playing with the spigot here. There's a lot going on in this situation. We saw the energy crisis rear its head over the last few months. And if we get another cold spell or two, Russia has Europe exactly where they want them. Europe is a huge trading partner with Russia, US not so much. So it's really going to disproportionately affect them over there on the continent.
Jared, thank you. I want to bring in Rick Newman now to this conversation because he's watching that situation, that political situation very closely as well. So Rick, tell us about what you have been watching in terms of this power play that is going on here on the part of Russia, how commodities feed into it. And then, of course, you're watching President Biden's role in all of this as well.
Yeah, just a quick follow-up, Julie, on the discussion about oil prices. So they have not really moved on what we've been seeing so far with this standoff and the potential invasion of Ukraine. But Moody's Analytics just a little while ago put out a note saying oil prices could easily jump over $100 per barrel if this conflict would lead to Russia halting exports of oil. So that would go a pretty long way. I don't think the baseline assumption is that Russia would automatically stop exporting oil, or sanctions would force Russia to stop exporting oil if there was an invasion of Ukraine, because that would hurt everybody who buys oil, of course. And that's a lot of the European countries who rely upon Russia for oil and also for natural gas. So even if there is some kind of shooting war on the Russia-Ukraine border, that does not mean there will be a halt of energy exports from Russia, but it means that will suddenly be something that is in play, and we probably would see that reflected in market prices at least for a while.
And Rick, just quickly here, as we watch this ramping up of tensions and ponder potential U.S. involvement here, what do you think is motivating President Biden when it comes to sort of teasing that involvement?
Well, yesterday we got the news that the Pentagon has told about 8,500 troops to prepare for a possible deployment to Eastern Europe. This does not mean they would be going to Ukraine. I think that's an important distinction everybody needs to keep in mind. They would be going there to play some kind of support role, possibly also to help evacuate Americans from Ukraine if that becomes necessary. But I think a big shadow hanging over what Biden's doing right now with regard to Ukraine is Afghanistan. That, of course, looked like a disaster last year. It's not the fact that Biden withdrew U.S. troops. It's that he withdrew U.S. troops, and contrary to what Biden himself had predicted, Afghanistan rapidly fell to the Taliban. And of course, we had that horrifying terrorist attack that killed 13 U.S. service members last August. So that looked like a fail for the Biden administration. And Biden does not like getting involved in foreign entanglements. I think he would be very careful if he did put U.S. troops into Eastern Europe. There probably would be a limited deployment with a deadline, for example. But I think the Biden administration, for sure, also realized that they looked very weak coming out of Afghanistan, and they don't want a repeat of that with regard to whatever happens between Russia and Ukraine.
Interesting parallel. Thank you so much, Rick. Appreciate it.
See you, Julie.
We're going to take a break. Coming up this week last year, we weren't talking about a sharp sell-off in stocks. We were talking about a sharp spike in one of these stocks here in particular, GameStop. Coming up, we're going to talk to Wall Street Journal editor Spencer Jacob about his new book that focuses on that meme stock craze. We'll be right back. Markets here continue to be in the red. Oh, look at that, though. We are cutting the losses a little bit, at least on the Dow, which is now down 400 points instead of 600 points, off about 1.2%. We continue to see a lot of selling, though, concentrated within the tech sector today, with the Nasdaq still the underperformer among the three major averages. It's down by 2%. You know, as we see all this selling today, we look back to 1 year ago, and that's really when the meme stock mania heated up. There is GameStop from last January going really through March. On January 28th, the stock traded as low as around 112 and as high as, 438, I believe is the number, the low and the high on that single session, as we saw all of that craziness go on. Of course, we've seen the likes of GameStop and AMC sell off sharply, along with a lot of the other risk assets over the past several months. Spencer Jacob wrote a book about all of this, looking into the meme stock mania, what was driving it, who really came out on top. He is joining us now. He's also editor of the Wall Street Journal Heard on the Street column. The Revolution That Wasn't is the title of the book. GameStop, Reddit, and the fleecing of small investors. Spencer, we're looking at the sell-off that we have seen in these stocks now, but there were people who made money, obviously, at the time with the big increase that we're seeing. Now that we have this sort of year between then and now, what are some of the takeaways?
It's hard to imagine that it's been a year. A year ago, GameStop was this failing video game retailer. AMC was a theater chain that was months away from going bust. BlackBerry was this company that used to make your smartphone. And then they became these weapons that were used against Wall Street. And the narrative at the time was they took the shares and options in these stocks and they blew multi-billion-dollar holes in big Wall Street hedge funds, and that they had kind of outsmarted Wall Street. And very temporarily they did. And it's a crazy story. It's crazier even than you remember. And I tell it, I go back to the origins of the story, and it's fascinating. But they didn't beat Wall Street. I mean, that's basically my take. And that's why I call it the revolution that wasn't, because in terms of, Wall Street's a big place, and Wall Street likes it when people get very excited about beating Wall Street and plow a lot of money into it. And a lot of people, corporate executives too, got really rich off of this. And not that many people who participated as retail investors made money. Some did, of course. They always did. People made money on pets.com. People make money on everything. Yep. But a lot of people didn't do well.
Spencer, what interests me and what I find fascinating is there's still this hardened group of meme stock investors just love the likes of GameStop. They love AMC, even though they're probably sitting on losses. Is that surprising to you, just their loyalty to these stocks?
It's completely surprising to me how much it's still remained a story. I guess as somebody who spent the last year writing a book about it that comes out in a week, I'm happy that it's still very much a story and it's still very much a punching bag. But look, I mean, it's like, one of those like predictions that the world is going to end. And that's kind of what you've seen on these message boards. There's going to be this huge mother of all short squeezes. It's going to bankrupt Wall Street and we're going to make a lot of money. And it keeps not happening because it won't happen, because it's predicated on numbers that don't really add up. And you've had people kind of charge at it again and again. It's like you're waiting for lightning to strike a second and third and fourth and fifth time. And the conditions that happened a year ago just are not going to repeat themselves. Of course, if lots of people rush in and buy a stock, it's going to go up for a little while, but Wall Street's not going to get, caught sleeping again.
And the Wall Street Journal itself published a story this week looking at the big drop in posts on Wall Street bets, right? And that basically they're just beating the AMC and GameStop horses over and over again. Mm-hmm. In writing this, did you get any insight as to what the next phase of retail revolution, or if it's not a revolution, at least retail involvement in the market is going to look like?
I see it as morphing, and I see that the people who got involved in this, and that's really who I'm concerned about, are the people who got involved in this. Young people who opened accounts, more than 10 million people opened brokerage accounts over the course of my story. I see some of them continuing to speculate, but maybe finding other things that are more exciting, like cryptocurrencies. There's already been a lot of morphing into that. And a lot of those people, they kind of got hooked on the adrenaline rush of the whole thing. I see people also feeling very bitter about Wall Street, probably not without reason, and just saying this is not for me. And that's going to cost them a lot of money, because if you don't participate in Wall Street, if you're a 20 or 25-year-old and for the next 40 years, you don't save money, don't put money in a 401k because you see Wall Street as crooked, that's going to cost you a ton of money compounded over the years. And then some small minority, but I hope not that small, will kind of, say, hey, I learned my lesson. This wasn't that smart. And getting advice from random people on Reddit was not that smart. And I'm going to kind of just slow and steady wins the race. And I'm going to save for my future now that I have an account open. So I hope that group is not that small, but but that's really who I'm kind of speaking to when I write my columns for the Wall Street Journal.
A lot of big names on Wall Street, Spencer, lost a lot of money during this frenzy. How are they feeling right now?
Well, they felt pretty stupid at the time. And if you look back, everything's obvious in hindsight. You look at what was going on. I go back several months before the events and look at what was going on the message boards, and it was spelled out. So there were some sophisticated people on these boards who said, we're going to create a short squeeze. This is how you do it. These are the options you need to buy to have the maximum bang for the buck. These are the people who are most exposed. And so, people like Gabe Plotkin, whose Melvin Capital lost $6 billion, and he certainly wasn't the only one to take big losses. It was just a case of hubris. They weren't reading these message boards, or if they were, they weren't taking them seriously, and they never imagined that this could happen. This was something that was completely beyond, if you're short a stock and then some other company comes in and buys it, or, the company cures cancer or whatever, then you're going to lose money and you're going to lick your wounds, because, that's what happens. But you never imagine a stock going from $2.17 to $483 because a bunch of people got excited about it on a message board and nothing, fundamentally changed with the company. So that was something they just didn't see coming, but they're prepared today.
Well, in the meantime, perhaps the apes should pick up the book and figure out maybe what they should be doing differently or not doing differently going forward. Spencer Jacob, Heard on the Street column editor and columnist and author of The Revolution That Wasn't. Thanks so much. Appreciate it. When we come back, we're going to talk about global economic growth and a potential slowdown, or at least not quite as robust as had been anticipated. We'll be right back.
This morning, the IMF lowered its global growth estimate to 4.4% from 5.9%, a host of concerns. Let's talk more about the move with IMF Chief Economist Geeta Gopinath. Yahoo Finance's Brian Chung is here as well. Geeta, what was the biggest factor behind this move?
So we downgraded growth for this year. We had it at 4.9% and we brought it down to 4.4%. And that's explained to an important extent by sizable downgrades for the US and for China. Now for the US, it's because we don't have the Build Back Better fiscal package anymore in our baseline. And we're, of course, expecting interest rates to go up. And so the monetary tightening is in that too. And we have supply disruptions that have lasted longer. In the case of China, well, I think there are two big factors. One is the slowing real estate sector. That's been weaker than we've expected. And the fact that the recovery in private consumption, again, is not strong enough. So both of those factors are leading to the downgrade.
Geeta, Brian Chung here. It's great to have you on the program. I want to zoom in a little bit more on the United States. What is interesting is this is also coming at a time when the Federal Reserve is posturing for a possible tightening of policy. How do you see that weighing on the global growth prospects for the country?
Well, in the case of the US, the recovery has been very strong and very fast. So the US is back to pre-pandemic trend GDP. There's really the output gap is zero. And employment has recovered strongly, even though there's been a decline in labor force participation. The unemployment rate is under 4%. So it is a strong recovery, and inflation ended at 7% at the end of last year. So, it is to be expected that interest rates should go up. Given what, the expectation of the path of interest rates, that would still keep real interest rates quite accommodative. So, our expectation is that growth will slow, as it should, to prevent the economy from overheating anymore. But it should be a fairly well-behaved transition down.
Can we zoom in a little bit on inflation? Because it's not just a U.S. phenomenon, it is a global phenomenon. But what is interesting is that the report did note that the kind of threat of a wage price spiral might be more pronounced because there's more broad-based inflation in the U.S. than in other jurisdictions. How does the World Economic Outlook look at inflation from that perspective? Is that also a big reason for the downgrades that we saw in the U.S. and globally?
So, indeed, if you look at inflation across the world, it's up. Headline inflation is up. And that's because of the increase in energy prices almost everywhere. But on the other hand, if you look at core inflation, that is, there's less trouble there for a bunch of countries than there are for others. In the case of the US, we've seen core inflation go up quite substantially. The inflation has been broad-based. Nominal wages have grown. They've grown most for workers who work in sectors like leisure and hospitality than for the others. We so far do not see a wage price spiral in the US. But indeed, when you have very tight labor markets, you still have a lot of pent-up demand, especially for services. We should expect to see those forces putting pressure on prices, which is why makes absolute sense to start raising interest rates.
Geeta, it's Julie here. Does the biggest core unknown remain the path of the pandemic? It seems like that we are, at least here in the United States, seeing numbers peak and start to come down. But of course, there could be other variants, so we don't know what this year's going to look like. Is that the biggest sort of unknown and therefore maybe biggest risk?
It is one of the biggest risks indeed, that we remain in the grip of the pandemic. While Omicron is having a big hit on activity in the first quarter, we don't expect it to have a big hit for the year as a whole. But again, there are many risks that still exist. For instance, if there are more lockdowns, more shutdowns in China because of the zero COVID policy, then that can have important implications for global supply chains. That has consequences for inflation. So there is tremendous uncertainty, I would say, that remains highly elevated. And of course, also in terms of the US monetary policy reaction, what that will look like, and whether that could then generate, if there's, for instance, if there's a very sharp increase in borrowing costs around the world, then that, of course, has negative implications too. So just tremendous amount of uncertainty, and I would expect that there will be some turbulence as we're seeing these days.
Agit, so something that thematically we've been talking about on the many times that you've hopped on our program here over the course of this pandemic has been the diverging recoveries in different economies. And what's interesting was that within the context of monetary policy, we've already seen tightening in those emerging market economies where they may not have recovered as fast as the US, where we haven't even started that process yet. How does the IMF kind of look at where the recoveries are now as we head into a period of time when all the advanced economies are going to start to tighten, but maybe the recovery has already full stopped in some of these emerging markets?
Yes, Brian, and unfortunately, the divergent recoveries just persist. We have advanced economies back to pre-pandemic trend this year, and for many emerging and developing economies, we have significant losses into the medium term, like in 5-6% range. So there is much more scarring that's going on in emerging and developing economies. And several of these countries have indeed raised interest rates sharply to get ahead of price pressures, even though they haven't fully recovered in terms of output or employment. So they have a higher challenge. Their debt levels are also high, and they are more susceptible to increases in global interest rates. So that is something that we're being very watchful of. I mean, just to be clear, it's not that all emerging markets can be painted with the same brush. There are several that have large amounts of foreign exchange reserves. They don't really rely on dollar borrowing from the rest of the world. They are in a better shape. But there are others that actually do borrow a lot, short-term borrowing in dollars, have large external financing needs. And if there were sharp increases in borrowing costs, of course, that would be particularly problematic for them.
Yeah, and of course, differentials in interest rates could make for interesting capital flows as well. But Geeta, last question here. I just kind of want to ask about you. It is important to note that this will be your last report, World Economic Outlook report, as the chief economist of the IMF. You'll be transitioning over to, or you already have transitioned, I think, over to the first deputy managing director role at the IMF. Can you tell us a little bit more about that job switch and kind of how your responsibilities are going to change? Because obviously that's a big shift over there.
It is a big shift. I'm very honored to have been given this opportunity. I go from being economic counselor and director of one department, which is the research department, to overseeing multiple departments and working with a very broad swath of colleagues in different areas. I think what's been very gratifying for me these past few years is the ability to combine rigorous analytical work with public policy and to see the difference it can make in the world, along with my IMF colleagues, and I hope to continue that.
Well, good luck in the new role. IMF Chief Economist Geeta Gopinath, always nice to see you. Yahoo Finance, Brian Chung, thanks so much. All right, before we head to break here, let's get a quick check of the markets. Seen a little bit of a rally here off the worst of the session. Dow down about 254 points according to the prices I have here on my trusty screen, but all three major indices in the red. And we'll be right back.
Welcome back. We've got stocks that are continuing to sell off at this hour. They're up off the lows of the session. The Dow at one point was down more than 600 points. Now it's only down more than 300 points. S&P and the Nasdaq also pretty deeply in the red here. There's one stock that's higher that we're watching, more than one, but there's one in particular, and that's American Express after the company came out with its numbers and also raised its forecasts. Brian Sazzi talked to the CEO. So Amex, an outlier in the right direction today, Saz.
Yeah, this is quite the move in Amex, but again, perhaps justified, just given the revenue strength Amex saw throughout its various businesses. I have the full story right now on the Yahoo Finance homepage. But yes, I caught up with Amex CEO Stephen Squeri ahead of our show today. Him really striking an upbeat outlook for this year, saying he's not seeing any cautiousness in consumer spending, and Squeri citing quickly after I asked him about any potential weakness in consumer spending, travel bookings, telling me that travel bookings so far in January are up 19%. So that is pretty good given where we are in the pandemic. Now, Amex is seeing earnings this year in a range of 925 to 965. The consensus was for about 967. But again, Squeri striking an upbeat tone in our interview. Also, too, I think what you're seeing here is a positive response to their dividend increase. Amex out here raising its dividend 20% in a broader stock market, looking for yield, looking for a little safety in this volatile world. That is going to be well received. But I do find it interesting, Julie. Squeri, he talked at our All Market Summit conference in the fall, really noting that they're taking a wait-and-see approach to Bitcoin. That is what he told us at the time. And I would say that strategy is validated in light of just this plunge in cryptocurrencies off the highs here. Squeri still, I think, taking a wait-and-see approach to rolling out anything related to crypto on the Amex platform.
And it's also interesting, as you talk about the consumer, that we got the conference board's read on consumer confidence day for January coming in better than estimated. And that survey noting that a lot of people are planning to make purchases and big ticket purchases in some cases, things like houses and cars and vacations. So one would think that would be good news for a company like Amex does.
Well, I'm only thing I'm buying today, Julie, is more coffee. This is a big day of earnings. We have 3M CEO Mike Roman on next. It's going to be a long day at the ranch.
Yes, it is. And Microsoft coming out after the close of trading. By the way, our top trading ticker on the platform right now, General Electric, which is not in the green. It is down almost 7% after it reported earnings as stocks overall sell off. Akiko and Brad coming up next.
Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Brad Smith. We've got another choppy session on Wall Street right now. The Dow down more than 400 points one day after clawing back 1,000 points. We're looking at the Nasdaq, the biggest laggard on the day, yet again down about 2.5%, while the S&P 500 is off roughly 2%, now on pace for its worst month since March of 2020. A better than expected quarter. Moving 3M here, failing to lift those shares there. We are seeing it down in the session as the company looks to navigate a challenging environment. A conversation with CEO Michael Roman is up ahead. Plus, rising temperatures leading to rising insurance costs. A new report from Aon pointing to more than $340 billion in losses from climate-related disasters, making 2021 the third costliest year on record. We are beginning this hour, though, with a look at the market action. Jared, a wild day on Wall Street yesterday. And we heard yesterday, I looked back. I was away from my computer for about an hour. I came back. I saw it back in the green, but it looks like we're down again today.
Yeah, and I'll tell you what, par for the course here. We are in an environment of very low liquidity, heightened market volatility. We have, for various reasons, options dealers, commodity trading advisors chasing the market in both directions. And yesterday looks like nothing more than a very violent short covering bounce, down 4%, 5% in the markets, then recovering into the green, into the close. I look back, that's never happened 2 days in a row, down more than 2% and closing in the green. Actually happened in the Dow in 1932. So that is the only example I was able to find. But let's go to the Wi-Fi Interactive. I'm looking at the Dow, and aside from some earnings stories, we got J&J, we got IBM, American Express, talking about those throughout the next 2 hours. Aside from that, just another day of solid red. Microsoft down more than 2.5%. United Health also down more than 2%. Cisco, Disney, same story. So really seeing a lot of these names take it on the chin. And I think one of the key takeaways from this year is that we saw retail buying in droves until last Thursday and Friday, and they were just capitulating yesterday morning. And unfortunately, I don't think the institutional side has quite gotten there yet. So let's take a look at the sector leaders today. Only energy in the green. We've seen that story play out many times this year. Other than that, everything down more than 1% or so. Tech taking it on the chin. That's down over 2.5%. So is industrials and materials. So a lot of those sectors really have experiencing some more losses here. Taking a look at the travel sector, a few bright spots. We got Delta, United, and Alaska Airlines. And then finally, Norwegian Cruise Lines just flipped into the green. But aside from that, seeing a lot more carnage in this space. Airbnb down 3%, down about 10% over the last 2 days. And Avis Budget Group down about 7%, guys.
Jared, while we have you, let's go deeper into tech. Of course, there was this lingering thought that maybe with some of the declines that could offer perhaps a re-entry point for some of the traders looking at those as discounts for some of their longer positions in tech. So what most notably are we keeping an eye on within that sector?
I think most notably, we got to keep our eye on the Fed because it's all about interest rates. And fortunately, we have a very here from Stifel joining in a couple minutes. He called the top in the S&P 500, calling for 4,200. That was a 600-point drop. Guess what the low was yesterday? 42.21. So I think we can have some insight there. But it's really about interest rates, isn't it? Especially when we're talking about those tech stocks. And we've had those rising interest rates, which have been a major headwind for them. So going back to the Wi-Fi Interactive, I'm looking at our semiconductor heat map. ASML down almost 5%. We got Xilinx down 6%. AMD and Nvidia each down more than 3%. And even got some news on the Nvidia front that they're killing that ARM deal. Pretty much expected. Most analysts already thought that. A lot of analysts I talked to over the last year said they don't even need to go in that direction. So I think this is more of a market story. Very similar how this is playing out in the software space. Microsoft going to be announcing earnings after the bell today. That's going to be a big one. But you can see, let's take a look over the last month, down 14%. So the mega caps still struggling here, guys.
Okay, Jared, thanks so much for that. And Jared, just setting things up for our first guest for the hour, we've got Barry Bannister, Stifel Chief Equity Strategist. Barry, it's good to talk to you today. As Jared said, he said, when Barry talks, we should listen, given where things moved yesterday. And you've said the intraday relief rally we saw yesterday was a bit of a head fake and that there's more downside ahead. What do you see?
Well, we first got pretty concerned about the market in May of last year and the very low 4,000s. And it looked like almost a ballistic path for the market, where it climbed the stairs and then fell out the window. The market dropped very abruptly, and that's something we had been concerned about, back to those levels of last early summer. If the Fed does not turn more dovish, which I have no reason to expect, we have not yet seen financial conditions tighten or credit spreads widen. There's no reason for them to turn dovish before the first rate hike in March. They would lose all credibility. So the Fed relentlessly moving towards tightening. How much is priced into the market? The big issue that we saw was that the 10-year real yield, 10-year after inflation on the Treasury, it's called the TIPS, or Treasury Inflation Protected Securities. We determined that there was a lot of convexity for the growth stocks. They were the more sensitive index to a rising real yield, and that's what we've seen year to date. And so we've been watching that. We're also watching economic indicators. Some of the value trades got ahead of themselves, given that we felt inflation would pull back, that the purchasing managers index would pull back, and that China's stimulus would be somewhat lacking. In other words, they're doing just enough to avoid a debacle, but not a lot. So overall, we still would wait on the market. I think the defensives are the better place to be in the next couple of months of this quarter. And then we'll reassess towards the end of the quarter what the potential is for growth stocks perhaps to rebound if inflation moderates and the Fed is, cautious to a degree about the balance sheet and the interest rate path.
Barry, Jared just pointed to that 4,200 level that you're watching, the S&P 500, as you look to more downside. How long do you think it takes until things kind of shake itself out? Are we talking about the end of Q1? What kind of timeline?
Yeah, the end of Q1 is when things become a little more clear. The Purchasing Managers Index, the PMI for manufacturing, is kind of the Swiss Army tool of economic indicators. It does correlate on a year-over-year basis with industrial production, S&P 500 earnings growth, and the year-to-year S&P 500. That index in the first few months of this year is going to fall out of bed from almost 60 to barely above 50. Also, the dollar is very important. That has a way of tightening global dollar liquidity. You translate all the money in the world into dollars. The dollar is strong. Global liquidity is tightening. The Chinese yuan is the currency to watch. We have been seeing how strong that currency has been because of their large trade and other current account surplus. But China has an incentive, and of course the market forces them to push the currency down, which drives the dollar up. It's a disinflationary shock, not particularly great for value, eventually not great for oil prices. Ukraine's kind of in the background. It's very, very important for oil and gas prices. I don't think Putin intends to invade, but he's got a valid point about Ukraine not joining NATO ever. So that hasn't been resolved yet, and that's a potential real issue for the market. You could see a severe winter on account of that.
Barry, even as we continue to move on forward through earnings season as well and get some of the company's forecasts, many of them pointing back to pre-pandemic levels that they're looking to see either revenues or profits grow on top of. And so with that in mind, how will investors who are hearing about some of that growth versus those pre-pandemic norms, how do you believe they'll trade on those scenarios, even with some of the headwind risk that you mentioned?
Well, I mean, if Hollywood made a movie about the pandemic fiscal and monetary response, it would have to be called Overboard Part 2. The spending at the fiscal level on COVID was just excessive. $5.8 trillion, 5,800 billion were appropriated in 12 months, March of 20 to March of 21. To put that in perspective, if you inflation adjust the cost of World War II, plus the Marshall Plan to rebuild Europe, plus the global financial crisis fiscal response, plus the Great Recession fiscal response back in the prior decade, all of them combined was less than 5.8 trillion. And then the Fed, of course, did QE4 at a rate 45% larger than Ben Bernanke's QE3 had ever been back in 2013, and had to eventually soak up that money on the back end. In other words, overnight reverse repo became 12 months of QE. So when you look at how much over replacing income in fiscal and stimulus to drive down risk premiums drove up the market, it's a very high bar for the market to exceed. And I think that's going to be a real problem for earnings growth and beats versus miss rates. And you're seeing it in the market today.
Well, Barry, it's great to get your insight today as investors try to make sense of the most recent moves. Barry Bannister, Stifel Chief Equity Strategist. Well, better than expected quarterly results failing to lift the stock for 3M, hitting a new 52-week low in this session today. I want to bring in Yahoo Finance's Brian Sazi, who's standing by with a special guest. Brian.
All right, thanks so much, Akiko. Joining me now is 3M CEO Mike Roman. Mike, always nice to see you here. Within your earnings report, something caught my attention, not hearing it from a lot of other folks. You said you had notable strength in December. What did you see in your business last month, and has that strength continued into this year?
Well, good morning, Brian. Thank you for having me on today. Yeah, we talked about that. We had a solid finish to Q4, capping a strong year for 3M Company, and that was really better than expected growth across each of our 4 business groups with some strength in December. And that included each of those businesses coming in a little better and some increase in N95 respirator demand that was part of that as well in the month of December. So a little stronger than expected on the top line. We continue to effectively manage our production operations in the middle of some of the ongoing supply chain challenges, delivered for our customers, continued to get some traction on our pricing actions. All of that combined enabled us to deliver a better than expected result, both top line, bottom line, and some strong cash flow as well. So a solid finish, and for the year, strong broad-based growth across our businesses, strong performance both in margins and an increase in adjusted EPS. So again, capping a strong year for 3M Company.
Mike, it's been a volatile few days for the markets. I'm sure you saw what happened yesterday in the markets. Just stunning reversal, things under pressure here. Talk now about a potential recession later this year because of interest rate hikes. How do you see it? Are you cautious to start the year?
Well, there's a lot of uncertainty as we come into 2022. I would say there's some positives. We're well positioned as a company to deliver on growth in the new year. We've got that strong performance that we delivered in Q4 on top of the total year. We've been investing in areas for growth. We have some fast growing trends that we're investing in. We've got areas like our automotive electrification up 30% in 2021. Our biopharma business is up 26%. Our home improvement business continues to grow at double digits. In fact, we're investing, we announced this past week that we're investing almost $500 million in a new factory in Clinton, Tennessee to support that growth and demand. So we're well positioned from what we've been investing in from a growth standpoint, and those trends that we're seeing in those end markets that can leverage 3M capabilities and strengths. Now, the outlook for the year, the macroeconomic outlook for the year still looks fairly positive, both industrial production and GDP, I would say even down to some of the individual markets like build rates for automobiles. It's the uncertainty in the near term that is really the challenge. What's going to happen in supply chains? We've managed through challenges in Q4. It's still with us. We're still seeing constraints and disruptions in supply chains. And now you have some questions in the outlook for the overall market as we go into the new year. I would say we saw in Q4 and that strength in December that I talked about, strong demand in our end markets. Our customers were still demanding product and focused on serving them was really a priority. And that's got us positioned well, not to take away anything from the uncertainty related to the pandemic, the supply chains, the challenges that we might face in the markets as we go into the year.
Mike, are you seeing anything in your business that would suggest we have hit a peak in inflation and things might cool down a bit?
Yeah, we talked a little bit about this, Brian, on our call this morning. We saw inflation continue to step up in Q4, although the rate of increase slowed. So maybe the first indicator that inflation is slowing as we get through the end of the year, the increase of inflation is slowing. just a reminder, when you look into 2022, we called out inflation as having a bigger impact on us at the end of Q1 in 2021. So we were saying it's coming, and we saw it step up in Q2 of last year, Q3, and then again in Q4 at a slower rate. So the year-over-year comp is going to be significant as you get into 2022. And so we expect to see an impact from inflation even at a slower stepped up rate. So that continues to be one of the challenges. We also continue to see disruptions in the supply chain. So that serves up challenges in logistics and getting products. And we're investing either in how we run our factories or how we get product to our customers. That's another part of increased costs in our supply chain that we have been investing as we've gone through the year to really deliver for those customers.
The supply chain challenges you're still dealing with. Since we last spoke, so many folks say this will be the year things get better. By mid-year, the supply chains will be back to some form of normal. How do you see it?
Yeah, I think there's estimating the duration of some of the impacts. We do expect it to get better as we go through 2022. We're seeing a convergence of COVID-19, a snapback in demand, and I would say just some of the constraints that are on raw materials and labor as we have worked through some of those same issues. And we would expect that to get better as we go forward. Starting the year, we are anticipating continuing to having to manage through that. So it's a matter of how soon and how much better it's going to get as we move through the year. And we didn't do a lot with guidance on our call this morning. We're going to come back on February 14th. We've got an outlook meeting with investors. We'll lay it out in more detail how we look at the year and how we look at the impact as we progress.
And I have to give you a hat tip, Mike. You and your team are investing $500 million to build some new manufacturing capacity in Tennessee. And that comes really hot on the heels of Intel investing $20 billion in Ohio to build out its manufacturing capabilities for its chips. As you take a step back and talk to your peers in the manufacturing industry, do you think we're seeing an American revival in manufacturing?
Well, for 3M Company, we've always been an investor in the region of the world where we do business. So we invest to serve our customers from production in the regions of the world that their markets are. And that's true for the U.S. We have about 40% of our revenue in the U.S. We actually produce about 55% of our supply out of factories in the U.S. It's maybe the one exception where we do export. So we're one of the top 100 company exporters out of the U.S. as a result of that. So we've always invested in the U.S. to serve our customers here as well as around the world. We do produce the majority of what we sell in Europe, Asia, in factories in those parts of the world as well. We don't export out of those regions very much. So our supply chain challenges as we've gone through 2021 are often getting product from our U.S. factories to customers overseas. We have challenges getting product from our factories to customers in the U.S., but also in getting them overseas. So we've had that idea of investing where we can deliver the greatest value for our customers globally, and the investment in Clinton, Tennessee that you mentioned, that's related to our iconic brands in home improvement, our Command damage-free hanging, our Filtrete home filtration products. Those are strong growth drivers for us as a company. There's trends in the U.S. that create increasing demand. And so that's really an opportunity to invest in a factory in the U.S. to serve customers in the U.S. So we're excited to make that announcement where it's one of the areas that we prioritize coming through the pandemic, and it is helping to position us well as we go into driving growth in 2022.
Good to see it. 3M CEO Mike Roman, always good to see you. We'll check back with you soon. Brad, back to you.
All right, thanks so much. Brian Sozzi there with the interview with Mike Roman, 3M CEO. Everyone, we want to get you a quick look at the markets here to let you know where the major averages stand. Just before we go to a break, checking in on the Dow Jones Industrial Average, you're seeing that just above 34,000 right now. It's off of its session lows, but still down by about 350 points at this point in time, 1% there. S&P 500, you're seeing that lower by about 1.75%. We'll round that off to 76 points to the downside there. And then additionally, the Nasdaq Composite, we've got that deep in the red right now to the tune of about 2.4%, 330 points for the tech-heavy average. We'll continue to keep a close eye on that. Plus, on the other side of this short break, GE, Johnson & Johnson, and IBM all announced earnings results today. We dig into their performance and outlook for the year ahead after the break. Welcome back to Yahoo Finance Live, everyone, on a down day for the markets. Some of the companies who have reported earnings this morning, today, hoping to buck the trend. However, General Electric not able to do that as of right now. Shares are lower by about 6.6%. We're going to dive into a few companies that we've been keeping our eye on in today's earnings roundup. And first, we start things off with GE. For that, I want to bring in Akiko. And Akiko, what really stands out to you with regard to where and how this company performed? We're taking a look at the actuals versus the estimates there on screen.
Yeah, I mean, Brad, you look at the share price down about 6% in the session here. The company did beat on earnings, but missed on sales, and also offered cautious guidance, which could be weighing on some of the shares there. GE posted a profit of 92 cents a share on revenue of just over $20 billion. Looking ahead, though, GE saying they expect to earn about $3.15 a share, generate $6 billion in free cash flow. That growth in free cash flow was the good news, but sales of about $80 billion. When you look at earnings in the outlook, Wall Street was expecting $4 a share, so coming in a little lower than expected. The common story that we're hearing, and I think specifically, I'm looking out for Brad here in all these earnings calls, is just how much improvement has been made on the supply chain issues. The company saying they're continuing to be weighed down by those challenges, saying they don't expect to return to sales growth until 2023, with some of the recovery happening in the aviation business. But as we were talking about before the show, this is a company that is going through a transformation with that spinoff expected, with the energy as sector as well as their aviation healthcare business. So a bit of good and bad for the company, but when you look at where the shares are today, investors focusing a bit more on some of that mixed outlook.
Yeah, that's right. And I mean, you hit the nail on the head with so much of what we're going to be watching going forward from GE, especially with the revenue growth. They're expecting to return to revenue growth in 2022. And you mentioned aviation. They actually said on that they expect aviation revenue to increase more than 20% in 2022. They're citing the continued commercial market recovery on that particular instance and segment of the business here. And so we're going to continue to track GE shares here on the day after they missed on revenue, and with some of those concerns that we laid out, their stock moving lower as of right now. I do want to get into J&J though, because this is one that I've been keeping an eye on. Early in the trading session, we saw it open lower, ultimately was able to get into positive territory, holding on to gains as of right now, up by about 1.4%. And taking a look at some of the actuals versus the estimates for this company in J&J as well, we had seen revenue come in at $24.8 billion, and then EPS come in at $2.13. So you had a slight miss on revenue, but a beat on EPS just barely by the hair of a chinny chin chin there. But a few of the things that stuck out to me with regard to this report that came in from J&J, because I think what is notable here is while the stock opened lower, it's amassed some gains. And one of the reasons we may have seen that initial move lower based on the guidance, operational sales growth of 7.7% for 2022 versus the 12.8% in 2021. So investors perhaps pricing in a deceleration of growth year over year early in the trading session. However, there are a lot of positives to take out of this. You saw gains, growth across all categories for J&J, pharmaceutical sales that continue to be the Marshawn Lynch, if you will, from his days in the Seahawks, putting the team on his back, if you will, and carrying the load. Over half of the business revenue comes in from this division, so no surprise there. This is the line of business that accounts for Stelara, Tremfya, as well as the COVID-19 vaccine too. And then medical devices, just want to note that reported the best growth in full year results at 18%. But large questions for the company in the future, of course, as they transition perhaps into a for-profit business for the COVID-19 vaccine that they've put forward. We'll see exactly where investors try to get some clarity on the timing around that going forward. And then just lastly here, the consumer health division, when that will eventually have the kind of successful spin-off that they were looking for there, and the splitting of that division into its own separate entity and business, which should go forward throughout the rest of this year and the planning for that.
Yeah, I thought it was interesting, the company highlighting also the stronger dollar negatively affected sales by 150 million to 200 million. And, yesterday we were talking about the dollar hitting a 2-year high. So an interesting thread to be watching for in other calls too. Let's end things with IBM right now. We saw shares up as much as 7% in after hours yesterday. This is the quarter that the company spun out its managed infrastructure business. Revenue for continued operations grew 6%, marking its fastest revenue growth since Q3 in 2011. Net income in Q4 soared 72% year on year. But going back, Brad, to the labor market and how the companies are being affected, CEO Arvind Krishna saying they are in fact facing shortage of workers who have the right set of skills the company is looking for, and they're having to pay up for those workers, although the company said it's going to take a few more quarters for the impact from those higher wages to trickle down.
Yeah, that's right. And we're taking a look at the segments here, and software continuing to be a major boon for this business. Of course, they continue to cite Red Hat up 19% as a kind of subsidiary within that software business, and then hybrid platform solutions up 7%, which is included within that software number that we're taking a look at. But infrastructure and financing, we'll see exactly where the management team prioritizes some of the growth efforts within that part of the broader IBM consortium of businesses that they do have. But Big Blue, ultimately here on the day, keeping a close eye on shares of IBM, and we'll see how they're continuing to do, especially in spite of some of the movement that we've seen on the broader markets lower here on the day. As of right now, IBM stock still holding on to gains of about 2.4% right now, Akiko.
Yeah, and Brad, we're going to get into the thick of things in terms of the tech sector and earnings with Microsoft out later this week, and then Apple, or later today, and then Apple, of course, later this week. Coming up, though, we are talking about climate change, rising temperatures leading to rising insurance costs, a new report pointing to a significant amount in terms of losses from those climate-related disasters. A conversation with Aon's meteorologist is coming up ahead. 2021 marked one of the hottest years on record, and a new report from risk analysis firm Aon finds the total cost of climate-related natural disasters last year exceeded $343 billion. That is the third costliest year on record. Now, all eyes are on what's in store for 2022. Let's bring in Steve Bowen. He's meteorologist and Aon head of catastrophe insights. Steve, it's scary to think that we saw everything we saw last year. All sort of predictions here, forecasts seem to suggest that things are only going to get worse. What we saw in 2021 point to in terms of this new reality businesses are going to have to deal with?
Sure. So first of all, thank you for having me today. What we've continued to see over the course of years, decades at this point, is an acceleration of disaster losses from these larger scale, more impactful events. And what we're really seeing from a business standpoint is that it's not just the physical location as to where events are occurring that's leading to disruption to businesses and their outputs. It's that it's having this sort of domino effect, this cascading effect around the world, where it's affecting supply chain, it's affecting any type of manufacturing deliverables. And so companies are really having to keep an eye open around the world in terms of these larger scale events. And it's not just weather and climate events, it's also earthquakes, tsunamis, all can lead to significant disruption in allowing companies to be able to deliver product to get on the shelves for the end consumer. So having to take a step back and recognizing that it's not just the direct impacts that may be affecting the bottom line, it's also these secondary and tertiary effects as well that lead to some really, really non-negligible dollar losses.
So how has this shifted the expectation for businesses, number one, on mitigation, but also in setting aside the funds in the expectation of some impact from these disasters?
Well, there's never been a more important time to really seize upon public-private partnerships, really working with governmental bodies to understand that we really need critical investment of infrastructure to make sure that we're not building to meet the climate of yesterday. We know that climate events or climate change is enhancing the weather events that are occurring today. And that's happening in conjunction with just a lot of development into high risk areas that we know are likely going to be facing various types of weather related risk. So spending money wisely on infrastructure, it's more of an investment, is really going to end up saving a lot of money down the line. So what we're doing today is really going to be beneficial to down the line, and hopefully saving a lot of potential dollar losses as these inevitable events occur more frequently with time.
How will this alter regional economies if you have businesses that are having to continue to navigate some of these climate and climate-driven disasters, quite frankly? How does that change the makeup of those economies in certain cities? And what does that look like for even the potential for some of those businesses to say, hey, you know what, we're going to try and move somewhere else, at least for the time being?
It's a huge challenge. I mean, we certainly have seen a lot of shifts. A lot of companies are having to take full stock of where their portfolios are located after a big event, and oftentimes it's a series of events. We have a lot of areas that are what we call repetitive loss locations. So this is really causing a real reanalysis of the overall level of risk the companies are able to withstand, what they're comfortable facing. So I think we're really having to take a step back and see more working along the lines of working with the governmental bodies to fully understand the risk, making funds available. There's a lot of countries around the world that don't have, say, high insurance penetration, to be making funds available to help companies and help people get back on their feet in the aftermath of some of these larger scale events. And what we saw, frankly, in Tonga with the recent volcano is a great example of really needing international support to come in and help people get back on their feet after a really significant natural peril event.
Steve, certainly a lot of businesses bracing for updated regulations on disclosure rules around the climate impact. They've been facing a lot of pressure from investors as well. How do you think that's going to accelerate the investments that are needed, once again, on mitigation, especially given that things haven't moved as quickly here in the U.S. when you compare it to a place like Europe?
It hasn't moved as quickly, but there's definitely momentum. We're starting to see states like New York, California, even Vermont that are starting to require more of these types of climate-related disclosures. We're seeing a lot of rating agencies starting to talk about, we're going to start scoring individual companies on how much they're taking climate change into account, more of their ESG, their environmental, social, and governance topics into account on their day-to-day business planning. So this is something that's not going to go away as we continue to see more of these regulatory bodies, not just internationally, but here as well in the United States, really force companies to put some type of mandate together to highlight what they're doing to diversify their portfolio, to wean off fossil fuels, or more importantly, just take climate change into account and have a plan. I think we're going to see more and more of that in the future. And as you mentioned, investors, we're certainly seeing more of the activist investor come to the table, as well as really starting to promote and push more of these types of fundamental structural changes at the corporate level.
Well, Steve Bowen, we appreciate the time today. Meteorologist and Aon Head of Catastrophe Insights. Coming up, Russia launching new military exercises as NATO moves into the region and beefs up security. Plus, Prime Minister Boris Johnson facing new pressure here over reported parties at 10 Downing Street. We're going to tell you about an investigation launching on the other side in our Worldview segment after this break. In our Worldview today, Russia has launched new military exercises in response to moves by NATO and the U.S. The country's defense ministry released video showing short-range ballistic missile crews being deployed to take part in a series of drills. The military also announced a separate exercise in the south of the country involving more than 60 Russian fighter jets and bombers. The move comes after the Pentagon announced it was placing 8,500 U.S. soldiers on high alert to support NATO troops deployed to the region. Tensions between Russia and NATO have escalated amid growing concerns the Kremlin is planning an imminent attack on Ukraine. It has placed more than 100,000 troops along Russia's border with the country. Over in London, Scotland Yard has launched a criminal investigation into parties at Downing Street, adding to growing pressure for Prime Minister Boris Johnson to resign. The police commissioner said she's looking into potential violations of COVID restrictions over the last 2 years, though she didn't specify if Johnson was part of that investigation. Now, the Prime Minister welcomed that news, adding that it would help to give the public clarity in the face of accusations his staff deliberately violated the country's COVID protocols. The investigation delays the findings of a government ethics report into parties held in Downing Street while much of the country remained in lockdown, and lawmakers have threatened to hold a no-confidence vote to remove Johnson from office. And the Australian Open is reversing course here, allowing for demonstrations in support of Chinese tennis star Peng Shuai. Tournament organizers eased the rules after they faced pushback for removing a small group of protesters wearing shirts that read, "Where is Peng Shuai?" The tennis star has been missing from the court since she accused China's former vice premier of sexual assault. While she's reemerged in public, Peng has largely remained silent about those allegations, leading to accusations that Chinese authorities are censoring her. That prompted the Women's Tennis Association to pull all of its tournaments from China last year. Coming up, Bitcoin finding some support after falling below that $34,000 price handle. But could this shift White House plans for crypto regulation? That discussion's ahead after this break.
Welcome back to Yahoo Finance Live, everyone. Bitcoin is attempting to find support. It's in the green today. That's after falling to 33,000 to start off the week. And the broader crypto market, even amid some of these broader declines, they may alter the White House's plans for regulation. Here with more, we've got Yahoo Finance's own Jen Schonberger. Jen, what can you tell us about this?
Yeah, hey there, Brad. Bitcoin and the overall cryptocurrency complex rebounding this morning off the lowest levels since last summer, just as the Biden administration is prepared to release a brand new government-wide strategy to regulate cryptocurrencies. A Biden administration official tells me they will release a National Security Council memorandum as soon as early February that will task federal agencies with assessing the risks and opportunities that crypto poses. It will delve into the details of a central bank digital currency, the impact of digital assets on financial stability, and normalizing regulations for crypto with other countries. The action, first reported by Bloomberg News, comes as agencies across the government examine new rules for crypto. Last fall, the Biden administration released recommendations proposing that only banks be allowed to issue stablecoins. Jared Seaberg, an analyst at Cowen, called the administration's expected actions, quote, symbolically significant, as the White House would be acknowledging that crypto is becoming economically important and is here to stay. And while crypto may be rebounding today, investors might want to put on their seatbelt. Matthew Howe, the CIO at Bitwise Asset Management, says that the market is pricing in a very bearish executive order. He says this is contributing to volatility in the crypto markets and that volatility will be the name of the game between now and when that order is released. Brad?
Jen, I'll pick it up from here. I feel like volatility is the word of the month. Thanks so much for bringing us that story. Coming up, we're talking about those meme stocks coming back down to earth here. You know those names: GME, AMC, BlackBerry, Nokia, Bed Bath. A bit of a split picture here, but we're going to dive into some of those moves on the back of the sell-off we saw yesterday. Before we go to break, though, step up your investment strategy with a free 14-day trial for Yahoo Finance Plus. Get expert research reports, actionable investment ideas, advanced portfolio tools, and more in an ad-light experience. Check it out today at yahoofinance.com/plus. We'll be right back. Welcome back to Yahoo Finance Live. We are continuing to see some of those small cap names getting hit hard in this session. The Russell 2000 extending its losses after falling nearly 20% yesterday. Let's bring in Yahoo Finance's Inez Ferre, who's watching that for us. And Inez, we keep hearing from guests that increasingly investors are looking at the balance sheets. And a lot of those names in the 2000 we're talking about, not really profitable.
Oh, yeah, that's right. So when we think about the Russell 2000, it's really seen as a sort of a bellwether for the U.S. economy. And Jefferies came out with data in a note this week, noting that 31% of the companies in the Russell 2000 were not profitable as of the end of 2021. When you compare that to the Russell 1000 large cap index, the large cap has 5.7% that are not profitable, Rivian being in that Russell 1000. Meanwhile, in the Russell 2000, you've got companies like AMC, companies like Asana, you've got Macy's in there as well. So companies you've heard of definitely before, but these are smaller companies that are less diversified and that also rely heavily on borrowing. So let's take a look at the chart. When we're looking at the Russell 2000, we're seeing that today it's down more than 2.5%, but this index is down from its November peak more than 17%. When we talk about the Russell 1000, that index is down more than 8% from its record. So really, you can see that investors are punishing more the index with the companies with a larger pool of companies that are not profitable than the index with the lesser pool of companies that are not profitable. Of course, all of this in the face of rising inflation and a tighter monetary policy ahead.
And Inez, while we have you, we've hit an interesting milestone here, or anniversary, if you will, of 1 year out, essentially, from the meteoric rise of some unlikely characters within this broader equity market. And so as we're a year out from some of the retail and the Reddit retail-driven trading activity that we'd seen in names like GME, AMC, BlackBerry even getting into things later on, where do we stand now?
Yeah, I mean, we are looking at these stocks that are well off their highs. And if you take a look at a 2-month chart, I'm pulling up the meme stock chart right here on our Wi-Fi Interactive. You can see that AMC is down 58%, GME down more than 50%. By the way, a year ago, on this day today, this stock was up 145% in intraday trading, and it was trading at around $150 a share. So you can see kind of the immense volatility and the amount of retail traders that really poured into these meme stocks throughout last year. And AMC is at $15 a share right now. It hasn't seen this price since the spring of last year. I will note that I was taking a look at Fidelity by retail orders, and usually we see GME and AMC and one of the top 5 tickers. We're seeing now that those tickers have come down on the list to now number 15, number 16. At the top, you're seeing more of the mega caps. You're seeing more of the FANG names, and you're seeing Tesla in that list as well.
You know, it's amazing to look at some of these names. We even, as I was looking at Robinhood there on the screen as well, down more than 50%. And that was a big name going into their IPO, a question mark of how exactly they would trade given their role in the broader kind of Reddit retail trading frenzy that we had seen early in the year, early in 2021. And so we'll continue to watch these. Excellent breakdown as always. Inez Ferre, Yahoo Finance's own, joining us here to break down all things meme stocks as well as the Russell 2000 a moment ago. Well, we've got much more Yahoo Finance on the other side of this short break, including a look at what to expect from the 2-day FOMC meeting. Of course, that kicks off today, and we're going to break it down on the other side at the top of the 12 p.m. hour. Good almost afternoon, everyone, and welcome back to Yahoo Finance Live. You are joining Brad Smith and Akiko Fujita here on the air with you today, and we're breaking down and monitoring some of these declines on the Dow, the Nasdaq, the S&P 500. Throughout today's session, we've seen red on the screen. We've got just that as we hit the top of the 12 p.m. hour here. Noon Eastern time, and the Dow is down by about 477 points. S&P 500 down 97 points there, and the Nasdaq Composite, you're seeing that lower by about 418 points. We are going to be diving into quite a bit throughout this particular hour. We're checking in, of course, on the midday market action on Wall Street. The Dow, the Nasdaq, and the S&P, we're keeping a close eye on those, down more than 2%, in particular for the S&P 500 and 3% for the Nasdaq Composite. But as we saw yesterday, we could be in for another wild ride as investors wait on the Fed decision tomorrow. We're going to break that down. And the news conference from Federal Reserve Chair Jay Powell, a closer look at what to expect straight ahead. Plus, the road ahead for the trucking industry, from soaring consumer demand to port bottlenecks and a driver shortage. The new report from Uber Freight highlights what's needed to get drivers back on the road. And plus, the hot trend of athletes getting paid in crypto. It's costing some players big chunks thanks to this sell-off that we had seen. However, Bitcoin higher on the day, but Odell Beckham Jr.'s $750,000 contract, that's now valued at around $400,000. And after taxes, yeah, we'll hit you with the figure that it actually comes closer in towards later on in this hour. But as we mentioned, to kick things off with the Fed and that two-day policy meeting that begins today, I want to bring in Yahoo Finance's own Brian Chung. Brian, great to have you here with us. Help us set the scene for what the Fed is going to be walking into with their meeting and perhaps coming out on the other side with some type of decision.
Absolutely, Brad. So the two-day FOMC meeting just kicked off today. They'll be releasing the policy statement tomorrow at 2 p.m. So we'll have to wait a little bit longer before we see exactly what the Fed wants to message with regards to tightening its easy money policies that it's had in place since the depths of the pandemic. A lot of people wondering, are we going to get 3 or 4 or 5 interest rate hikes over the course of this year? But keep in mind, we're not expected to get any sort of policy change effective tomorrow. That's because the Fed more likely will tee up the first interest rate hike post-COVID for their March meeting. So instead, the focus tomorrow is going to be on the Federal Reserve's $9 trillion balance sheet. Keep in mind, the Fed is still in the process of expanding that balance sheet through treasuries and agency mortgage-backed securities purchases. Now, that program is set to stop in mid-March, and after that is when the Fed has said it would be fair game for them to start raising interest rates. The reason why is because they don't think it would send a very kind of streamlined or consistent message to be expanding its balance sheet at the same time that they're tightening policy. So they want to stop that process first and then start the process of raising interest rates. Now, of course, that's not commentary that we're going to get from the FOMC statement that's released at 2 p.m. tomorrow. Instead, that will likely be commentary that we have to listen for from the Fed Chairman Jay Powell's press conference. That'll be happening at 2:30 tomorrow afternoon. So as Kanye West once said on Bound 2, what would Jerome think? We're going to have to wait until tomorrow afternoon to find out.
All right, Jerome, he's gonna have to come correct tomorrow for sure. Yeah, no, it had to be done. It had to be done, Brian. Appreciate it. That's Yahoo Finance's own Brian Chung with the breakdown on the Fed and their two-day FOMC meeting. All right, guys, switching gears here and continuing to look at the markets. Stocks, they mounted a stunning comeback on Monday with the Dow closing in the green after being down 1,000 points in the session, actually, when we were on air yesterday. And so to join us now and help us break this down a little bit further, we've got Young-Yu Ma, who is the BMO Wealth Management U.S. Chief Investment Strategist. Great to have you here with us today. Let's just make sense of the volatility we saw yesterday and even some of the declines that we're continuing to see today in spite of the slight close higher that we were barely able to squeak out at the end of Monday's session.
Yeah, sure, Brad. Thanks for having me. Yesterday was really more of a snapback relief rally after a lot of pessimism and a lot of declines in the market. Nothing really fundamentally changed yesterday. I think the market's really just waiting for, as Brian said, to see what the Federal Reserve does, FOMC, to see what Jay Powell messages at the press conference. That's going to be the next big important news event that comes out. Of course, there's data that's trickling out. We had consumer confidence, which held in reasonably well today, but really nothing fundamentally has changed, and the headwinds that created this downturn are still in existence, and we have to wait to see how these resolve.
How do you explain the moves that we saw yesterday, though? I mean, we were talking at this hour yesterday, 24 hours ago, the Dow down about 1,000 points. And, you know, we got back to the end of the day. I had to do a double take here. I mean, was this about investors getting in to buy the dip, seeing the opportunity, or was it something more?
I wouldn't read too much into it. I think it was more of a snapback relief rally. There was a lot of wholesale selling that was taking place, maybe even some margin calls. And I think it was just time for the market to snap back. And as we see today, that's not really holding up so well. So I wouldn't read too much into 1 day or 2 days action. It's really, are the fundamental headwinds and fundamental drivers of the market, are they shifting, and how are they shifting? And we have to wait for a little more clarity before we see that.
And so what type of reaction, as we know the markets latch on to whatever the Fed says and even signals for some of their future policy decisions, what do you believe the Fed could say to perhaps quell some of the concerns that have even driven this move lower that we've watched?
Well, it's going to be tough. I think one big thing that the market will want to hear is that the Fed remains data dependent. If Chairman Powell can really emphasize that, I think the markets will take some comfort that if there is some slowing in the economy, that the Fed will ease off the brakes a bit. I think that would be one big aspect. And the other big aspect relates to the decrease in the Fed's balance sheet. I think the market really wants to see the Fed taking a gradual approach, perhaps putting that off toward the end of this year, or maybe even signaling a willingness to wait until early next year to start reducing the size of its balance sheet. The market would take some comfort in that, I think, as well. On the contrary, if the Fed signals that it's going to reduce the size of its balance sheet much earlier, say starting in the summer, I think that could again be problematic for the market. So that's a big point that the market, I think, is hanging on right now.
So how do you think investors should be looking at their portfolio? I mean, a lot of people are counting their losses now, especially so far this year. We were talking about the small caps earlier, saying that a lot of these companies who are not profitable are getting hit hard. What are some areas that you think provide really good opportunity in a volatile market?
I think value in general is probably something that's going to outperform for quite a while still. As you mentioned, the unprofitable companies are going to be the ones that are getting punished more. So if you look at the low PE multiples, stable companies that fit that value profile, those are probably the ones that are going to get more attention until we see more clarity in terms of the interest rate path, in terms of the trajectory of the economy. Value is probably going to be a place, although it's underperformed for quite some time, many years now, probably going to be a place that garners more and more attention in the coming quarters.
Young-Yu Ma, who is the BMO Wealth Management U.S. Chief Investment Strategist, joining us today with the breakdown. We know you're going to be watching whatever is to come from the Fed's announcement tomorrow, plus the press conference. We'll have to check back in the future to see if they've delivered on some of the expectations that you're looking out for as well. We appreciate the time here today. We've been tracking tech stocks very closely. They rallied back from the brink as investors. They bought into the dip that we saw yesterday. And we're going to bring in Ted Mortensen here, who is the Baird technology strategist. Ted, help us kind of dive into whether it was a dip or whether it's a discount that some of the investors were latching onto, and if this is the end of that dip.
Well, first of all, thanks for having me. I think it was really a pretty big of a bear market head fake. In any cycle, and I've been doing technology for over 30 years, and I've seen one of the more senior guys on the street that have actually seen a fair amount of cycles. Where we are in technology, in any cycle, you've got euphoria, complacency, a phase of concern, a phase of fear, and a phase of panic and capitulation. Right now, where we are in the market from an institutional standpoint is a lot of PMs have been pretty much hurt specifically on software. And I would say we're kind of in that fear and panic area. And until we get capitulation, we won't see a bottom of the market.
So when do we get to capitulation?
That's a great question. I wish I had the clear crystal ball, but I think one of the things that the institutional investors are looking at is, from a technical standpoint, there's been a fair amount of damage. And a lot of people are looking at one-year charts, but they should be looking at five-year charts. And where the institutional parties are looking at is where we have actually some very, very good support. Listen, the tech macros are very, very powerful. They haven't changed one iota. I think people are just looking for a reasonable entry point from a risk reward standpoint.
And so where are some of the best opportunities in tech right now? I mean, across the cloud, I've been tracking Salesforce coming into this year. That didn't seem like a safe place. We've been tracking Nvidia. Some of the semis didn't necessarily seem like a safe place. So where within technology specifically would you be looking at?
Well, right now, the IGV, or the cloud index, specifically dominated by a lot of high valuation software names. These names have actually been taken out to the woodshed. I've got some software names down anywhere from 25 to 35% this month. So these multiples have contracted almost 40%. And there are some very, very attractive buys in the software area. And I think what's interesting is, from a historical standpoint, that 30% growth cohort, people are looking at like a 10 times EV to revenue multiple. We're getting very close to that. The 20% cohort with free cash flow is where I'm starting to see a lot of institutional interest, is in that 7 to 9 times EV to revs rate. And we're really getting pretty close to that area. So from a software perspective, we've retraced a lot from the top. Unfortunately, from a semiconductor standpoint, the stocks, if you look at the stocks, in the last 2 years, we've been up 94%. So I would say there's more downside from some of the checks that we are doing on lead times and Chinese consumer weakness and inventory builds, where we probably have a little bit more downside in the stocks than we do in software.
In terms of bets on emerging technology, you've highlighted, your case on the metaverse, VR, AR remains intact. How much of that is about the software play? How much of it is about the hardware and the headsets? And if that's the case, in terms of the latter, is it about the big players like Meta with Oculus, and then Apple in the anticipation of that release this year?
It's a great question, and it is really becoming a big boys game. And the reason why is that, from a silicon perspective, all these chips that are really focused on AI acceleration and cloud acceleration are really done at the next generation nodes. This is, without getting too technical, this is at the 7, 5, and 3 nanometer node. The capital intensity at that level is massive as it relates to a tape out of a chip. So the people with, I would say, huge balance sheets and very, very high R&D, like a Nvidia or a Qualcomm or an Apple or an AMD. Those are the companies very, very well positioned. From a software perspective, it's really an open field on designing into that cloud and that metaverse area. So it's less defined, but quite frankly, the software add-ons could be a myriad of new software companies that are emerging. But one thing is in common, they all have an AI component or a machine learning component or a visual AI component.
Ted, just while we have you, would love to get your outlook, especially on the streaming sector, as we had heard from Netflix already with some of their projections for the future and their earnings, quite frankly, kind of laying out a grim scene, if you will, for the broader content space as it relates to streaming. Is that something that you believe this is going to be an impact for some of the other players that are out there as well that have yet to release their earnings results? And how would you be playing the streaming space right now?
Well, Netflix's quarter was a tough one to take. I think they were a little bit in denial that their core acquisition growth was decreasing a little bit. And also, I think you have to look what's going on internationally. They had some problems in Latin America as well as India. And I think it's just a game of saturation at this point. It's the best company in the group. They've got a fantastic engine as it relates to content. It is getting more crowded as it relates to the amount of content coming on. But Netflix is by far, I would say, the cream of the crop in the group. And from an institutional standpoint, with the amount the stock has been down, the GARPy, I would say GARPy growth guys are definitely kicking the tires on Netflix. The other name that people continue to look at, from an infrastructure standpoint, is Akamai, not only because of their security business, which is growing in excess of 20%, but they do play into that streaming content macro.
Ted, we're going to have you back on the show again soon as we continue to watch some of these tech earnings. Ted Mortensen, Baird, a technology strategist, joining us today. Well, coming up, we are watching the chip space as we see some of those semi names get hit hard, dragged down by the broader declines we're seeing in the market. Nvidia quietly putting that ARM deal to rest. What it means for the company's outlook, that discussion is up ahead after this break. Well, shares of Nvidia are down about 5% in the session on a day when we've seen tech names down broadly here. This coming on the back of a Bloomberg report that the chipmaker has reportedly made plans to quietly walk away from that $40 billion deal to acquire ARM. Let's bring in Yahoo Finance's Dan Hellie. And Dan, I can't say that, most analysts would say they're probably not surprised. This was largely not expected to go through because of the regulatory hurdles that they've faced. What does it mean in terms of the broader outlook for the company?
Yeah, wild. Really, this deal, this $40 billion deal for ARM, has kind of been dead for a while. Now we're getting this report from Bloomberg saying that, Nvidia is just kind of going to scuttle it. And they're going to go their separate ways. I think, the big thing here is that if the deal had gone through, it would have completely blown up the balance of power in the chip industry. Nvidia said they would have kept ARM, which is basically kind of a Switzerland of the chip industry. They make designs for chips, and then companies ranging from Apple to Google to Qualcomm end up using those designs, Nvidia, one of them as well, to build out their own chips. So that's where you get Apple's M1 processor or the new chips from Google or Qualcomm Snapdragon chips. They're all ARM-based chips. Nvidia's as well, to some degree when it comes to their older CPUs. But as far as Nvidia goes itself, without this kind of deal, yes, they would have had intimate access to ARM's inner workings and a better understanding of how they could build out their own CPUs. But it really doesn't hurt Nvidia that much as far as the business itself goes. This doesn't mean that they're not going to have access to any CPUs. They framed it as being able to build up ARM's ability to push forward in the development of processors and chip designs. But for Nvidia itself, this is not really a blow necessarily. I think this was something that was kind of built into the price of the stock, the idea that this was not going to go through. You saw that the FTC had sued back in December to block the deal. And at that point, Nvidia shares had gone up slightly. So it really isn't necessarily a detriment. I think more or less what we're just going to see here is, according to the article at least, is ARM trying to go public on its own, which is surprising that it hasn't done to this point, just because of how powerful it is. And SoftBank, obviously, the owner of ARM. So, overall, Nvidia is still going to be riding high on AI, on graphics processors, on the ability to help kind of form the metaverse. Their kind of take on the metaverse, by the way, slightly different than what we're seeing from the likes of Meta. They're using it kind of as a utilitarian method to do things like train AIs for self-driving cars or help industries set up things like where to lay out cell towers. So really kind of a smarter way, an industrious way of using the metaverse. So they have plenty of runway out in front of them. And look, graphics cards need to be upgraded regularly because they start to get a little slower and slower every year. So it's not like they're not going to have customers from the consumer side and the industry side going to them constantly.
Dan, while we have you, from the metaverse to the microverse, if you will, and Microsoft, I don't know if it works totally. We'll workshop it a little bit there. But
we'll give it to
ultimately, this company is set to report earnings after the bell today. Walk us through some of the expectations.
That's right. This is Microsoft's first earnings since they announced their blockbuster deal to purchase Activision Blizzard. And for the company's quarter, this is their Q2, by the way, of their fiscal 2022. So don't get confused when you start seeing those headlines roll across. But revenue we're expected to see for the quarter is $50.9 billion. That's versus the $43.1 billion they had in Q2 2021. Earnings per share expected to come in at $2.31 versus $2.03. And what we always like to look at is their intelligent cloud and their productivity and business processes. That's where their cloud kind of offerings lie. Their subscription services for Microsoft 365 as well as Azure. For intelligent cloud, we're expecting $18.3 billion on the quarter versus $14.6 billion. So that would be a nice bump if they hit that. And then for productivity and business processes, it would be $15.9 billion versus $13.4 billion in the prior year. And as I said, this is their first call since they made that announcement that they're going to acquire Activision Blizzard. That still has to go through some regulatory hurdles. We're not sure if it'll definitely go through just because of the atmosphere that we've seen coming out of Washington with regards to big tech. But, out of all the companies, Microsoft has managed to keep its nose clean, especially since that 2000 antitrust suit. So we'll see if that has any impact on this deal going forward. And hopefully we get some commentary from Satya Nadella.
Yeah, the report after the bell could be a major barometer for setting up some of the other earnings reports to come from cloud players later on this earnings season as well. Yahoo Finance's own Dan Howley joining us today and this afternoon. Thanks so much, Dan, for the breakdown there. And everyone, coming up after this short break, long-haul truck drivers are in high demand as the freight industry sees accelerated shipping demand. Find out how Uber Freight is managing through the supply chain bottlenecks when we return. Welcome back to Yahoo Finance Live, everyone. Freight trucking is seeing higher demand for services prompted by growth in online shopping, but a shortage of truck operators in particular has the industry exploring all options in the search for new drivers. Uber Freight co-founder Bill Drieger joins us now. Bill, great to have you here with us on the show today. Uber Freight just published a recent analysis and report on the freight trucking industry. Would love to get your major takeaways and the key highlight from that report.
Yeah, as you touched on, so this morning we published our market insights report for the second half of 2021. This report brings together our own in-network data as well as broader macro trends to examine what happened in the second half of 2021. Some of the key themes were this ongoing driver shortage, as you mentioned, as well as a shift in trucking employment. We've actually seen a surge of new trucking companies entering the market. Also, we touched on the ongoing surge in consumer spending, which is driving elevated rates in the trucking market. And so this report is really for our carriers and our shippers to inform them and to give them some insight into what's going to happen in 2022. At a high level, the first theme is we are seeing this rising consumer demand that is driving an ongoing shortage in terms of capacity. What we saw through the pandemic is over $2.5 trillion in excess consumer spending, and all of that excess money has been funneling into retail spending. Personal consumption expenditures hit a record annualized run rate of $16 trillion in August and kept rising through 2021. We also saw record retail sales holding at 20% above pre-COVID levels, which set an all-time high in October of $565 billion. And of course, that drove port congestion, and we've also seen, as a result of all of that consumption, particularly in electronics, this ongoing chip shortage, which directly hit trucking because it's resulted in a 19-month delay in new truck orders.
I mean, a 19-month delay is pretty significant, Bill. When you look at the study there, the good news is that the demand is there. The bad news is you don't necessarily have, not you, but the trucking industry doesn't have the labor supply, especially with long distance hauls. What are you seeing on that front, number one? And number two, what kind of business opportunities does that open up for Uber Freight?
Yeah, correct. So long distance trucking, which represents over 34% of trucking employment, is down 3% since pre-COVID. Drivers are also working longer than they ever have before. So the average week for a driver is now 44 hours compared to 41 pre-COVID. And ultimately, what we're seeing is drivers prefer to stay closer to home. So those local delivery and warehousing jobs that have exploded because of e-commerce are very attractive for drivers. We are very excited to see on the other side, the DOT and the DOL enact legislation to open the door for apprenticeship programs for younger drivers starting as young as 18. That won't directly benefit us at Uber Freight because we work directly with the carriers, but it will drive relief for those carriers that we work with, and more capacity in the market, of course, is beneficial to the total ecosystem. What we are seeing, though, is a huge surge in new carrier registrations. This is probably the best market ever for an entrepreneurial driver to enter and have success. And us at Uber Freight, it's been a focus for us. We've definitely laid the groundwork for that entry. But what we're seeing is an 85% increase in new authorities year over year from 2021 to 2020. And 2020 was already a record year. That translates into 110,000 new drivers entering the market. And they're entering the market because they see an opportunity for higher income. And these are typically drivers that are coming from big carriers. So drivers typically enter the market with the big carriers, they get some experience under their belt, and then they see this opportunity to go out on their own, to start a carrier, to make more money. And this is the best market ever to do that. And companies such as ourselves are really opening the door for them to do that because they can come in the market, they can immediately plug in to a product like Uber Freight and see the benefit and have access to freight and start their business.
Certainly. And Bill, help us quantify the number of drivers that would be necessary in order to kind of fill the gap here between the demand in the industry and being able to meet that demand with the service supply that's necessary.
Yeah, so we're talking hundreds of thousands of potential drivers needed in the market to fill that gap. So today there's over 3.5 million drivers in the trucking industry. It's one of the largest employment sectors nationally. That translates to about 1.5 million registered carriers, but that's across all sectors, including things like dump trucks and other commercial sectors. Within the freight trucking industry itself, though, you're talking it's hundreds of thousands of drivers driving this gap.
And Bill, you mentioned the record number of registrations you're seeing among new carriers. I imagine the incentives are pretty hefty, just given the demand that's in the sector. What kind of wage growth have you seen?
Yeah, that's so I talked to a carrier the other day who said that 75% of their drivers are now over $75,000 a year. That was a key metric that he shared. And we're seeing drivers and offers coming in at over $100,000 for new drivers. So it's a fairly significant increase because you see rates have increased over 30, 40, 50% since we started the pandemic. And that, of course, is then driving higher wage opportunities. And for us, that translates to new authorities because what's happening is those carriers are not raising their wages as fast as the market is moving. And so, of course, drivers are seeing that opportunity to enter and start their own business. And again, this market is just ripe for entrepreneurial opportunity for new drivers and to enter as carriers.
What's the take rate for Uber Freight at this point, even as you're seeing some of the new drivers enter in?
So as an intermediary, it varies by market conditions. So we commit to a rate with big shippers, and then we purchased in the open market with our carrier base. So over 70% of our carriers are these new owner operators. And when they enter the market, they don't have a lot of opportunity. And this is one thing that's been a priority for us since we started, was providing transparent upfront rates so that those owner operators can make better decisions. So an owner operator comes into the market, they can download our application, they can see a rate, they can cross-shop that with other providers, but they now have information, they have power to make better decisions, which creates a more sustainable market. Because not even 8 years ago, if they wanted to find a rate, they had to pick up the phone and start making phone calls. And that's not how the market operates today, because us and others have really opened it up. And so as a result, drivers have a lot more kind of leverage in that interaction than they did 5, 6, 10 years ago. And that, I think, has also laid the groundwork for the surge in new authorities entering the market. And so ultimately, we provide them access to freight with large shippers, the largest shippers in the US and North America, that otherwise they wouldn't have access to. And so our take rate is the difference between what we ultimately get from the shippers and what we pay the carriers, but it really varies in the market. And in these times with tight capacity, carriers have a lot more leverage, right? Because ultimately there's a shortage of capacity. And so shippers are willing to pay for that because shippers need to move their goods.
Bill, everything you're telling us here is that there are improvements in place, there's tools in place, but it's not moving along quickly enough to address the shortage that exists in truckers right now. So if we're already talking about significant delays, how much worse is that likely to get if this demand keeps up?
It's there is relief. So we are seeing drivers return to the market and carriers return to the market. In fact, driver employment has been rising steadily since we saw the low kind of right after in early 2020, kind of post the initial surge. So it's hard to predict the future in terms of what's going to happen across this year. We still are in a very tight capacity situation, but we are expecting that we should start to see some relief. This, sustained rates ultimately do drive more interest in the market. And of course, where the DOT and the DOL are making some great policy choices and decisions and prioritizing how they approach and relieve some of the supply chain pressure. I mentioned that the apprenticeship program, but they are looking at just bringing more pools and more of labor and more capacity into the market and ways of driving outreach, speeding up the onboarding process in terms of registering and getting your CDL, and programs like the apprenticeship program, which open up the driver population by moving that driver age, the eligible age, lower. And so I think those sorts of moves will accelerate relief. Ultimately, the market will bring new drivers in as wages. The high rates are driving high wages, which will drive new talent to the market. But you also historically have just a constraint to get a CDL. It takes 160 hours of training to get a CDL. It's expensive. It's thousands of dollars of investment for an individual driver. Large carriers make those investments, but as an individual, it's hard to make that choice when you have other job opportunities for which you can just walk in and start working. And so to make those policy shifts will also open up the door for more drivers to enter the market.
Well, Bill, we hope to have you back on the show again soon with an update, hopefully with some progress there. Bill Driegert, Uber Freight co-founder, good to have you on today. Well, coming up, a big jolt in the EV space with General Motors shelling out nearly $7 billion to double down on EV batteries. We are diving into the car maker's largest investment in history after the break. General Motors is taking aim at Tesla, announcing a roughly $7 billion investment in EV battery manufacturing in a larger effort to dethrone the top EV maker. That $7 billion number, by the way, the largest investment for the company. Let's bring in Yahoo Finance's Rick Newman, who's following this story. It's clear that GM has these grand ambitions for EV makers. How significant is this announcement today to help them get to that ultimate goal of zero ICE cars?
It's a big deal, Akiko. So as you mentioned, GM says this is the largest single investment they've ever made, nearly $7 billion to build a new battery factory and expand some other production facilities where they will make electric pickups and electric SUVs in Michigan. All the automakers are doing this, and this is the biggest transformation going on in transformation in probably a century. And just about every automaker is putting down this kind of money to catch up to Tesla on EVs. Tesla right now is selling about 930,000 electric vehicles a year. That's a major ramp up for them. GM says it wants to be producing 1 million EVs by 2025, obviously just a couple of years away. That would be a big ramp up for GM. And of course, they say that by 2030 to 2035, they want to be producing only electric vehicles with no gasoline model. So everybody is going in the same direction, and it's quite a race.
4,000 jobs is what GM says they will create as a result of this announcement today. But their first rollout on EVs, specifically the Volt, wasn't exactly a smooth one, with issues with the battery as well as the fires. I know the company has said that this is not the same battery technology they're relying on for the future, but how much damage control have they been able to do? How much have they kind of been able to rebuild trust?
Yeah, so you're talking about the Chevy Bolt with a B that came after the Chevy Volt with a V. And the Bolt has basically been in suspension. Chevrolet has not been selling any of those because of this battery problem. The batteries catch fire. It's a defective battery. So GM is trying to fix all the Bolt batteries that are in people's garages and get that technology straightened out. That in itself is a setback for General Motors. But I also think it's important to point out it's early days for EVs. Tesla had a lot of problems with manufacturing quality. They got that ironed out. And I think that problem GM is having with the Bolt batteries, better to have it now at the very, very beginning of the electrification revolution and learn from whatever went wrong and then incorporate those learnings into future technology. We are going to see GM coming out with a new electric vehicle in just a couple of months. That's going to be the Cadillac Lyriq. That is an SUV that's supposed to be go into production around March. And then we're going to see more EVs coming online. The big Hummer, that's going to be a big introduction for GM. And hopefully for GM, they learned what they needed to learn from the disaster with the Bolt fires, and that's not going to be a problem in the future.
Yeah, any type of battery issue with a Hummer, much larger scale, of course, at that point. Right. Rick, where does that put us on the roadmap, the timeline to when the batteries can, from the consumer perspective, be beyond this type of concern, even if you will, prior to making a purchase, either on the mass market end of the spectrum with this broader automotive ambitions that we've seen from multiple companies and across the market? Where does that put us within this roadmap?
Well, electric vehicle sales are still less than 5% of all new vehicle sales. And most people have the same concern, which you can charge these at home and you can install the charging to get all the power that you need at home. The problem is when you hit the road, there are not electric vehicle charging stations everywhere they need to be. Now, we are in the process of building up this infrastructure, but it's just going to take time. And there are whole stretches of the Midwest that don't have any electric vehicle chargers. So if you want to make a long trip in an electric vehicle, it's still not nearly as simple as finding a gas station, which you can find at just about every highway exit. This is going to change over time. I mean, this revolution is clearly underway. Everybody in this industry thinks this is the future, which means they're all putting money into it. And it's going to be transformative. It's just going to take a while.
Yahoo Finance's Rick Newman. Thanks so much for breaking this down, this news around GM and the broader space as well for the automotive industry moving swiftly towards those EV ambitions here. We're also continuing to keep a close eye on the markets today as the Dow is down right now by about 400 points. We'll round that off to 1.1% in negative territory. The S&P 500, you're seeing that down by about 87 points. And then the Nasdaq Composite, you're seeing that lower by about 2.9%, just about 400 points in decline there on the day for the tech heavy average. And on the other side of this short break, tracking the market volatility, we check in with Jared, who's got the key levels during today's session after the break. Major averages in the red just around lunchtime here, everyone, as you're keeping an eye on the major averages, as to are we. The Dow, the Nasdaq, and the S&P 500, they are all in negative territory as of right now. And this is as this market volatility that we've been tracking over the past 2 days, it has persisted despite yesterday's close in positive territory. And with more on this, we want to bring in Yahoo Finance's Jared Blickery, who's standing by. And Jared, perhaps we start with the activity we saw towards the end of yesterday's session and whether or not that was actually tech trying to set in a bottom, yet seeing more declines here on the day.
Well, I'm not going to sugarcoat this, Brad. It was a short covering rally, but guess what? All major rallies begin with a little bit of short covering. But yesterday's was so fast and furious, it really stands out in history, publishing an article about this in about an hour. So I went back. First of all, let me just show the price action that we're seeing today, because things looked a little bit rosier yesterday. We had that big green hammer candle on the Dow, also the S&P 500, but pretty much selling off today, and we're seeing the same kind of illiquid situation that we have been over the past few sessions. Here's the Nasdaq Composite, looks fairly similar, and the S&P 500. Now, let me show you what I tweeted last night, and this is what I'm writing about today. I went through the big reversal days in the Dow going back to 1929 because I have data going all the way back then. Nasdaq only goes back about 50 years. What I found was big reversals days in stocks, they can signal a bottom or simply another leg down in the weighting. The difference, very limited sample size, seems to be how much the market was down just prior to the reversal. This time the drawdown was very small. So time for the Powell Magic Show Wednesday. But that was before today's price action, which is pouring a little bit of cold water onto our hopes. So these are the big reversal days going back to 1929. There are 13 of them, and there was a really quick one that actually worked out for a nice bounce here. That was in March of 1929. But as we know, the liquidity spigots were on back then, not because of Powell, but because of some other Fed chairs. And then in November of 1929, the market was down 39%. We had a big reversal day like we did yesterday, but guess what? The market went down another 83%, would not reach another record high for 6,256 days in 1954. I just want to point out that the results are very varied right now, and so it's hard to draw too many conclusions from this. It is nice that we weren't down too much yesterday, but at this point, I think it's fair game to say that anything can happen. So just taking a look at the Nasdaq 100, this is where we're sitting for the day, but I just want to put on a heat map that shows where we are from the beginning of the year, and we're seeing some substantial drawdown still. Nvidia off 25%, Apple, the least bad off of the mega caps, that's still down 11%, going to get their earnings on Thursday. And then Microsoft, earnings after the bell, that's down 14%. So got to kind of play wait and see mode, I think, until at least we get that Powell presser tomorrow at 2:30.
We'll all be watching closely. Jared, thanks so much for that. Coming up, Bitcoin and Ether bouncing back today, but the pain from that crypto sell-off reverberating across professional sports. We're talking about one athlete, yes, Odell Beckham Jr., and his losses on the other side. We'll be right back. NFL star Odell Beckham Jr. may be celebrating a big win that sent his LA Rams into the NFC Championship, but that was followed by a big loss, a big sell-off in the crypto markets. hitting him hard with his salary. Brad, I'm going to let you do the math. It is painful just looking at the number.
It really is. And I mean, it's just remarkable here because when he went to the Rams, of course, that contract and that move took place in November of 2021, November 11th, the timing that it was basically announced. And when we saw a plethora of some high-profile talent actually making their way to the Rams, and Odell stepping out front and saying, you know what, I am a believer in Bitcoin. I'm going to accept my earnings in crypto. And ultimately, it's unfortunate that that was the peak, essentially, that we had seen during that month. At one point, it had hit 67,000 in that month. And there you're seeing what's taken place since the announcement. So November of 2021, at the time of the announcement, $64,000 is where Bitcoin was sitting at. Now, currently, $36,858. And so that gives you a sense of the devaluation, if you will, on that headline figure for the contract. But again, Odell probably doing quite well. This is a man that's amassed millions in earnings over the years. And I'm just happy that he's in a warm weather city for his personality. He certainly does deserve to be in LA with some of the other stars out there, Akiko. Yourself included.
I'm sure he's going to be just fine. There's a lot of other people who are reeling from the sell-off, but I want to point to these numbers that was put out by the Action Network. Darren Ravel there breaking down the numbers for us in terms of the losses. You pointed to where Bitcoin was trading the day he said he was going to take some of his salary in Bitcoin. So 64,293 to 35,400. But on top of that, he's going to be taxed on that $750,000. He's in California. We're talking about 50%. So that means, according to the Action Network, his net gain here is $35,703. Not a whole lot when you started with 750,000.
No, not at all. And especially even if Bitcoin had stayed at the same price on that $750,000 contract there, then he would have essentially taken home somewhere, rough figures around 11.7 Bitcoin. But at these prices now, I mean, we still continue to think about the number of other athletes that are thinking about accepting their contracts or their own types of payments in cryptocurrency in the future. And there have been some very smart financial transactions that we've seen in the past and money habits from athletes. We were talking about Rob Gronkowski just yesterday as well in our own meetings, thinking about how he sets aside all of his earnings. And you wonder if some of those athletes who had decided to set aside some of their earnings and taking it in crypto, but still taking some of their other endorsements in US dollar or whatever their main currency is, what that would yield for them over time. But again, right now, this is just a tough decline for crypto, especially as it relates to Odell Beckham Jr.'s potential earnings. And we'll see how long he holds on to that crypto. He probably has a little bit higher of a propensity for risk in his portfolio than most of us.
Yeah, something tells me he has a bit of a buffer. But you're right. I mean, we're talking about Odell Beckham today, but there's a lot of not just athletes, but officials who've talked about taking some of their salary in Bitcoin too. And any investment, any money with Bitcoin in crypto, volatility follows. And that's kind of been the big question in this space, is that with more institutional money moving in, would that sort of ease the choppy waters, if you will? Certainly not the case if you look at where the trading activity has been over the last several days, but can't say the same for equities too, because we saw that big swing yesterday. A story to be continued, but that does it for Brad and I in these 2 hours. Much more to come here on Yahoo Finance Live. Keep it right here.
Marquise Francis. Welcome to A Time for Change. I'm Marquise Francis, here with Alexis Christophorus. There's a new business model in the magazine publishing world. After 58 years, Sports Illustrated Swimsuit Edition announced that it will accept advertising only from companies with a proven commitment to gender equality. We're here from the editor-in-chief in just a moment, but first, let's take a look and quick listen to how Sports Illustrated is positioning this new program called Pay with Change.
Introducing Pay with Change. We're turning our ad space into a place that creates change for women, and all brands making progress can buy in. Because if we're not moving women forward, we're holding them back. Our goal? Change the cost of doing business from a dollar amount to the currency of doing good.
Well, I had the chance to speak with editor-in-chief MJ Day recently about why the magazine is making this change and what it stands to gain and perhaps lose.
So Pay with Change is our new advertising mandate. And that means we will only be allowing brands who help drive gender equity forward to be featured in the magazine's annual print issue, as well as across our entire digital platform. So it's a very exciting moment in time for us because I feel like it really brings the Sports Illustrated brand messaging ethos, into a 360 purview, because we've been perpetuating and really like celebrating the ideology of being using our power for good across all of our editorial platforms, and now really the entire brand, the threads throughout the entire thing, we're going to be encouraging people to think that way about themselves, about what they can do for, women empowerment, what they can do and put out there into the universe, to be better, and to do better. So we're really, really excited.
But, advertising goes right to the bottom line of the publication. And I'm curious what Sports Illustrated Swimsuit stands to risk or stands to possibly lose with this new mandate.
Yeah, I mean, listen, we're excited today to announce the launch of it. We don't know what that means and how this will translate. We do believe that this will be a revolutionary kind of industry change and shift. And, any progress is good progress when you're speaking around, women empowerment. And I think that it will take time, and we're not afraid of that. And we're committed to that. And I think the end game, we're all winning,
So MJ, talk to me a little bit about the standards you're using to calculate whether a brand is, driving gender equality forward, as you put it, and how do you plan to keep these brands and these companies accountable?
They have to prove that they are moving the conversation forward for gender equity. And that either can mean that it's a well-established program that's in place, or that can mean that they are creating and providing opportunities, starting today. We know that these types of things take time, and we know that progress isn't perfect. And we know that, sometimes we just need to take the leap and make a change and decide to make a change. And so that's what we're supporting now. And I think it's an evolution within itself. I think a lot of people are going to bring ideas to us about what that means. And so it's one of encouragement and support and effort. And what we want to see is proof of that progress.
Now, I know the Sports Illustrated Swimsuit Edition is out in May, so you have a few months to go. I'm not sure if you already have advertisers locked in and if they've been made aware of this initiative yet, but do you anticipate, or have you gotten any pushback at all from advertisers? And sort of on the flip side of that, have you gotten some new unexpected advertisers out of this?
I say with great excitement that the response has been overwhelming. People are really excited about this initiative. It's only been positive, and I'm proud of the type of partners that we're attracting, because you see the like-mindedness in this effort, and it's thrilling, because I think the world and the industry has sort of been waiting for this moment, and I'm excited to be able to host it here.
MJ, I'm sure, I'm not telling you anything new. You've seen the critics over the years. You've been with Sports Illustrated Swimsuit, by the way, for pretty much your entire career and worked your way up to editor-in-chief. So there are the critics out there who see the swimsuit edition as exploiting women and their bodies. What would you say to those who call this pay with change initiative ironic or maybe even hypocritical?
I would tell them that they haven't been paying attention. And I would tell them that since the inception of really the Sports Illustrated swimsuit issue, we've been doing more than almost any other, brand out there in terms of elevating women's platforms and giving them opportunities to be more than just, a ... swimsuit model. It has been at the forefront of everything that we have been doing since my tenure at the helm of the brand. It's purposeful change. It is authentic and heartfelt change. And I would tell them that not to judge a book necessarily by its cover and apply that to how you feel about women in general, because you cannot make assumptions, in the first glance of something. And this is what we're battling against too with this. We want to allow women and brands to be seen holistically and not just instantly categorized because of the first experience you've had with them.
Well, I think you have a unique perspective, being in the role as editor-in-chief of Sports Illustrated Swimsuit since 2014, but you've been with the brand since 1998. So talk to us a little bit about how you've seen the narrative change around diversity and inclusivity at the publication.
When I came to be the editor in charge of the brand, that was my only initiative, was to have that conversation here and to pursue that. As a woman, as a at the time, as a 30-something-year-old woman who was never really anything smaller than a size 12, I knew what we as women kind of were subject to by not having representation, around us in mainstream media. And I also knew that the ideals of beauty were very, very subjective. And so for me specifically, I felt it was a great responsibility possessing the power that this brand does to be as inclusive and as representative as we could be. I do have a very unique perspective, and it is very much a personal passion of mine. And I do think we can take this over into the publishing side of things as well, and make a great deal of change there, because, the more good we can do with this power and the more brands we can encourage to do the same, the better this industry and this landscape will be, not just for business, but just for everyone. So
I know that last summer you had that pioneering photo shoot with trans model Lena Bloom. What was public response to that, viewership response to that, and also advertising response to that?
I mean, I think universally the world stood up and just, gave Lena and our brand a long, slow clap, because it's long overdue. That recognition and inclusion of that nature is, has been celebrated, and we've had nothing but support for Lena, for that beautiful cover, for that conversation. And, Lena and Valentina Sampaio, very much a part of this brand and this family. And I'm so happy with the reaction and the support that, has been shown to us and them.
Tell us briefly what this Gender Equity Fund at Sports Illustrated Swimsuit is about. What types of organizations stand to benefit from it?
So the SI Swimsuit will create the Gender Equity Fund, and that's where a percentage of the total 2022 ad dollars will go towards funding women's equity and advancement. And essentially, we're putting our money where our mouth is, and we'll be working with multiple brands that support and promote progress for women.
And finally, I know we said earlier it's a few months away still, that May issue, but I know you are fast at work. What can we expect? Any surprises, anything that you can sort of reveal to us in this swimsuit edition?
Alexis, so many surprises. I mean, I think it's going to be a beautiful issue. I think it's going to be a really unique issue. I think people are going to walk away from this year feeling just as inspired and as excited and surprised as ever. And I think a lot of people are going to see themselves in a lot of different ways in this issue.
And again, that Sports Illustrated swimsuit edition is due out in May. We'll, of course, be watching to see how that new ad program is put into practice. Still ahead here on A Time for Change, how the modeling industry is changing from someone on the inside. Welcome back to A Time for Change. The modeling industry has not always been kind to women, both women in the modeling industry and the rest of us looking at images from the outside. But a new generation is working to make it a kinder, gentler industry for all of us. Iskra Lawrence is a model, social media influencer, and entrepreneur who just launched her own skincare line. And Yahoo Finance's Ali Canal was able to speak with her about how she's managed to build a thriving career on her own terms.
As someone who has always been an advocate for self-love and self-acceptance, as a model, it was very challenging because I was met with a lot of barriers. And namely, I was trying to be a straight size model and I was always too big. And then when I tried to see if I could be a plus size model, they said I was too small. So my mission began with trying to change the industry. And it's beautiful seeing kind of the results. I mean, I've been modeling now 18 years and seeing that there is so much more inclusivity in the modeling world. And that translates so much to me when we talk about body care, because a lot of my self-image, issues stemmed from what I saw, the models who I saw representing brands, the messages that I was consuming. And so for me, I always knew that my end goal was creating brands that really, truly cared about inclusion, the message they were spreading, and the images that they were portraying. So for me, a body care brand made total sense. And Soltaire's tagline is "Everybody is welcome here," because we truly want everyone to feel welcome. And this beautiful serum body wash right here, that is a product that everyone is putting on their bodies every single day. So it was my chance to get to people while they're literally washing their bodies every single day, and hopefully give them those little reminders that they are enough, that they are worthy of taking just 5 minutes to themselves every day, and that their bodies are beautiful just the way they are.
And to follow up on a point you made, you said you were rejected from mainstream agencies for being too big and plus size agencies for being too small. I'm curious the lesson there beyond the world of modeling. How do you fit in when you're constantly being told that you don't? Because I do think a main issue today is imposter syndrome.
Yeah, that's true. I think that everyone at some point in their lives has not felt enough. No matter what career they're in, whatever community you're in, we're just pulled in multiple different directions about the type of person that we should be and that we should look like. So it's really, really tricky when you're trying to build your self-worth, if it's based, or any value system based on appearance. So that's one thing I've worked really hard to try and encourage people to step away from, and instead try and build a value and worth system that is based on their characteristics or their talents or the things that they put into the world. So one thing I like to do is a mirror challenge, where I use it for like a self-affirmation tool. And I also done a show on Facebook called Mirror Challenge, where I get people who have had self-esteem issues, body image issues, abuse issues, to get in front of the mirror and break down the definition that they might currently have about how they view themselves, or the value system they might place on their worth. Maybe they're brave, maybe they're creative, maybe they're funny, maybe they're the life of the party. And those little tools, even though they could seem throwaway, it is the narrative that you tell yourself every single day. I'm telling you, you've got to speak to yourself like your best friend would speak to you. And that's a decision that you've got to make every single day, to speak to yourself in a loving, kind way.
And speaking of the illusions of appearances, you have nearly 5 million followers on Instagram. What's your relationship with social media? Because on the one hand, you're able to reach so many people, but on the other, it is the cause of a lot of self-doubt, anxiety, a lot of mixed messaging when it comes to how to love yourself. So how do you navigate that when it comes to sifting through all that noise, not getting caught up in it, while also trying to appear as authentic and genuine and not performative as possible?
Yeah, I think that's such a valuable question, because that's something that this generation is really trying to figure out, how they use social media in a positive way, but have boundaries set so that it doesn't kind of consume them, and make them fall into this compare and despair. So my biggest thing is I try and think of like a consume and create ratio. As someone whose business is obviously very much based online, and the communities that I'm building with Self-Funding and Soltaire are very much online, I have to figure out when I'm creating or when I'm just consuming, and making sure that that's more balanced, because I feel productive, I feel accomplished, I feel like I'm putting something good into the world, over just consuming, where I can go in this downward spiral where I'm just like, I don't know, 10 Instagram pages and thinking, why am I not in Bora Bora, or why I'm, don't get to work out every single day and have an 8-pack anymore because I'm so busy with my toddler and these businesses.
And a lot of what you express to your followers stems from your experience in the modeling world. You had to forge your own path when doors were shut, often taking jobs with little to no pay, which can be a tricky mindset. I think especially, as women, you're like, okay, let me just put myself out there, get myself in the door. Hopefully the money and the opportunities will follow. But how did you balance exploitation versus forging your own path?
Great question. I did not navigate it very well at the beginning. I would say from the age of 13, when I started modeling, up until the age of 23, I would say I was definitely getting exploited. I was definitely working for free. I was definitely signing a lot of rights away to my images. One time I did a shoot with a photographer who had me sign away my rights to my images, and not long after, I saw them used in huge billboards on a really famous gym in the UK. I saw them used in a big drugstore promoting toothpaste, which would have been, thousands and thousands of dollars. And I signed those images away, all of them, for the £300. So I've learned a lot. Unfortunately, I think there is still a lack of protection from modeling agencies in general. I'm not saying anyone's in specific. I found a great agency now and I feel really secure, but there are people fighting. I don't know if you've heard of Sarah Ziff, but she has the Model Alliance, and I absolutely love the work they do because she's fighting for legislation to protect models. So there's definitely, there's not much transparency in the modeling industry. I personally felt like I was employed by them, where in a matter of fact, actually, you're the model, you're the client, and you pay the agency a commission. So I found that the more I grew online, I was able to essentially have a leverage because I knew the brands wanted to work with me, and I was able to then go back to agencies and I was able to, call out things in the contract that didn't make sense anymore, or say that I would prefer to work in this way. And I realized that I'm actually the client here, and it's really important for models to know that they do have a voice. We are definitely made to feel like if you're difficult, you won't work. And I've heard many stories about models who have been difficult and then they get put on the middle seat of a plane. Or if a client calls, they won't be the model that's, bigged up on the phone. They won't be the model that gets the booking. So there's a lot of politics within the industry.
I want to shift gears here a bit because you have a mixed race baby who is so cute, by the way. I know that after the murder of George Floyd, you posted a lengthy Instagram about protecting your child and educating yourself as a privileged white woman. Where are you in that journey, and how has raising a biracial child influenced your parenting style so far?
Oh my goodness. It has completely shifted my perspective. I have had a privileged life, and up until I met Philip and we lived together, and I really truly got to spend 24 hours a day with someone who has a completely different life experience to me, who is part of the Black community, and witnessing his thought process and what he has to deal with every single day. That's when it really hit home just how it's a choice. I was able to choose when I thought about racism. One of the first things we did was, even before he was born, was go and obviously find books that would feel like he could be represented, that we could discuss race with him, books that we've also encouraged our friends within our friendship group who have white children. The experiences they're going to have are going to be completely different. Or at least right now, while my baby's cute and a toddler, how that is different in society to when he's a teenager and out late at night and wearing a hoodie or in a group of people. Like, there's going to be so many different challenges that will be different for us raising a biracial child. And I'm already aware because we bought some Duplo this Christmas, and there was white characters and there was only one Black boy. And immediately my toddler said, "It's me, mommy." So there is this just constant challenge of just being aware and having these open conversations from day one with our child and with my partner about how I'm doing. What can I do more? Can we make sure that we're going to a church that's diverse? We're having these conversations consistently.
All right, that was some great perspective there. That was Yahoo Finance's Ellie Canal talking to model, influencer, and entrepreneur Iskra Lawrence. Up next, Mattel adds another historic figure to the Barbie Inspiring Women line. Find out who it is right after this.
Welcome back to A Time for Change. We've been talking today all about changes in how women are represented in the public eye. The toy giant Mattel just released its latest in the Inspiring Women series from Barbie. Ida B. Wells was a journalist, suffragist, and civil rights activist. She was also one of the founders of the NAACP. Wells was born in Mississippi in 1862, and as a journalist, wrote about the lynchings at a time when few newspapers would. In 2020, she was awarded a Pulitzer Prize for, quote, her outstanding and courageous reporting on the horrific and vicious violence against African Americans during the era of lynching. The Ida B. Wells dolls just hit store shelves in preparation for next month's Black History Month. That's all for this week's A Time for Change. I'm Marquise Francis.
And I'm Alexis Christophers. Thanks so much for watching. We've got lots more Yahoo Finance Live straight ahead. We promise to continue to ride this stock market roller coaster with you. Also, the CEO of Okta will be joining us, so don't go away.
Bracing investors on edge, trying to recover after stunning market moves. And as the Fed begins its two-day policy meeting, is the bank poised to deliver the clarity markets are looking for as earnings season heats up and the IMF delivers a message growth is cooling? Now, Okta has its finger on the pulse when it comes to company organization and the challenges they face on this side of the pandemic. We gauge the corporate landscape amid increased volatility and tap in on the trends they're using to get ahead. Plus, how close is the U.S. to creating its own digital dollar? And what's the risk-reward ratio? Bank of America weighs in. Good afternoon, everyone. I am Karina Mitchell, along with my co-anchor, Alexis Christophers, on the Tuesday afternoon. And Alexis, a whole lot of risk and TBD to see where the reward is. Maybe the bounce in Bitcoin is something that you can count on.
Yeah, that's something you could definitely point to, Karina. But we'll have to see if stocks, though, are able to stage another colossal comeback like we saw yesterday when the Dow was down more than 1,000 points and then finished up about 100. Here's where things stand right now. We are well off our worst levels of the day. The Dow was down more than 600 points earlier. It's now off about 200. In the broader market there, too, we're bouncing off our lows. The S&P down 60. We know it crossed over into correction territory. The Nasdaq has been in a correction now for the past few trading sessions, off about 300 points. Of course, investors waiting for more clarity here from the Fed at the conclusion of its two-day meeting tomorrow. And let's not forget earnings, which have been less than spectacular. Just 52% of the S&P 500 companies who have already reported actually beat estimates, and even fewer are offering guidance. We're waiting for some heavyweights this week, including Tesla, Apple, and Microsoft out after today's closing bell on Microsoft. Let's get a check of the bond market for you, because last check I saw yields there moving higher, with the yield on the 10-year at 1.76%, still off its recent high of 1.9%, and the 30-year yield at 2.11%. Consumer confidence falling for the first time in 4 months in January, as high inflation and Omicron start to weigh on consumers' minds. We'll have to see if that translates into less spending by consumers in the weeks and months ahead. Let's head over to Jared Blickery now in the studio. He's watching the charts. What have you got your eye on today, Jared?
Well, we'll get to Bitcoin in a second. I got to say, Karina, if we're clinging to bullish hopes and all we have to do is look at the crypto space, that's a little bit bearish right now. So here's the intraday price action, actually a little bit less bearish than we saw at the beginning of the day. You can see we've clawed back a lot of those losses, only down 166 points right now, down 0.5%. By the way, I ran the numbers. What are the odds of having another 2% down day that closes in the green, much less 3 or 4%? Only happened one time in the Dow, and that was 1932. So let's not get our hopes up. Nasdaq Composite still hovering around its session lows. It's down 2%, and we'll get a read on the Russell 2000. The small caps also hovering near their session lows. So not a lot of bullish action in the markets today. Do want to get a read on the 10-year T-note yield. That is up 2 basis points, so kind of bucking a 2-day trend here. And the 5-year T-note yield, just had an auction on that, went okay, and that's up about 2 basis points. And then finally, the U.S. dollar. This is something we've been keeping an eye on here at Yahoo Finance for a few months, and I got to tell you something. This is a pattern that could be a little bit troubling. Let me put this on a 3-month, and there you can see we have this consolidation area, and then we broke down. It was a false breakdown, and we're right back up in the mix. One of the biggest headwinds to stocks, and we were talking about this with Barry Bannister of Stifel earlier today, is that rising U.S. dollar. So we want to keep an eye on that. By the way, he called the 4,200 point low in the S&P 500. So we also want to listen to him on that. Now here's the Nasdaq 100. Now Apple is down over 1%, Tesla down just under 1%, Alphabet down more than 2%, and Amazon down more than 3%, Nvidia down more than 4%. So let me just dial up a 16-day view. This is how many trading days we've had in this year, and you can really see some of the carnage. You take a look at some of the losers here. Moderna actually the worst off in 2022. That is off nearly 40%, followed by Netflix and Align Technologies. So a lot of losses that we're looking at right there. Want to take a look at the sector action, and we're going to dial this back to an intraday view. And much like many other days this year, energy, that is up 2.5%. and nothing else. We see tech, that's the greatest loser to the downside. That is off 2%. And let me just chart what's been going on recently in the XLK ETF. And this is showing 12% losses over the trailing month. And that's really been the albatross around the market's neck. And we're talking about Microsoft. I'm going to do a deep dive on their earnings preview in about 30 minutes. They are they are announcing after the bell, but they're down another 2%. ServiceNow down 6%. Shopify down 5%. So the list goes on there. And it's a very similar story when you look inside the ARC components. So if we're looking for some green, as promised, we're going to take a look at Bitcoin. That is holding on to gains of 4% over the trailing 24 hours. And let me just get a more granular view of the month's price action. Here's that dip we took yesterday. It sold off with equities, and now we're just bouncing back a little, 37,000. Not the biggest number in the world. Probably got to go down and test that 30,000 level that we were seeing in the middle of last year. There it is right there. Guys?
No.
All right, Jared, you are the best. Thank you for finding that green. And Alexis and I both love it when you crunch the numbers. We'll go from crunching numbers to digesting the market action and bring in our next guest, Brian Levitt, Invesco Global Market Strategist. Brian, thanks so much for being here. So I guess the story for today is oversold doesn't mean over, right? So I want to get your perspective first on these wild swings that we saw yesterday in both directions. And then the slide today, I want to ask you, how long overdue is this? And is this a question of equity markets suddenly sort of waking up and realizing what the Fed is about to do, poised to do, and sort of catching up with where bond markets were a few weeks ago?
Yeah, I think that's right. I mean, investors have gotten pretty bearish. So if you look at surveys, bull bear surveys, investors have gotten very bearish. So you're starting to see signs that maybe some of the worst of this is behind us. If you also look within indices, so not just at the broad level, there's a particular amount of carnage. And so, we're starting to get, somewhat oversold. I think the challenge here for investors is that we're so used to when we see this type of volatility that the Federal Reserve is attentive to it and may even signal, some hope in a statement tomorrow, or maybe some, caution to don't extrapolate all these rate hikes. Challenges, we're dealing with very high inflation, and the Federal Reserve is going to continue to move. They're going to move, and they're going to try and bring inflation expectations under control. And to do that, they're going to drive real yields higher, and they're going to tighten financial conditions. So that's not a great backdrop for equities. It doesn't mean we run for the woods. It doesn't mean that the business or market cycles are over. It's just investors should expect some volatility as we move through this period.
Play devil's advocate with me. Is there any chance that the Fed turns a little bit more dovish based on all of this market volatility? And then on the flip side, do you see them potentially hiking by 50 basis points?
I don't see them hiking by 50 basis points, and I do not see them turning more dovish. The Federal Reserve recognizes that they need to move. They are going to begin to tighten policy. I think the key thing for tomorrow is they're not going to suggest that they're scrambling or meaningfully behind the eight ball. It's going to be a very measured approach, and they're going to talk about gradual moves in interest rates. And so they're not going to do anything tomorrow to further spook the financial markets, but they're going to set the path for what's going to be meaningful tightening. Now, the good news is for investors is that the markets are already expecting the Fed funds rate to be at 175 by the end of 2023, which would portend 7 interest rate hikes. And as of today, would be a very flat yield curve and may suggest that a recession would be in the offing, 6-12 months from then. So we've already priced in a pretty tight environment, a disconcerting environment potentially for the economy in 2024. The hope is now that as we start to tighten conditions, and as consumer demand starts to ease, moderate, that inflationary pressures will start to come down, and the Fed won't ultimately have to go through with 7 interest rate hikes.
So now, Brian, where do investors go amid all of this volatility? Where do you see any opportunities? Are there any opportunities? And how do you preserve the portfolio?
Yeah, I mean, we're in a slowdown phase. We're in a slowdown phase driven by tightening. In a slowdown phase driven by tightening, you still want to be a bit more defensive. But to the extent that you own equities, you want to be exposed to higher quality. I don't think that that's a bold statement. You want to be less exposed to more speculative or less highly visible earnings. You want to be exposed to higher quality companies. I mean, the good news is for investors in all of this is while a lot of companies, a lot of stocks got hit very hard, some of them deserve to. Some of them just did not have the fundamentals to support the valuations. But what you've also seen in this is very good quality businesses, even within the tech sector, that have gotten hit pretty hard. And some of them, good long-term historical growth businesses, structurally advantaged growth businesses, are now trading at market level valuations. So that to me creates opportunities for investors, unless you believe a recession is in the offing. If I watch credit spreads, I watch what the 10-year rate is doing, none of that suggests to me that a recession is in the offing and that the market cycle is coming to a untimely end.
One thing we do know, inflation is red hot, particularly in the central part of the country, and the IMF has downgraded growth. Okay, we will leave it there. Brian Levitt, Invesco Global Market Strategist. Thank you so much. Alexis, a lot to digest there.
You better believe it. And coming up next, even more to digest, because we're going to speak with the CEO of Okta. Todd McKinnon's here. He's going to break down their new report on cloud usage among its clients. Don't go anywhere. Okta just released its annual Business at Work report, looking at which apps and cloud services were the most popular with its clients over the past year or so. Here to help us break it all down is Okta CEO Todd McKinnon. Todd, always good to see you. So I was looking through this report. I know two things stuck out. Collaboration and security were the two most popular categories. But I also noticed that a lot of your users are choosing apps that are sort of best of breed over that single vendor approach. Any idea why we're seeing that trend?
It's great to be on the show, Alexis. Thanks for having me. This is our 8th annual Businesses at Work report. And to give the viewers a context, this is where we take aggregate data about usage on the Okta integration network, which is from our 14,000 plus customers using over 7,000 applications and technology across the whole tech landscape to get unique insights into what's happening in the world. And over the years, we've seen high flyers emerge, like we first saw Slack growth exploding several years ago, Zoom growth. So you get a look into the up and comers, you get a look into interesting trends. Like in this year's report, as you mentioned, people are really focused on that back to work experience. One really interesting thing we saw in the data this time is that if you look at office management applications like Envoy, and you look back 2 years ago in the pandemic, the usage of those office management applications went down, but it's actually back to pre-pandemic levels. So it's kind of, you're seeing that office environment normalize. You mentioned the collaboration applications. For the first time ever, in the top 10 fastest growing applications on our report, 5 of them are collaboration applications like Figma and Monday and Airtable and Notion. So companies are bringing people back to the office. When they're not back in the office, when they're doing a hybrid work environment or a dynamic work environment, they're investing in technology tools to make those employees productive. And the last thing you mentioned too about security, everyone's trying to do this all while keeping everyone very, very secure and stay out of the headlines in terms of security breaches.
Hey, Todd, it's Karina. Thanks for coming on. You have this really interesting purview, this great insight into what organizations are doing to sort of stay ahead using all of these apps and how they've actually weathered the pandemic and the challenges they face ahead amid, this new year and such increased volatility. We know that there's slowing growth. The IMF just came out with that report. I'm wondering, what are you seeing as far as the challenges these companies are facing? And then even in your own sort of workscape, how have you managed the pandemic and what are the challenges that you're dealing with?
You mentioned companies trying to stay ahead and get ahead, and that's more true now than ever. There's so much technology, so much power in terms of moving a business's strategy forward if they choose the right technology. And what we're seeing in our data is that if you want to stay ahead, you can't fall behind. We look at a lot of customers that are stuck behind on legacy technology. It's on-premise, particularly things like on-premise technology from Microsoft, where they have Exchange servers or SharePoint servers on-premise. And we see in our data that these on-premise environments are subject to higher number of attacks. So people trying to attack those legacy applications with password stuffing attacks and take advantage of that. Those legacy applications don't have the modern security that a cloud-based alternative, something like an Okta or a Google Workspace or an Office 365 have. So as these companies try to modernize and try to build new customer applications for their customers, deploy the best technology to their workforce users, they have to be able to move forward, get to modern technologies, modern protocols to get the benefit of all this technology without the security risk.
Todd, over at Okta, you guys have been seeing explosive growth, something like 60% growth year over year. But at the same time now, you've got just about every industry dealing with higher costs. And I'm wondering how that's impacting your business. Are you starting to see that already from the client side? And then also in-house, how are you dealing with these higher costs?
Well, from a customer perspective, they do think about costs, but more and more they're thinking about top line. How can there's a technology revolution going on, and the stock market goes up, the stock market goes down, there's lots of volatility. But if you zoom out, it's absolutely critical for every business in every industry to start to become a technology company, to reimagine their products as technology services, to create new products as technology services, and take advantage of all this innovation. So that's what customers are trying to do. We have a big part of our business, which is customer identity and access management, which is making sure that those digital products have an amazing login experience, have top-notch security, because as you know, online, if you don't have an amazing login experience, they're going to go to the alternative. So it's imperative for customers to invest in technology and have a great experience to grow the top line. On the expense side, I think what we're seeing is that employees are more valuable than ever, and having an engaged workforce that can work in this new world we're in now, where it's back to the office in some cases, but in many cases it's dynamic and hybrid. The technology has to be there. And I mentioned before, you're seeing companies invest in everything from HR tools to collaboration tools to making sure that every technology is very accessible and very easy to use, because surveys show that the more forward a company's technology strategy is and the more applications and tools they have in a modern environment, the more likely they are to stay at that company. So you're seeing companies double down on their employees and believing that that's going to drive their growth going forward.
And then Todd, I know you said collaboration and security are two of the big things organizations focus on, but there's also some good news as well. You say companies are also invested in giving back through apps. Tell us about that.
Well, it's a big part of our company. Our philanthropic arm of our company, Okta for Good, has tremendous impact in terms of the communities we operate in around the world. Whether it's giving, whether it's working with the nonprofits to use our product, whether it's our employees that are engaged in their communities to help give back in their communities around the world. And that translates, just like Okta or every other company, every nonprofit has to use more technology to be more successful. They have to be able to reach their constituencies through technology. They have to have an engaged workforce striving forward toward their mission. And we're happy to support them in the work we do. And you're seeing more and more companies taking the same fully integrated philanthropic approach for their nonprofit efforts, and it's kind of rippling through the industry, and I think it's a very positive trend.
All right, Todd McKinnon, CEO of Okta. Always good to see you. Thanks for bringing those insights. Be well.
All right, and coming up, GM is accelerating its investment in EV, revealing its biggest investment ever. Details straight ahead. Welcome back to Yahoo Finance. Well, Michigan has just approved a deal that will see GM investing about $7 billion into multiple projects in the state, including into EV. Here to tell us more is Yahoo Finance's Rick Newman. And Rick, this is GM's biggest investment ever, I understand. It includes a battery facility.
Yeah, that's what GM is saying, their single biggest investment ever. So $7 billion, they're going to build what I believe is their third battery plant. They may ultimately build 4 battery plants. And of course, that's to create the cells that are going to power these electric pickup trucks and SUVs that GM plans to be rolling out. So GM says its goal is to sell 1 million electric vehicles of all different types by 2025. Tesla right now is the leader in the United States with about 930,000 electric vehicles. Ford is pushing to get into that range as well. So a lot of new electric cars coming on the market during the next few years.
But, Rick, I wonder how well positioned GM is, compared to the traditional Ford, compared to Tesla. Remember, it pulled out of that deal to help fund the EV startup Rivian. So where do you see it playing out here amidst the competition?
Yeah, first thing to, I think, point out is it's still very early days. You could say GM actually had a lead here because they introduced the Chevy Volt with a V. That was a hybrid electric more than a decade ago. And then a few years after that, the Chevrolet Bolt with a B. But that Chevy Bolt has really had problems lately. There have been defects in the batteries. The batteries catch fire, not what you want in a car that's parked in your garage. So GM has had to recall all those vehicles, and they're basically not selling them at this point. They're just trying to fix that problem. Meanwhile, Ford is doing really well. They've got the electric Mustang on the market, and they've been taking orders for the electric F-150 pickup, the Lightning. They seem to be getting tons of orders for that. But GM is coming right behind now. They're taking orders for an electric Silverado pickup. That's the main competitor to the F-150. And they're also going to be rolling out a Cadillac electric SUV in just a couple of months. That one's actually going to be going on sale. We're going to see electric SUVs coming behind that. And I guess GM will continue to sell a few plain old gasoline powered cars. In fact, that will continue to be the bulk of their portfolio. They're just not talking about that anymore because that's not what investors want to hear. They want to hear all about electric vehicles.
Tesla is also revving up its gigafactory. So does GM catch up to Tesla? Can they accelerate ahead of them?
GM could catch up to Tesla. I mean, GM certainly has a gigantic manufacturing footprint. They've got the dealer network and other things that will help. I don't think it really matters as much who sells the most electric vehicles. And General Motors has been in this battle before, where leading up to the 2009 bankruptcy and all the problems GM had. It was really important to GM for a while that it remained the sales leader in the United States, but it was losing money. And there was a point where GM said, we're going to stop worrying about whether we lead in sales or what. We're going to focus on profitability. So hopefully that's a lesson GM has learned at the institutional level, and they will keep in mind as they get as they start to roll out all these electric vehicles. The point is profitability, not just the raw number of sales.
Yeah, despite all of the volatility in markets, some big deals getting done. Okay, Yahoo Finance's Rick Newman, thank you so much for that. Alexis?
All right, coming up in the next hour, we're going to look at why the American heartland has become an inflation hotbed. Stay with us.
Welcome back to Yahoo Finance. I'm Karina Mitchell, along with my co-anchor Alexis Christoforous, on what is turning out to be another wild day on Wall Street, with just about 2 hours left to trade. That as earnings season heats up and Microsoft set to report after the bell. Want to get you a check of the benchmarks. Just take a look at the market action now. And incredibly, the Dow is now off by just 21 points. It was down by much more earlier in the session. The S&P is down by just 33 points, and the Nasdaq down by 205 points. Want to kick it over to the bond market to see what's happening there and take a look at the 10-year yield. And that is slightly higher. It's at 1.78%. You see the 30-year yield up to 2.13%. And with much more on what is making the markets move in either direction is Yahoo Finance's Jared Blickery. Jared, it's a familiar story that we're seeing. Tech once again leading the Nasdaq lower.
Yes, it is. And let's just go to the Nasdaq 100 heat map, and we can really see the damage that's being done. I showed the worst yearly performers before just a few minutes ago, and just want to review, kind of recap what's going on here. We are in the midst of a mega cap tech rout, and we're only seeing the losses accelerating. Nevertheless, the Dow trying to turn green right now. Unlikely, as I've been pointing out, to do that 2 days in a row, but anything could happen. I think the bottom line is that we're in a very low liquid environment, and everybody's waiting to see what the Fed does later on this week. That's going to be coming tomorrow in exactly 24 hours here. We're going to bring that to you live. You take a look at what's happening in the semiconductor space, a lot of deep red here. You take a look at what's happening in the software space. It's a very similar story. I don't need to go through the numbers. And finally, ARK. This is just I guess, a hotspot of inactivity right now. We're just not seeing the buyers swoop in the way we have in the past. And there was an important note that came out not only from JP Morgan, but also Goldman Sachs and some others looking at retail flows. Retail flows have been very strong this year, except that abated last Thursday and Friday. And yesterday morning was a capitulation day for the retail trader. All in all, it looks like retail traders may have finally put in the bottom for them, but the institutional guys, they have to come in and do that as well. Unfortunately, we haven't seen that just yet, guys.
Yeah, got to try to get those institutional and investor traders on the same page. Want to talk earnings, because we've been talking all day long about how, or all week long, about how a lot of them have been, less than spectacular. We heard from some big names today. GE, a revenue miss there. 3M came in better than expected. Break down some of the big ones for us, Jared.
Sure. Let me start out with GE, and they're not part of the Dow anymore, so you might have to bring up your own ticker. But this was kind of a decent quarter for them, although the stock sank by about 5 or 6% in early trading. So the revenue at GE in aviation, particularly disappointing. This is according to a Bloomberg analysis. It rose 4%, while analysts had been expecting a double-digit gain. And then they're also suffering from supply chain constraints like just about everybody else is in this market. They took their toll across the company's business. GE Healthcare, they got hit hard. They got hit for 800 or 900 basis points of revenue pressure, and that's because they couldn't get the orders out of the door. That's what Larry Culp said in an interview. Thank you for that. The good news, GE reduced its pension deficit to $12 billion, and it is now down $8 billion from 2020. That was a major pain spot for them. So they have been doing work on that turnaround front. And they also said they don't expect any pension plan funding through the end of this decade. Also want to check out 3M earnings because the revenue narrowly beat analyst estimates, and the Omicron coronavirus actually increased the near-term demand for their masks. Also, it was a story about Post-it notes and tape. Their consumer division did very well this year, so 3M benefiting from that. Finally, I want to touch on Raytheon Technologies in our industrial group. Pratt & Whitney jet engine division, they showed encouraging signs that the recovery in commercial aviation is underway. That was an important milestone to be reached. And also lower production of Boeing 787 Dreamliner. That is hurting the company, and that is because it is plagued by quality issues.
And then J&J also reporting and missing on revenue before the bell. Let's turn our attention to what's coming after the bell, because a lot of focus on Microsoft, and investors are looking at their cloud strength.
Yeah, exactly. And this is supposed to be their first quarter in which they're reporting $50 billion of revenue. That's just simply incredible. Here's a one-year chart, and let me put this on a line graph so you can see it a little bit easier. Well off the highs here, but it's not an absolute disaster. Still looking at gains of 27% over the trailing year. And I want to get to a Bloomberg analysis, and here we go. This is their preview. Their second quarter earnings expected to be the first 3-month period in which sales topped $50 billion, exactly what I was just saying, on continued strength in Azure cloud software. Also, their web-based versions of the Office programs. Results also expected to be boosted by holiday sales of Xbox consoles. And so we have some of the numbers here. Top line number, revenue estimated to be $50.87 billion. And then you break it down by segment. I remember just a few years ago when they had 3 segments reporting $10 billion or more in revenue. That is up to 50, so pretty incredible there. Productivity, business processes, $15.91 billion, intelligent cloud, $18.3 billion, commercial cloud, $21.2 billion. And then finally, adjusted EPS estimate, that is coming in at $2.32. Want to get to some stats of what we can expect from Wedbush. Now, they rate the stock an outperform price target of $375. And they're saying, based on our recent checks, we believe the company saw another robust performance in the December quarter, led by Azure Office 365, with our expectation to see a 3% top line beat and upside across the board, which should be a major boost in the arm for the overall tech sector looking ahead. We know the tech sector could really use a strong boost in the arm.
That it could, to put it mildly. All right, thanks a lot, Jared Blickery. Let's stick with the markets. Bring in John Bellows, portfolio manager at Western Asset. So, John, I'm going to ask you about this whiplash that investors are getting over the past 2 days. A colossal comeback yesterday for the Dow, erasing a 1,000-point deficit. It was down about 600 today and was briefly in the green. It's down now about 90 points. What's at play here? And I'm just wondering how much of this is just technical selling and buying at this point.
I think clearly we're in a period of heightened uncertainty and market volatility. Hard to comment on any one day of ups and downs, but that is definitely true in the broader sense, as we are in a period of heightened uncertainty. I think adding to that, or the driver of that, has been a pretty spectacular pivot from the Federal Reserve. They've made a very significant change in their outlook for what appropriate policy is in 22. That change has been kind of ongoing over the last few months. And I think what the market's doing today is reflective of that. Market's trying to figure out where that pivot ends, what eventually anchors Fed policy going forward, and is still trying to calibrate correctly, the scale and magnitude of that Fed pivot. So very volatile markets. Any one day you can see up or down. But I think the bigger picture is the Fed pivot has added to the uncertainty, and markets are struggling to figure out where it ends and what is the anchor in the meantime.
So, John, as a portfolio manager, I'm curious if you're using these big down days as an opportunity to scoop up some bargains. And if so, what are you buying right now?
Well, Western Asset is very value oriented in our process. And so we are focused on the price. And so when you see big changes in prices, that will obviously be something we look at and factor into our decisions. I guess I'd kind of temper that with a few things. I think in addition to wanting to be active on the value front when we see this type of volatility, and we think it's also important to have diversification in portfolios. You don't want to have portfolios that are swinging around wildly on any one given day. And so we put a lot of thought into, both sides of the diversification. You want to have something that works in most environments. I think the second thing I would say is, we tend to be longer term investors. And so when you see prices dip on one day, that could be an opportunity, but it really needs to be wedded with the more bottoms up research that goes into being a value investor. So the short answer is, I do think there's opportunities, and we certainly have been acting on some of those, but it's not a 1 or 2 day trade. It's in the context of diversified portfolios, and it's in conjunction with the bottoms up work that really a value discipline requires.
What are you doing with commodities at the moment, John? Because it looks like a lot of investors are piling into gold. The Spider Gold Shares ETF on Friday notched its largest single day of inflows on record. So is that where investors are going for safety, and is it a good trade?
Well, one thing that's kind of interesting about gold is we've seen a very, very strong move up in real interest rates. If you look at TIPS yields, for instance, are up 50 basis points in the last few weeks. It's a big move. It tends to be the case that gold is inversely correlated with real interest rates. So higher real interest rates might actually be gold negative. It's just something to think about. I think that maybe the gold strength on a day like yesterday, a little bit more flight to quality type characteristics, but perhaps actually out of sync with the broader trend towards higher real interest rates. I think your question on commodities more generally, though, is one where we're optimistic. I think that, as long as the economy continues, the global economy continues to expand in 2022, that should be a support for commodities that are part of that economic growth story. So, oil would be there, maybe even copper over a longer run, although China obviously has some more near-term concerns. So, we're generally optimistic on growth over the medium term or even this year. As the global expansion is ongoing. And I think that makes you positive, or it makes us positive on commodities in general. Gold may be an exception due to that correlation with real rates. But I think commodities generally, especially those tied to economic growth, constructive.
And John, finally, what can Fed Chair Powell say tomorrow that would actually calm investor nerves, if anything at all, at this point?
Well, again, I think part of what's going on is investors are trying to figure out where this Fed pivot ends. There is some uncertainty on exactly how much removal of accommodation the Fed has in mind. The Fed obviously doesn't know the final answer, and they're not going to give it to you tomorrow. But I think if Powell were to suggest that the market has priced a sufficient amount for now, I think that actually could be calming. I don't think there's any reason for Powell to continue to push a further hawkish message. He's already sent the message. The market's already adjusted. And if tomorrow, the market gets the sense that what's been priced, 4 hikes this year and some removal of the balance sheet, is sufficient given where we are in the outlook, I think that actually could be calming. I think one thing that's kind of challenging there is it's going to be dependent on the economic data. So whether they end up hiking 4 or less or more, depend on inflation outcomes in the second half of the year. And obviously Powell doesn't know with certainty there, neither does the market. So there will be some unresolved uncertainty on the final number of hikes. But again, if Powell were to say, markets have understood the Fed pivot correctly, they're priced correctly now. He won't say it that way, but that could be the suggestion. I think that will be calming because it will give the market some sense that the uncertainty around the Fed pivot has been resolved.
Yeah, we're all watching and waiting. We're going to bring you that Fed announcement tomorrow live at 2 p.m. Eastern. John Bellows, portfolio manager at Western Asset. Thanks so much. And coming up here next on Yahoo Finance Live, where is inflation running the hottest in the U.S. right now? The answer may surprise you. Welcome back to Yahoo Finance Live. Nationally, inflation is running at a red-hot 7%, but in small towns in the Midwest and South, the rate is more like 9%. That's according to a new report on inflation from Moody's. Joining me now to break it down is Adam Kamins, Moody's Analytics Director of Regional Economics. Adam, good to see you here. Before we get into some specific states, if you can just give us an overview as to why the American heartland has become such a hotbed of inflation.
Sure. So the last few months in particular, the conditions have converged to make the middle of the country a bit more exposed to inflation. So if you think about it, some of the core reasons would be kind of what is the economy all about? What are they making? What are they selling? And the middle of the country is a bit more manufacturing oriented, right? And when we think about what the root causes of our inflation right now, those root causes tend to go back to supply chain disruptions, issues with getting raw materials from China and other parts of Asia that have been disrupted by the pandemic. And all of that flows really heavily into these manufacturing areas. So rising prices are affecting firms there, wages are rising there, and that's a big part of the story.
All right, so let's break this down into states for a moment, because I think a lot of people are going to be surprised to hear this. The state with the most small cities registering inflation of at least 8% last quarter, Wisconsin. And also coming in second was Texas. What is it about those two states, and why are we seeing inflation running so hot there, do you think?
Sure, right. Those are not states you usually think about as being areas where there are very high costs, but a few reasons for that. Again, it goes back to the economic structure. Manufacturing is big in both, and in Texas, energy as well, right? Oil production is a big part of the economy, and energy prices have been just soaring throughout the last few months. So that is putting a lot of upward pressure on prices in Texas. The other thing I'd say about both of those states and kind of the middle of the country in general is inflation has been a lot more pronounced in goods as opposed to services. And these are the middle of the country, the propensity to consume goods is a lot higher than the share of consumption that ties back to services. So people are buying more stuff basically in the middle of the country. They're buying more services and spending on different items in the Northeast and on the West Coast. So what we're getting in the middle of the country is kind of on both the supply side and on the demand side, you've got factors that are leading you towards higher inflation.
You know, what's interesting is Wisconsin's inflation is sort of becoming a political issue because we have a Senate seat and a governor race in the midterm election this year, which brings me to my larger question. You know, there was this reporter who asked President Biden this week if inflation was a liability. We've seen it hurt other presidencies. President Carter comes to mind with the sky-high inflation of the 1970s. Is there anything the Biden administration can do to cool these high prices?
It's very difficult for a president or kind of the executive branch to deal with high prices. Really, you know, as most investors are aware, right? It's on the Federal Reserve. It's monetary policy that really is the key. To the extent that the Biden administration can do anything, I think they've taken some of the appropriate steps. Like, for example, back in the fall, trying to help with the Port of LA Long Beach and put some conditions in place there to relieve bottlenecks. Those kinds of things are going to matter really more than anything else. And I think ultimately the root cause of all of this goes back to the pandemic. So getting the pandemic under control is going to be key. And to the extent that the Biden administration or any other leaders can kind of get us through the Omicron wave and minimize disruptions going forward, that's going to be the real key.
And you mentioned the Fed needing to battle inflation. How difficult will it be for policymakers to cool decades-high inflation with the tools that they have at their disposal?
So our point of view at Moody's Analytics is that this is more likely to be somewhat transitory still, that a lot of the factors behind the spike in inflation have to do with disruptions that owe to the pandemic. So I think if, as we expect, some of these supply chain issues continue to ease, and we've seen that a lot of the Asian factories that are shipping raw materials to the U.S., that they are remaining open generally through Omicron in a way that they were not able to through Delta. So if you get sort of that kind of easing of disruptions, alongside rising interest rates, I think we get to a place where by the end of the year, inflation is much more under control and people are not focused on it the way they are now, for sure.
Well, we certainly hope so. Have a few months to get us there. Adam Kamins, Moody's Analytics Director of Regional Economics, thanks so much for those insights. Folks, you were looking at a live picture of the big board there at the New York Stock Exchange. And no, you're not seeing things. The Dow is now in the green, up more than 50 points. Remember, it was down 600 points earlier today. So another day of huge swings here for the Dow. Broader market coming back as well. We've got the S&P down just 21. Big tech continuing to get clobbered, but not as badly as earlier today. The Nasdaq down more than 1% or 162 points. Karina?
Setting up for a repeat of yesterday, Alexis. Okay, we're going to take a quick break, but on the other side of it, switching gears, the Pentagon orders 8,500 troops to be on high alert, ratcheting up tensions between Ukraine and Russia. What comes next? Details ahead. Welcome back. Well, Russia just announced a flurry of military drills as tensions between Russia and the Ukraine rise. Here to break down next steps in diplomatic negotiations and potential geopolitical risks is Alex Brudeau, Eurasia Group Practice Head from Eurasia. Thank you, Alex, for being here. So Russia says it has no plans to invade Ukraine, yet it just stepped up these drills. In your estimation, does it actually go through with a strike?
Well, it certainly is developing the capability close to the Ukrainian border to conduct a military attack against Ukraine. I think the general sense is that President Putin has not made a political decision one way or the other as to what he will actually do when it comes to this. There are a number of demands that the Russians have made on the security front, not just relating to Ukraine, but also relating to broader Eastern European security. Russia is currently waiting for the US and NATO to send written responses to some proposals that they had made in December. There's an expectation that those will arrive over the next week and that the Russians will then evaluate those and decide whether or not they want to continue with the negotiations that started a couple of weeks ago and initially didn't go very well.
And then, you know, one of the tensions that sort of has escalated things is that Putin wants to make sure that Ukraine doesn't become a member of NATO. But how likely is that to happen anyway?
It's unlikely at this stage. And President Biden actually mentioned this in his press conference last week, that there are various factors that mean that Ukraine is not going to become a member anytime soon. However, the Russian side has signaled that that's not sufficient as a security guarantee, that they want some sort of legally binding guarantee that Ukraine would never become a member, which for NATO and the US is a non-starter. So a key question here for the negotiations is just how flexible the Kremlin really is on that point. Are they willing to, take the assurances that Biden gave at the press conference last week? Do they need something more? But I think also an important point here is that the Russian side and Putin over the last couple of months has talked about a number of different security issues throughout the region that he wants addressed in these negotiations. So the question will be whether or not there's a package of agreements that can be reached that will satisfy both Washington and Moscow. Now that's a challenge, but it is not impossible. And actually, we think that it is likely to happen, but it will take some time.
And then how aligned are the EU and the US when it actually comes to imposing sanctions? Because, Europe is very dependent on Russia's natural gas and oil. So does this in any way sort of lead to an energy crisis, do you think?
Well, there are some key differences when it comes to their approaches on sanctions. The US has been signaling that it will be very aggressive from the outset with sanctions it imposes if Russia attacks Ukraine. With the EU, I think it's harder to find a consensus amongst the 27 members about what is the best approach, with France and Germany representing maybe one side of this argument, states closer to Russia, like the Baltic states and Poland, hoping for or expecting more confrontation. So the prospect of significant EU sanctions is more limited unless we see a very overt, full-scale invasion of Ukraine, an attempt to occupy a significant part of the country, which would really galvanize EU views. I think there is some sensitivity, certainly, to energy issues when it comes to the Europeans. It does not appear at this stage like energy sanctions, apart from the issue of the Nord Stream 2 natural gas pipeline, that those energy sanctions would be a target. And I think it's also important to note that, for Russia, just as much as for Europe, there is a dependency there in terms of the supply of energy, the revenues that Russia gets from energy supplies. They're going to be sensitive to these issues as well. And that potentially decreases the risk here that we might see Russia cut off natural gas supplies to Europe in a major crisis.
Alex, how important is it the way that President Biden handles this, particularly in light of the fact that he has been criticized by some over his handling of Afghanistan and obviously coming up to midterm elections?
Well, I think it is important to the Biden administration. They actually have taken some risks here in terms of the outreach to President Putin that we've seen since June. The mood from many members of Congress is that the White House should be more confrontational in general, should be imposing tougher sanctions on Russia, should be stopping the Nord Stream 2 pipeline. A message from the White House up to this point has been that dialogue with Moscow can lead to positive outcomes. That's really being put to the test in this case. Foreign policy in general probably will not matter a huge amount in the midterms, but certainly a major crisis would be a concern for the Biden administration and for Democrats as they're trying to keep the House and the Senate.
All right. Well, thankfully, there is still dialogue happening at this point, which is a good thing. All right. We will leave it there. Alex Brideau, Eurasia, Group Practice Head from Eurasia. Thank you so much for your insight.
All right, thanks a lot, Karina. Coming up next, how the Ukraine-Russia conflict is impacting the oil pits. We're back right after this. Welcome back, everybody. Oil prices rallying today following the biggest one-day sell-off in a year. Traders appear to be focusing on the strong outlook for energy demand. Jared Blickery at the charts to fill us in. And of course, a lot of wild cards here, Jared, for this market. You've got the conflict between Russia and Ukraine heating up. And you've also got the Iran nuclear talks.
That's right. And we can talk about Russia in a minute. And let's just focus on the price right now. And we can see nice rally underway, up almost 3%. You take a look at what happened yesterday. Even at the lows, it was not off that much. So simply on a two-day basis, still up 2.8%. And we'll take a longer term view. We'll look at 3 months here. And you can see this is when we broke to that 14 or the highest level since 2014. And we really have maintained those gains. So energy has persevered in the midst of this sell-off. And I just want to show the sector action for today real quick. Energy up 3.5%, financials up as well. So the value trade really working out here. Here's the energy heat map. Exxon up over 2.5%, Chevron up over 3%, BP up over 4%. Let's take a look at the 16-day gains for 2022. Really impressive to see ExxonMobil up 22% here. So you mentioned Iran. Those sanctions have been in consideration for over a year as potential market movers since Biden has been in office. Those talks expected to resume, but nothing's really happened on that front. So yes, there would be additional supply coming into the market. Let's remember that they're a member of OPEC and OPEC Plus. So I think the Saudis would keep that under wraps.
And then, you guys just touched on it. I spoke with it earlier on with our guest just a few minutes ago. Ukraine-Russia tensions, obviously a big issue. How does that impact energy?
Yeah, that's really the big issue here, because typically global conflagrations really don't lead to major market meltdowns, at least ones that don't last for a while. They tend to be pretty quick in nature. But given Russia's outsized influence in the energy market, it is a huge producer, not quite up to Saudi Arabia levels, but it is a contender with the U.S. And when you have that kind of firepower, there's a lot they could do. They could easily spike crude oil up to $100 per barrel or even more. I don't think that's on the agenda, but if they're facing crippling sanctions, you can't count that out. So I think it's going to be very important to study the negotiations and read how they are coming out. But I don't think Russia's going to do anything drastic that forces Biden's hand that we do get those crippling sanctions, which does lead to higher energy prices.
All right, lots to consider there. A lot of moving parts. Jared Blickery, thank you. Want to switch gears now and get the latest on COVID, because today Pfizer said it has begun clinical trials of its Omicron-specific COVID vaccine to determine if it's safe and generates a strong immune response in those both vaccinated and unvaccinated. Here to talk about it is Dr. Michael Sag, Associate Dean for Global Health at University of Alabama at Birmingham. Doctor, thanks for being with us. So given how rampant the spread of Omicron is, does this vaccine trial come too late, or is it, I guess we can look at it as an insurance policy in case Omicron mutates to become something a lot more serious?
Well, I think your question's spot on. The testing will happen in the next couple of weeks to a month or so. And by the time that the new product gets tested and hopefully is shown to be effective, Omicron will probably be in our rear view mirror. So it's really a question of what are the next boosters that we should be using? And an Omicron booster might be better than the usual Pfizer booster because it gives the immune system something different to look at, obviously, especially in those people who never had Omicron. Nobody knows what the future is going to hold. There likely will be new variants that emerge over time. But I think the principle is to give the immune system as many different looks as it can at the outer portion of the virus, the spike protein, so it can be prepared for whatever variants may come along.
Doctor, we just found out a very sobering statistic today. COVID-19 deaths in the U.S. reached the highest level since last February. Even though we keep hearing about Omicron being milder than Delta, how serious is it for those who are not unvaxxed? And how important is it to get that booster shot then?
Well, the deaths are mostly occurring in unvaccinated people, and that's the way it's been ever since last December when the vaccines were released. Somewhere in the message, I think the public is getting a little confused. They hear accurately that Omicron as a rule is a little bit less aggressive than Delta. That's true. It's especially less aggressive in those who are fully vaccinated and boosted. That's true. especially with regard to hospitalization and death. But for those people who are unvaccinated in particular, when they get Omicron, those overall numbers of people who might progress to hospitalization and death is less proportionately than what we saw with Delta. But the overall number of cases is so much higher that the aggregate numbers are higher in general, which is why we're seeing a new record in deaths. And it's tragic. These folks don't have to die from COVID, but they are dying because they're not getting vaccinated. And the misinformation that's out there that's telling people that the vaccine kills people, telling people that these vaccines are unsafe, that's just wrong, and it's killing people.
Doctor, I know you're in Alabama, where the situation there is pretty dire in your hospitals. COVID hospitalizations rising, about to reach an all-time high. What is their vaccine status, those people, generally speaking, and what is the new case count like there?
We're hitting a peak again, and part of the reason is that the vaccine status of people in Alabama is generally much less than the average for the country, unfortunately. And that's true for a lot of the states in the southeastern U.S. and in some of the Midwestern states. The problem is that we're having trouble getting our messaging out there, and that means that people who are not vaccinated are picking up COVID. As far as overall caseloads, there are breakthrough infections for sure among people who are vaccinated and even some people who are boosted, but those cases are mild and typically don't lead to hospitalization. But to reiterate what I said earlier, it's really the unvaccinated folks who are filling up our emergency rooms, our hospitals, our ICUs, and they're the ones who are disproportionately dying from COVID. The rate of death is about 13-fold higher for an unvaccinated person than for a vaccinated person. That's a huge number.
It certainly is, Doctor. I want to switch gears and talk about the mask mandate, the debate there, which continues to rage on. So this week, a New York State judge ruled that the state's mask mandate was unconstitutional. You also had this week 7 school boards in Virginia suing the new governor there for his mask optional order. I know sometimes they have to deal with the letter of the law and not necessarily the science, but as a doctor, what would you tell these parents right now grappling with whether or not to send their kids to school masked or not?
Well, backing up, we know that masks work, especially the more robust masks like the N95, the KN95, even surgical masks are much better than not wearing anything. And I think what the school superintendents are trying to do is keep the kids safe as possible. We want our kids back in school. We really need to have them there for their sake and for just the sake of creating normalcy. But we can't just send them into harm's way with no protection. So the concept of a mask mandate is based on the knowledge that if everyone is wearing a mask, that keeps most people safe, a whole lot safer than if it's sporadic, because that person who's infected is spreading virus into the world around them. And if kids are coming into contact with each other, they're going to pick it up not only for themselves and bring it home, but mom and dad and other relatives can pick it up who live in the house. So it's really an interesting legal battle. But from a public health perspective, there's no question that we're all better off during these spikes. That's what I really want to emphasize, of having us all wear a mask as we weather the storm and then get to clearer skies, hopefully in February and early March.
So I'm going to leave us on a hopefully an optimistic note. Are there glimmers of hope that you see that tell you perhaps this pandemic moves over and morphs into an endemic in 2022?
Yeah, I really believe that. And I think there's 2 ways to look at it. One is just the nature of these epidemics. They do tend to, over time, burn themselves out as a raging fire. There will be smoldering areas that spark up every now and then here and there. But the other thing that I really want to emphasize is to celebrate our science. We are 2 years into this epidemic, and we already have a large number of treatments available. We have very effective vaccines. We know a lot about how this virus is transmitted, and like we just talked about, wearing masks that can prevent it from being transmitted from person to person when these spikes happen. We have all this knowledge. So I think that's going to converge over the next couple of months. And I think if we're smart, we can move forward in the most normal way, getting back to where we were pre-COVID, if we all get vaccinated and during spikes we wear masks and protect ourselves. And when we do get infected and have symptoms, we have these new drugs and we'll be able to hopefully keep people out of the hospital and prevent them from dying.
Have to use all the tools that we have at our disposal for sure. Dr. Michael Sagg at University of Alabama at Birmingham, thank you.
All right, thank you. And Alexis, you're right. No time to let your guard down right now. We are going to take a break, but coming up on the other side of it, Bank of America says a U.S. digital currency is, quote, inevitable. Find out what's coming down the road ahead. It's not imminent, but our next guest says the U.S. adoption of a digital currency is on the horizon. Here with more on the risks and benefits, Alkesh Shah, Bank of America Global Research, Head of Digital Asset Strategy. Alkesh, thanks so much for being here. So realistically, how far away are we from a digital dollar? Because the Fed just issued a paper on it, but they kicked it over to Congress, where, as you know, things can move slowly.
Yep. So it's not near term. There's some work to be done, especially to figure out considerations like privacy, the current banking system, how to make sure that liquidity is maintained in the banking system. We really think, even though we think a digital dollar is inevitable, that it's probably not till 2025 to 2030.
And then what are the key considerations before issuing a central bank digital currency or CBDC?
Sure. So I think one of the most important considerations that central banks around the world are working through, including the Federal Reserve, is privacy. So when you have a digital asset or a digital currency that runs on the blockchain, which is the underlying technologies of these digital assets, all of the transactions are available to be seen. Now, in the case of a central bank digital currency like a digital dollar, it probably won't be open to everybody, but the government will be able to see it. And the government also needs to preserve the privacy of its citizens, or at least have a process where not just anybody can take a look at it, right? And so those rules and processes need to be in place to preserve citizen privacy before a digital dollar could actually come out. So that's probably one of the most important considerations. The second consideration that, and the Federal Reserve in their statement listed a few of them, but the second most important one is really ensuring that our banking system continues to work as well as it does. Today, banks get deposits, they lend it out, they help the economy grow. If the Federal Reserve issued a wallet for its digital dollar, potentially banking deposits could move to that wallet and leave banks, not all of them, but even a few percent leaving could affect the economy. And so the Federal Reserve needs to take that into account, consider those aspects of it, and decide exactly how they issue those wallets for that digital dollar. Potentially, they could have the banks issue the wallets, hold the wallets, so this way it doesn't affect the flow of payments and liquidity. And so really, those are probably the two most important considerations. The Federal Reserve statement mentioned a few others, but I think those are the two most important.
And then does it actually help or hurt the dollar's position as a reserve currency? And then what are some of the benefits and disadvantages of it?
Sure. So today, the dollar is the world's reserve currency. It is the most liquid, it's the most used for payments. And as other central banks offer digital dollars and digital currencies, and the benefits that digital currencies offer, there is the chance that the dollar would become less the world's reserve by not having a digital dollar. And so that's one of the reasons why it is important in order to maintain our status as the world's reserve currency to eventually have a digital dollar. And the reason why digital currencies are so interesting and so important, and why central banks are doing it, is one of the reasons is payments. Today, if you make a payment cross-border, it can take days to settle, whereas with a digital currency, it's almost real time. And so if another central bank offered a digital currency and that began to be used, that's where it would impact the dollar if we didn't also have a digital currency.
And then I'm wondering about stable coins. They're pegged to the dollar or other fiat currencies. Do you think those gain traction in the meantime? And what kind of regulatory pressures do they face?
Yeah, so stable coins are a somewhat new phenomenon, but they've grown significantly in use. So people first started hearing about stable coins when Facebook came out with Libra as an idea. That really didn't go very far. Since then, though, other companies have issued stable coins backed by dollar and other reserves to be similar to a dollar. And they've grown significantly in transactions. So to give you a sense, last year, every quarter, you had almost $1.5 trillion of transactions of stable coins. That's up from $250 billion a quarter in 2020. So you had almost a 6x increase in transaction volume of stable coins in terms of use for payments and for trading digital assets. And this year, we're on track to potentially do $1 trillion of transactions of stable coins a month. And so the adoption of stable coins is significantly growing. And the reason why is just as I had mentioned as an example for a digital currency, if you use a stable coin for a payment, it's almost real time and it's much less expensive. So right now to do a cross-border remittance of say $200, it can cost you up to 5% of that $200 to make that transfer. Whereas with a stable coin, it's virtually free. And so using a stable coin in payments is definitely something that could see near-term and intermediate-term adoption until eventually we have digital currencies, and then potentially they can both coexist.
China, of course, way out ahead of us with their digital yuan, which they've been testing for a while and rolling out wider during the Olympics coming up. All right, we will have to leave it there. Alkesh Shah, Bank of America, Global Research, Head of Digital Asset Strategy. Thanks for stopping by.
All right, and coming up next, everybody, why investors are dumping shares of the chip giant Nvidia. Our tech editor weighs in. Shares of Nvidia getting slammed today on news that it may give up on its $40 billion deal to buy ARM from SoftBank. Our tech editor, Dan Howley, here with more. Dan, I guess this shouldn't come as a big surprise, right? Because, I mean, this deal has been getting heavy pushback from regulators and customers ever since it was announced.
That's right, Alexis. A couple of analysts that I spoke to basically said that this deal was more or less dead on arrival as far as they were concerned. And that lines up with what we had heard in earlier discussions about the deal. One analyst that I spoke to over at Oppenheimer, Rick Schaefer, had said that people had given it maybe a 50-50 chance of ever getting through, considering all of the regulatory scrutiny that it had faced, whether that's here in the US with the lawsuit from the FTC seeking to block it, in the UK, which had it go under national security review, and then in the EU and China. Those were also two bodies that were going to be looking at it. So it really didn't seem like this was ever going to go through. If I'm looking at the numbers right now, Nvidia's off about 2.4%. We're looking at also AMD, which is off about the same at this point. So it's not necessarily a bad move for the stock. And I think that's because, as people that I've spoke to have been saying, investors recognize that this wasn't going to be a major driver going forward. Now, obviously, the stocks are doing worse than the likes of Qualcomm or Intel at this point, which are only off less than about 1%, but still not necessarily a world-ending kind of scenario here. And, when you look at NVIDIA itself, it does still have access to the chips that they wanted to get through ARM. Really, this wouldn't have been much of a financial benefit to NVIDIA. It would have just given them internal access to CPUs that ARM's making. And, those are increasingly showing up not just in products from Qualcomm, but also from Intel. They're going into servers as well. So ARM is trying to expand into those areas, and that would have lined up nicely for NVIDIA. I think, going forward, the idea is what happens to ARM here. Now, they could end up going public, as this initial Bloomberg report had said, but some analysts that I spoke to said that they could see someone else try to swoop in and buy them up. One target would have been Microsoft, and that would have lined up because of their work with other companies across the tech industry. Obviously, they have good relationships with everyone from competitors to partners, and so that may be a good lineup, especially considering the deep pockets that Microsoft has and the amount of research and development they could put in. Whether or not ARM could do that on its own when it goes public remains to be seen. But not necessarily a loss here for NVIDIA, maybe a good thing that this is now kind of off their plate and they can move on to more important matters.
And then, of course, Microsoft reporting after the bell. So what else do we expect? What are investors looking for? Very nervous after those Netflix results.
That's right. So what we're looking at is a potential for $50.9 billion in revenue, $2.31 in earnings per share. And then as far as the intelligent cloud and productivity and business processes, those are where we really kind of get the cloud assets from Microsoft that's much to watch. We're looking at intelligent cloud at $18.3 billion expected, and productivity and business processes at $15.9 billion expected. And this is obviously an important call because it's the first one that Microsoft will have since they announced their pending acquisition of Activision Blizzard for that nearly $70 billion. So we'll be looking out there for some kind of comment on that from CEO Satya Nadella.
All right, Dan Howley, thanks for the roundup.
All right, and that will do it from Alexis Christoforous on myself on what has turned out to be another wild day on Wall Street. All eyes on the closing bell. After the break, our colleagues will take you to that bell. Everyone waiting to see what happens to the markets. As we saw yesterday, a lot of action in those closing minutes. We will leave it there, but thank you so much for joining us, and over to our next show.
So the headline should probably be been there, done that. Markets started the trading session in the red following the dramatic swing Monday that saw the Dow fall more than 1,000 points, only to recover by the closing bell. And guess what? Today, we are possibly setting up for the same kind of roller coaster. We were in the red. We might be in the green. Jim Paulson is here to help investors strategize the next move. Then we have to dive into the crypto asset volatility and consider if Bitcoin and other cryptos, consider if they've hit bottom. Decrypt editor-in-chief Dan Roberts has questions all of us should ask to determine if it is time to buy or sell. And we are on watch for Microsoft earnings, which report after the bell. Revenue expected to come in at roughly $50.9 billion, which would be considerably more than the $43.1 billion in the same quarter last year. And what about the almost $69 billion deal to buy Activision Blizzard? Synovus Senior Portfolio Manager Dan Morgan is going to help us understand all of it, break down the report in our 4 p.m. hour. We are headed to a closing bell in about 58 minutes. I'm Adam Shapiro.
And I'm Emily McCormick. Let's take a look at where stocks are trading in this final hour of the session. And as Adam was mentioning, another roller coaster day on Wall Street. We have the Dow Jones Industrial Average now in positive territory. At session lows, it had been down about 800 points, for more than 800 points. So definitely recovering those losses. Similar story here for the S&P 500, just slightly in the red this afternoon after falling by about 2.8% at session lows. And the Nasdaq now down about 0.8 percentage points after having been off by more than 3%. Well, let's head over to Yahoo Finance's Jared Blickery, standing by now at our touchscreen for more. Jared.
This is pretty incredible. Let's take a look at the Dow here, up 173 points. I went back in history. At no point has there ever been 2 consecutive down days of more than 2%, followed by a close in the green, unless you go back to 1932. I got to double check that, but 90 years, that is impressive here. But what's not impressive is the low liquidity in the market, and that is sending the Nasdaq down. You can see it's well off of its lows, but still down 0.8%. And here's the S&P 500, almost turning green just now. So we'll see what happens into the close. Finally, Russell 2000 also in the same boat. I want to take a look at the 10-year T-note yield because we are seeing that surge higher. It's up 5 basis points. And let's take a look at a candlestick chart here so we can see the historical price action. We had been in a little bit of a downswing, even though we're still in an uptrend here. But that is igniting the value trade that we're seeing. Another thing I'm looking at is the U.S. dollar index. Now that has given back most of its gains, but it's crawling back up into territory we haven't seen in some time. So we want to keep an eye on that too, because it has important implications for global liquidity. Here's our Nasdaq 100 heat map. It's looking a lot better than it did several hours ago, especially on the open. You can see Apple up 1/3%, Tesla up 1.5% there, roughly speaking. Both of those announcing their earnings today. Microsoft going to announce after the bell. I will be bringing that to you. That is down 2/3%. But a lot of these tech names that have gotten smashed, just kind of clawing back some of those losses. Is it going to be an investable and tradable bottom? We have yet to see, because as I outlined at the beginning, this is pretty much almost an historic first. So let's take a look at the sector action, and we can see energy and financials, and now real estate and healthcare, all of those in the green, but the real standout is energy. That's up 3.7%. Let's just get a check on what it's done for the year. We can see it's up 17.5%. I think we just took out that high from last week, so energy really screaming to the forefront. And then to the downside, communication services, that is off about 1%, followed by utilities and tech. Tech still having a tough time getting off of the jump. And here's the ARC Innovation ETF components. We see Tesla, Square, the new block, those stocks are up. But aside from CRISPR as well, that's up 4%. Really just seeing those stocks take it on the chin. Finally, want to get a check of the travel sector. This has really turned around. We had a couple of airlines green earlier in the day, but now we have Delta up 2%. We have Hilton up 1%. Carnival Cruise Lines up 2.5%. And Norwegian up almost 4%, guys.
All right, so Jared, we're going to keep our eyes on these markets, and we're going to be talking with you some more. But right now, we want to bring into the stream to talk about what the next step is for a lot of investors. Jim Paulson, the Luthold Group Chief Investment Strategist. It's good to have you here, Jim. And you've pointed out that you think a lot of the emotional selling is probably over. Quote, the market, again, has both buyers and sellers. I want to ask you, who's got the power in this market? Is it the retail investors, or is it more of the larger houses and institutional investors? Simply, I ask that because I've heard the term today, the revenge of the retail investor, what we saw yesterday.
Well, I think it's hard to know for sure, Adam, who's really in control. I still think that over all of it, that institutions probably swing a little more power than the retail community does. Although, particularly in emotional sell-offs like we've had, a lot of times retailers are a big part of that. And I guess I think that what ultimately, when a correction or a bear market for that matter does end, it's not generally buyers which bring it back. It's most often just people that wanted to sell are done selling, and they're all prepared for worse. And then once the selling suspends, it only takes marginal buyers, very small buyers for that matter, that can move it quite a bit when all the sell side is done. And that's often how these crises, sort of emotional crises, end, is more about a lack of selling or the suspension of selling as opposed to a bunch of new buyers coming into the market.
Jim, this is Emily here. What do you think was the catalyst for this emotional selling? Because many of the factors that we've been talking about, including Fed rate hikes and tightening, inflation and slowing earnings growth, have been known or at least expected for weeks, if not months now.
Yeah, I think that's a good question, Emily. I think that I really think that the biggest catalyst for this correction is just that it was long overdue. And whenever a correction happens, we'll all have a ton of explanations for why. Whatever the things are of the day, we'll throw that in the pot, and that's why it went down. But I think at some point, market corrections just happen because they're overdue. We typically, I think since 1952, we've had 25 corrections and 10 bear markets. It's not uncommon at all to have at least one a year. And so at some point, we were long overdue from the start of this bull market, at least in the S&P 500, to get one. And then, of course, there's always the reasons why. The Fed's going to tighten. We got inflation. We got rising yields. Omicron slowing growth. All good reasons. But in reality, I think this correction would have found itself with whatever the reasons were of the day. So at the end of the day, I think we had to flush it out. We do a lot of good things. We gut check our sentiment. We kill off exuberance. We bring down valuations. We reduce the concentration of leadership only in new era tech. A lot of good things. Now yields have come off again. Maybe the Fed's going to slow its easing or its tightening trajectory. All things which could help revive us.
Jim, let's talk about the correction, because I think a lot of us recall 6, 7, 8 months ago, we were being told before the end of 2021 there's going to be a pullback. And that was a big talk during the summer. Didn't come. So here we have correction. But you point out, look, the forward 1-year payoff can be pretty good if you stay the course. Help investors who might be upset with the volatility of the last 2 days understand what the next 12 months looks like.
Yeah, I think that's the main thing to focus on. These emotional sell-offs that are so severe and they happen so quickly, they are as tough for the brand new 20-something investors. They are for us old crusty investors that have been around for almost 40 years in this business. They don't get any easier. They scare you to death, and that's what they need to do, and they do that very well. But I think a lot of times when we get into this, you ask yourself, one question: is this the end of the bull market? Is this the end of the economic recovery? And for me, the answer there is no. The fundamentals under this economy remain very strong. I think we're going to grow close to 4.5% this year, and earnings results remain very good overall. And I think they're going to win out. So this looks much more like a correction than a bear market. Of the 25 corrections we've had since 1952, when you look at what it does once a correction finally bottoms from the low of the correction, what does the stock market do on average over the next 12 months? And what you find out is that on average, in the next 12 months after the previous 25 corrections, it was up on average a little more than 24% in the next year. And we went into this correction with very low consumer confidence. And when that has occurred, from the lowest levels of consumer confidence, we've had even larger 1-year forward returns, almost 33% 1-year forward returns. So I think when you're worried about how much you're losing, you ought to think about, if I just hang in there, how will I feel 12 months from now? And typically, traditionally, you're going to feel pretty good if you stay the course.
All right. We are listening, and stay the course seems to be something that some of us have trouble doing, but it seems to pay off in the long run. Jim Paulson, the Luthold Group Chief Investment Strategist, all the best to you. Thank you for joining us. We'll be right back. We're going to keep an eye on the markets as we head toward the closing bell.
Welcome back. Let's talk more about the market action this afternoon as we experience yet another session of major swings in stocks. And for that, David Balin, Citi Chief Investment Officer and Head of Citi Global Wealth Management Investments, joins us now. David, the Federal Reserve kicked off its first day of its latest policy setting meeting today. Do you think the volatility that we've seen over the past couple sessions and really past month now might deter the Fed from going in as hawkish a direction as it might have otherwise?
I do. If you think about what's taken place in the market, it indicates the degree of sensitivity that market participants have to what is going to be the new rate environment and the new liquidity environment. The Fed made a major reversal, right, about 5 weeks ago when it said that it was going to raise rates and also to consider quantitative tightening, which effectively means that you and I are going to have to finance the debt that is necessary, issued by the Treasury instead of the Fed. So with all of that, I think that they're going to look at what happened and they're going to say, our goal here is not to shut down the economy and to make things actually, slow, right? Their goal here is to signal their willingness to fight inflation to the extent that they can. And really, they also acknowledge the limit of their ability to fight this kind of inflation. When you're dealing with shortages of semiconductors, making the economy go slower is not the best way, right, to actually address those kinds of issues, those kinds of shortages. So I think that the Fed is going to notice the impact that it's had. It wanted to send a message, and that message was it intends to, be on the lookout for inflation. But in no means do they think that they have gotten to peak employment at this point, and therefore really need to slow an overheated economy.
So, David, in a note to your clients, you wrote that the torrent of monetary, fiscal stimulus, and COVID-driven supply distortions over the past 2 years caused major supply-demand imbalances and labor market distortions. At this moment in time, looking 6 months forward, investors hearing that are saying, "Okay, what do I do?"
Yeah, so I think that you have to take a look at the data, which we really also spent a lot of time talking about. So let's talk about labor, right? We have several million people who have not returned to the job market yet, who are seeking jobs, a few million. We've got about 3 million people who are entering the job market who have not yet been employed. So about 5 million people is our capacity. We've got an enormous number of people switching jobs right now across many, many industries, creating a real turnover, right? And we have a lot of friction in the world in terms of where people are living. They're unable to move and leave their apartments, or they don't want to leave their apartments, or homes. And so with all of that, what I would say is that kind of friction, right, is what's causing us to have higher labor costs in some sectors, leisure and retail in particular. So I don't think that we've got long-term inflation in terms of wages. I think we have a gap up. And with that type of view, what you want to do is you want to invest in certain areas of the market in this part of the cycle. You want to be investing in consumer staples, which are beneficiaries of lower prices for commodities, lower prices for shipping, and obviously greater consumer demand. The second thing you want to do is be in dividend stocks more broadly. You want to get paid instead of fixed income on those coupons of companies that are increasing their earnings. And one of those is consumer staples, but the other is, interestingly, healthcare and information technology. Some of the great IT companies are also dividend players, so we like those. And then we also are looking overseas at certain markets in Southeast Asia and the United Kingdom. And the UK right now has dividends on some of their stocks of 5 and 6% with growth rates that are parallel those in the United States. So you build a portfolio that has this kind of diversification, but you don't look back to technology broadly or any of these things that were mean reversion trades that took place during the early and mid stages of the pandemic. Those are done. You go to this more conventional, more mid-cycle investment strategy.
David, and when we think about the major stock indexes more broadly, one of the things that our previous guest pointed out was that since 1950, the stock market has done well, even when the Fed raises rates and undergoes tightening, so long as real earnings are rising. At the stock index level, is that what you're expecting to see this year?
Precisely. I think that your last guest is correct on two levels. One, they talked about the idea of not market timing. Market timing is a very dangerous thing. And yesterday and the day before are going, in my mind, when we look back, be poor days to sell, and especially poor days to sell some of the better quality technology names. So what we want people to do is to rotate their portfolio, to stay fully invested, and to move into the sectors, I think, that are going to be better for us, but to stay invested. And the reason is exactly as you say. Earnings for the next 2 years are going to rise we think between 7 and 8% on average, and better in certain segments. And so as a result of that, it's very hard for the market to go down unless the Fed overreacts. If you think about 2018, which I think is a remarkably important data point, only when we had 9 interest rate hikes then, and only when the Fed began quantitative tightening and removing liquidity to an extent that the market thought was too much, did we have a major correction. That event just occurred in this market, and the Fed has done nothing yet. So I think there's a lot more tolerance and resilience in this economy, that can tolerate the Fed rates being higher.
Quickly, would you advise keeping your money in the United States, or should you be looking overseas, though, for a better return?
Well, I think that what we have to be conscious of is that right now, we can't have as many bonds in the portfolio, right, as we would have before because of the incredibly low and negative yields that they've got. So you have to seek diversification. Why do you want to be in China? They're going to be lowering rates while the U.S. is raising rates. Why do we want to be in certain emerging markets like Southeast Asia and Brazil? Those markets are trading at very low valuations, and when the economy stabilizes and Omicron is over, we're going to see a broader recovery in those markets. Why do you want to be in the UK? It's gone through Brexit, and it's trading very poorly right now, and yet it's the gateway to Europe. So there are reasons to be in each of these markets, right? And I think that if you are globally diversified, you're going to have less of the volatility that we've just experienced. Also, I think from a trend perspective, the U.S. at 62% of the world's market capitalization rarely ever gets higher. In fact, this is at really an all-time peak. So from my perspective, global diversification has really those two big benefits.
All right, we will leave it there for now. David Bailyn is Citi Chief Investment Officer and Head of Citi Global Wealth Management Investments, and we thank you so much for your time. We've got a check of the crypto markets on the other side of this break as Bitcoin hovers near $37,000. Stick with us.
Okay, so as we move into the crypto corner today, and we're going to invite into the stream the editor-in-chief from Decrypt, that would be Dan Roberts. Look, a headline that says, not a great day in equities or crypto, doesn't get quite the attention as, oh my gosh, it's a crash. Right. But what's a crash? Dan's going to help us, and there's an article in Decrypt right now that puts this into not only context, but the next time your friends who might not have that much experience on the day-to-day say, oh my gosh, it's a crash, slap them silly. Dan, explain.
Well, you're right, Adam, that when Bitcoin falls, say, just 10% in a day or 2 days, many mainstream sites run screaming headlines about Bitcoin is crashing again. And it gives people who already don't really believe that crypto is a great investment a chance for a victory lap. And they say, see, it's so volatile, it's a fraud, it's a Ponzi. But 10% really isn't a crash in Bitcoin land. Now, of course, that said, in the last couple days and last couple weeks, you really have seen a crash. I think it's fair to call it that, what we saw, especially a few days ago with Bitcoin moving more than 30% in just a few days. And in fact, if you look at the highs of November when it was higher than 60,000, and then we got as low as 33,000 on Saturday and on Monday, I think it's fair to call that a crash. Now, even that said, we're beginning to climb back. As we talk today, Bitcoin's up 3%. Ethereum is in the green again. And I think that right now, what's interesting to me about crypto prices is you're seeing them behave in lockstep with tech stocks. And there's always been, a fun debate over just how correlated crypto is to the equities market. Right now, the same kind of effects are having an impact on both. You can throw around terms like contagion. You could say it's the Fed announcing that it wants to take more aggressive steps to curb inflation. You could say it's the Omicron variant and COVID. There's just a lot of things right now. And this is a time when you're going to see the people who really believe in crypto buckle down. And it reminds me of 2018. And by the way, I'm not necessarily declaring this crypto winter again. We might have so much buy-in that it's not going to be quite that bad. But if you go back to 2017, which before the pandemic was the last time we saw a huge surge, Bitcoin went to 20,000. We all remember it. It was the big mainstream mania. And then in February 2018, we saw like a 70% over the next few months crash. That was crypto winter. And what crypto people said at the time was, we're heads down and building. And right now is a real inflection point. Have we seen the bottom? And are we going to climb back up? Or is it going to be another extended crypto winter? But what I like to tell skeptics is, it's not going to go to zero. No one knows what's going to happen next with the price. But what bears always say is, the whole thing could collapse. It could go to zero. It has never done that. It has never gone to zero. It's not going to go to zero. And crypto is here to stay and is going to be around a long time. What happens in the short term with price? Anyone's guess.
Well, Dan, and to that point, as you were mentioning earlier in your answer too about this increased correlation that we've seen with stocks and with tech stocks specifically, do you think that heightened correlation is going to change the post-crash playbook for where crypto prices are headed in the near term?
Well, I think a big part of this, Emily, is the institutional investment that we saw pour into crypto during the pandemic. I mentioned 2017, and before that, the last huge crash was more than 50% in 2013. Those were early days compared to now, and it was mostly retail investors. It was regular folks who had bought crypto on Coinbase and other exchanges, and it was crypto OGs who've been in it since 2009. Now you're seeing more buy-in than ever before. I don't want to use the phrase too big to fail, but Wall Street hedge funds, prominent investors who previously didn't want anything to do with crypto that have now said they've allocated 1% to 2% of their portfolio. Big publicly traded companies that have allocated some of their treasury to crypto. Because of all that, I do think that some of the same people who are getting hammered by the drop in tech stocks are getting hammered now. Are they going to cycle out of crypto when they only just got in, or will they hold on like the hodlers do and show that they believe long term? It's anyone's guess. But some of those people who have only been in crypto for a year, it would be silly if they now dump, right? I mean, they only just got in, they bought in at the peak. Time to buckle down and hold on if you really believe that the technology is here to stay. But let's see how much longer it remains correlated. The correlation between Bitcoin and the Nasdaq especially was the highest it's been in years over the last 6 months.
Dan, before we get to the Trump coin and legal action the Trump family may be taking regarding that, got to ask you, what does it mean if YouTube, who so fondly brought us cats riding vacuums, actually brings us NFT options? What does this mean for creators on the platform?
Well, it could be a new revenue stream. It could be really interesting. You could just view it as a money grab for YouTube. And let's make sure we say at this point, YouTube has only merely hinted that it's eyeing this space. It is considering something in the NFT space. If I had to guess what that looks like, I would point you to NBA Top Shot, where the NFTs are video clips. And of course, Top Shot was really credited with starting the big NFT boom last March. And the NFTs on Top Shot are little NBA highlight video clips. Since it's YouTube and since it's a video network, the NFTs are likely to be videos. And let's remember for the unschooled here that NFTs can take lots of forms. They can be PFPs, which are profile pictures like Bored Apes or CryptoPunks, which really, they're just a static image, and you use it as a flex. It's a status symbol. You change your Twitter profile picture to it. They could be metaverse in-game tokens. They can be membership passes where you have to own a certain NFT to get into a club. So YouTube would just be the latest big name to embrace NFTs. Twitter just did it last week, and we talked about it on this program. We'll see if they do it, and we'll see what it looks like, but it would probably be video clips. And boy, it would be interesting because a lot of gamers have huge backlash to NFTs. They don't like them.
All right, Dan, unfortunately, we're out of time because I really wanted to go to the Trump coin story, but we're going to have to bring you back. Dan Roberts, Decrypt's editor-in-chief, always good to see you. When we come back, we got to get ready for the Fed's next move, and we're going to do that with our next guest.
Welcome back. Let's get a quick check of where markets are trading on this back-to-back session of quite a bit of volatility here. As we can see, the Nasdaq Composite is down nearly 2%. It's off session lows, but definitely still in the red this afternoon with about half an hour to go until the closing bell. Working our way up on the screen here, the S&P 500 down just over 1%. And taking a look at the sector action, it is information technology, communication services, and consumer discretionary that are leading the way lower in that index. Whereas on the flip side, we do have the cyclical sectors, including energy and financials, in positives territory during today's session. Then finally, quick check on the Dow Jones Industrial Average. It had been slightly positive about half an hour ago. It's flipped back into slightly negative territory, but again, also off those lows of the day. But let's zoom in now and focus on two stocks that I'm watching and two stocks Adam is watching during today's session in our 2 and 2. And I'm watching shares of General Electric. Now, this company reported earnings results this morning, and they were disappointing on the top line, and that stock stock is getting punished as a result. Now, sales were down 3.5% over last year to reach $20.3 billion for the December quarter. And that sales miss did eclipse better than expected adjusted earnings and industrial free cash flow, which is also a closely watched measure for GE. Now, GE also said that industrial free cash flow could rise to as much as $6.5 billion in 2022. Now, taking a look by business here, aviation unit sales were up by 4% to reach just over $6 billion. That was still slightly below consensus estimates as the company continues to navigate pandemic-related disruptions to travel. And then on the flip side, GE's renewable energy business saw revenue down by 5.6%, and supply chain issues and inflation were really headwinds to that business during the quarter, which that unit, of course, does mostly make wind turbines. Now let's pivot for a moment and take a look at shares of IBM. And I did want to highlight this stock because it is one that is very acutely outperforming the broader market right now after posting better than expected quarterly results yesterday afternoon. IBM posting its biggest sales jump in a decade for the December quarter, with revenue up 6.5% to reach $16.7 billion. And the big driver of this was from IBM's software unit, and more specifically, its hybrid cloud offerings, which the company has been really heavily focusing on to try and revamp under its CEO, Arvind Krishna. Now, IBM's software unit sales were up by 8.2% to reach $7.3 billion, and hybrid cloud revenue specifically grew 16% to reach $6.2 billion, and that stock is up about 5.5% this afternoon as a result. Adam?
Emily, it was Carl Malden, I believe, used to do the old American Express ad, "Don't leave home without it." And apparently a lot of Americans did just that. They took their credit cards and spent a lot of money because American Express reported earnings today, and the street likes what it's seeing. Those shares right now are trading higher. They've been up about 8% all day. They saw revenue, net of the interest expense, increase to $12.15 billion from $9.35 billion. Spending on Amex cards hit record levels in the fourth quarter. A lot of consumers, and the company pointed out, millennials and Gen Z are splurging once again on those pre-pandemic things like going out to a restaurant and going overseas for a holiday. But it was CEO Stephen Squeri who said, quote, "Travel bookings are up 19% in the first 2 weeks of January, which is continuing from 24% growth in the fourth quarter. In other words, Amex, don't leave home without it." All right. Then there's Verizon, the former owners of what was Verizon Media Group, and that's important because Yahoo Finance is part of that. The shares are trading down, not a tremendous amount today, but they're off about a full, well, it's now off about not even 0.3%. Fourth quarter earnings topped estimates, and revenue came in right in line with what Wall Street was expecting. So their earnings were $1.31 adjusted. Revenue fell about 1.8%, but here's where I bring in Verizon Media. So it fell to $34.1 billion, but that included the divestiture of Verizon Media, which was the parent company of Yahoo Finance. For the full year, you should know that Verizon expects organic service and other revenue growth of about 3%, as they have now turned on, as Hans Vestberg would say, 5G. Emily?
Adam, as we continue to watch these volatile markets heading into tomorrow's Fed decision, we want to bring in our next guest to discuss the latest flow of economic data and what this might mean for monetary policy. And for that, we have Milton Israeti, Vested Chief Economist. Milton, thank you so much for joining us. I want to start off with the read that we got on consumer confidence this morning that weakened slightly compared to what we saw in December. The Conference Board's headline index coming in at 113.8 for this month versus the 115.2 from December. And that was mostly because of short-term growth expectations weakening due to inflation and Omicron. How do you think these concerns are going to translate into the hard data and real consumption for this year?
Well, I think they're going to factor in. I mean, right now we have tremendous momentum from the recovery, but that is beginning. There are other things that are suggesting that it's beginning to lose momentum, and so now we have to count on people's fundamental long-term confidence. And the inflation is a big issue. Not just the inflation, but what's going to be done about the inflation from most people's point of view. I think it's very interesting when you look at the data. It still looks pretty good. Not every data point looks good, but it still looks like the economy is recovering. But all the surveys and the confidence numbers suggest that the American household is getting worried.
So Milton, we hear when people talk about data, especially from data analysis, that it's the question you ask when looking at the data. So when we're looking at consumer confidence and consumer sentiment, what is the question as an economist? we should be asking to get an appropriate answer that might guide us as to what we do with our investment?
Well, I wish I could conduct the surveys. I can't. But if I were doing the survey, I would make a big distinction between asking people what's going on in your life now and what do you expect. Now, some of the surveys do this, but it depends on how you ask the question. But I think that the part of the problem we have today is that a lot of these surveys were and still are conducted just in terms of how people feel immediately. And some of the other surveys that have nothing to do with the confidence surveys, you've got people saying the country's going in the wrong direction. There's a lot of politics there, but it also suggests that they're worried about the economy longer term.
Milton, I do want to switch gears and talk a little bit about housing, because one of the things that you mentioned is that housing does present itself as an answer to inflation concerns. How do you suggest investors really consider this as a play for potentially their own portfolios and their own assets and net value and net worth when we have a Federal Reserve that is likely going to be raising interest rates multiple times this year and we get into this tightening cycle for equities?
Well, that's a good question. And it is. Real estate is a classic hedge for inflation in two ways. One is that it tends to rise with inflation. Indeed, it tends to outpace inflation. At least that's the historic record. The other thing is if you can lock in a low interest rate, which you could today, if you bought today on your mortgage, then you would be paying an interest rate that is far lower than the rate of inflation for the life of the mortgage. And that's a double hedge. In this case, it's hard to buy multiple houses as part of your portfolio. There are very few people who can build a portfolio that way, but there are real estate investment trusts. You have to be careful what you're buying. There are real estate investment trusts. There are other ways to play real estate in the market for a mutual fund or a mutual fund type investor. So even if you're in your house and you don't want to sell and buy and trade up and do all the things someone else might do to hedge the inflation more thoroughly, there are other ways you can go in the marketplace that should outperform the equity market and indeed outperform the inflation as well.
It was so much easier to buy lots of houses in 2005. You could lie about the loans, right? The liar loans. All seriousness, though, the
10%
Fed
down on houses.
Yeah, the Fed right now, they're having their meeting. They constantly tell us that, a day-to-day fluctuation in the stock market they don't pay attention to. But when you get a trend in equities, they pay attention to that, or do they not?
Officially, they don't. They say our job is the economy. We're not interested in markets. But if you observe them day to day or year to year, the Fed does pay attention to the market. The classic was when Ben Bernanke back in 2013 said he was going to start tapering the quantitative easing. The market went into a tailspin. They called it the taper tantrum, and he lost his nerve and did not conduct a taper. Yellen had to come in months later and begin that taper. So I think the Fed does look at the markets, and it reflects, especially in this election year, they're going to come under tremendous political pressure not to cause a stir in the economy or in markets. I'm not suggesting that Bernanke will fold, but the pressure is going to be higher than if it was last year or next year.
What do you think the number one question that the Fed needs to address tomorrow is going to be?
Well, I don't think they're going to change their plans. They said March, and March is not that far away anymore. I think a lot of the what the Fed's going to do is the language. If they talk much tougher on the language and say this is our number one priority, they are signaling the market and the economy that A, they take this inflation seriously after saying transitory for many months, they take it seriously, and that they're going to act on this. So it says to the marketplace, if you are expecting 3 rate increases, you may get them, but if you don't, you're going to get more. And it's the language that matters.
Absolutely. Definitely a lot for investors to be watching tomorrow, especially after the past couple of days of volatility. But Milton Mizrahi, Vested Chief Economist, thank you so much. A new report from the Deloitte Economics Institute has shown the U.S. economy could gain $3 trillion if it quickly decarbonizes over the next 5 decades. Deloitte's Deputy CEO, Alicia Rose, joins us on the other side of this break to discuss.
We want to bring into the stream Alicia Rose, Deloitte's deputy CEO, because Deloitte is out with a new report, The Turning Point, a new economic climate in the United States, and two key points that we want to begin discussing with Alicia Rose. One, the report says that the United States economy could gain $3 trillion if it rapidly decarbonizes over the next 50 years. On the flip side, if we don't, we face economic losses of $14.5 trillion. Seems like an obvious choice ahead of us, but it is so hard. When you say decarbonize now, what does that look like?
Yes, thank you very much for having me, Adam and Emily. You've highlighted two of the key points. Let me share some of the context of the report. It is a macroeconomic analysis, and it's comparing two potential climate scenarios. The two scenarios are one where the climate rises 3 degrees, and scenario B, where the actions are taken to keep climate rise as close to 1.5 degrees as possible. And it starts to look at the what ifs. You've highlighted two of the key points. One is that unchecked climate change or insufficient action, that action, in scenario A is a costly choice for the US. Over the past 50 years, the US has already had 1.4 trillion in economic losses due to weather-related hazards. And in fact, in 2021 alone, there were 20 separate billion-dollar events. And our analysis shows that a rapid transition to net zero could truly drive a new industrial revolution and jumpstart growth in the US economy in the long term. You've highlighted, again, that if we're able to keep climate change to below 2 degrees, and we take that once in a generation transformation, we could see 3 trillion added to the economy, more than 1 million new jobs that otherwise wouldn't have existed compared to a world where climate change goes unmitigated.
Alicia, thank you so much for joining us. Does avoiding this $14.5 trillion negative impact to the economy in the next 50 years require global coordination on climate change, or could this be done through US policy changes alone?
It absolutely requires global coordination. Our report is focused specifically on the US, although we've released two other turning point reports, one around Asia Pacific and one around Europe. It will take global coordination.
I hear you, and I'm thinking about, is it the Chinese now burn more coal than we do in the United States? How do you get, we still refer to the Chinese economy as an emerging market, but how do you get a country with the world's largest, no, India has the largest population, second largest population, to coordinate with everyone else on an issue like that?
Well, you've named the three largest emitters, US, India, and China. And it will, again, it starts with a conversation. It starts with data that we've specifically done this in 3 separate reports so that each country or region can take a look at itself and understand the opportunity in its own country and start to drive it so that when we come together, there is that coordination and we're able to achieve that net zero by 2050.
In the US, what do you think is the biggest hurdle to implementing this rapid decarbonization right now, or decarbonization rather, right now?
Absolutely. When we talk with organizations, and we've done a study, actually, our 2022 CXO Sustainability Report, which surveyed more than 2,000 CXOs in 21 countries, they do list a number of obstacles. Some of it is actually the difficulty in measuring the environmental impact of their own organizations. Some of it's the insufficient supply of sustainable and low emissions inputs in their own value chain. And so there are a number of obstacles, but listing those does not change the need to actually push forward. In order to achieve really the turning point that we highlight in the report of 2048, we really need to take action and start now.
I realize the report is based on an assumption and then what ifs based on that, but there are real world things happening. For instance, Miami Beach, where they are raising the roads right now because they have flooding issues when it rains too much and all of the other issues. But that's money being spent to raise roads that's not being used elsewhere. Has Deloitte taken a look at the cost already to us in the United States as we have to take steps to mitigate future potential climate problems, and how that money's not being used in other ways that might help productivity or efficiency in other areas?
Absolutely. Our economic analysis, again, outlines sort of two scenarios, and it does take into account current costs being spent and actually looks forward at the benefits that can incur that the economy will gain based on, that spend that you put into the system right now. I would say also, recognizing that there is spend and concern right now, there are always going to be economic risks and pressures at any given time, and we're going to have to manage both. And again, any delay really increases the overall cost of the transition and pushes out the timing of that turning point where the gains actually exceed the cost.
And Deloitte's report is The Turning Point, a New Economic Climate in the United States. Alicia Rose is Deloitte's Deputy CEO. Thank you so much for joining us. We are going to take a break, and then when we come back, set up for the closing bell.
Welcome back. We have less than 10 minutes to go until the closing bell, and Yahoo Finance's Jared Blickery is back with a breakdown of today's trading. Jared?
Yeah, well, bad news here. It doesn't look like we're going to get that nice stat where the Dow was down 2% consecutively, 2 consecutive days in a row, and managed to close green. Here we can see dip back into the red. Anything can happen in the final few minutes, but that stat that we haven't seen since 1932 looking increasingly doubtful at this point doesn't change the fact that we still have terrible liquidity in the market, a lot of volatility, and a lot of this should be interpreted as noise. But energy really flying high here, up another 3.5%. Financials up 1/3% or thereabouts. And let's take a look at our leaders and sentiment indicators. So only thing in the green right now is regional banks. That is not the best setup. You can see IPOs taking it on the chin. That ETF is down 4%. Then you got software, ARK Invest, chip stocks, internet, solar, home builders, all of those in the red, most of those in the dark red. So not quite coming back just yet. Now, the travel sector has turned green for the most part. We got Carnival Cruise Lines up over 2%, Norwegian up over 3.5%, and it looks like Hilton That is up 1.5%, a little bit of green for the airlines as well, but not for the semiconductors, not looking that hot. We are going to get some software earnings after the bell from Microsoft, so stay tuned for that. But you can see all the dark red in this space, and I'm not even going to put the 16-day view that shows year to date. It's a little bit depressing right now, but we have been seeing some green with respect to Bitcoin. Not a lot right there. We saw that up about 10% earlier on the day, and we've been giving back some gains there as well. It has become kind of correlated with equities, and especially the tech sector recently. I got an article coming up on that tomorrow. But in the meantime, let's just check out what we have in terms of some of these other spaces here. Do want to check out retail. That has been a bright spot recently. Not today, admittedly, and also the industrials. Let's go to the Dow Industrials, where we saw some earnings earlier today. J&J, that's holding on to gains of about 2.5%. IBM, we got that after the bell yesterday. That stock is up 5%. American Express, nice outlook there. That's up 8%. For the most part, not seeing a lot of other green. Notably, JP Morgan, a financial, that is up about 0.9%. Want to check out the volatility, the volatility in the market. Now you can see the VIX is holding above 30 there. Let me just get a chart and we can see the day's price action off of the highs. But let's take a look at a 2-month chart where we can see that huge spike up yesterday. These things don't tend to get resolved in a day, so maybe a little bit of waiting here, guys.
Jared Blickery, thank you so much, and we'll check back in a bit. We'll have the closing bell on the other side of this break. Stick with us. Welcome back, and we want to welcome in our market panel to discuss the trading we've been seeing today and throughout the past couple of sessions. And for that, we have Greg Swinson, Brig McAdam founding partner, and John Kicklighter, Daily FX chief strategist. But before we turn it over to you both, we want to get one check of the markets with less than a minute to go until the closing bell. As we can see here, not getting quite that rally in the final minutes of trading that we saw during yesterday's session, although we are definitely off the lows of the day today as well. As we can see here, the Dow Jones Industrial Average Average is down just about 71 points, or about 0.2 percentage points. And taking a look at the components here, Salesforce, Walgreens Boots Alliance, and Walmart are the laggards. Whereas on the flip side, we have American Express and IBM both trading sharply higher after posting better than expected quarterly results. For American Express, those were this morning, and for IBM, that was after the bell last night. That stock's still holding on to those gains. And taking a look at the other major indexes, we have the S&P 500 down just over 1.2%. And taking a look at the sector action there, we do have information technology, communication services, and consumer discretionary, the laggards in terms of the 11 major sectors in the S&P 500. Nasdaq also trading in the red today, and here's the closing bell.
All right, so let's see where we are going to settle, and not quite a repeat of yesterday where we recovered the losses. The Dow was off 67 points, will be down about 0.2%. S&P 500 is going to be down a little bit over 1%, down 53 points. The Nasdaq is down 2.25%, off 315 points. One sector, by the way, in the green today, and that would be energy. The energy sector was up almost 4%. Let's get to the panel and kick this off with Greg, because you are warning with the Fed statement coming tomorrow that the debt trap dilemma may be alive and real. As an investor, what does that mean to us?
Well, yeah, I think, to a certain degree, it might be too little too late. You still have a lot of inflationary factors in the economy, specifically or notably rents that haven't really been factored in the CPI until, and we won't expect that immediately, but that is definitely a factor. Rents are stickier, and I think that investors have to be prepared for CPI to stay high for longer, which last year everybody decided it was transient. That didn't really work out. And I think the market expects inflation to tail off in March, April, May, when in fact these rent numbers haven't really been factored in yet. So I would just keep an eye on inflation. Obviously, the Fed's going to make their comments tomorrow, and everyone, I think the market expects the first hike in March. But I think that this might be too little, too late. And I would keep an eye on inflation.
John, as we take a look at the market action that we've seen over the past couple of days, and notably the selling action we had yesterday, then that little bit of a rally into the close, the fact that we did come off the lows of the day today as well, do you think we're seeing an investable bottom here, or is there more volatility ahead?
I would not call it an investable bottom. Investable is more of a long-term view, and I think these markets are still extraordinarily expensive. I think that there's a lot of opportunism out there. There's a different mix of investors and traders who have greater influence on the markets in their more concentrated liquidity types, the retail trader, for example. And when you see the hands-off of big investors and big institutions, you see more of the influence of these smaller, more flippant traders, and you get this kind of volatility. And I think this volatility that we've had over these past 48 hours is incredibly worrying, and the fact that the markets are perhaps a little bit more sensitive to negative news now, more so than they have been in the past, where there's so many opportunities to buy dips. Now it's much more introspective and uncertainty about what the future holds.
When we were talking to a guest in the last hour, John, that guest pointed out, though, that the wording of the statement tomorrow, if it's really aggressive, will have an impact on trading. So do you think that what we see tomorrow is going to calm the markets, John, or is it going to add to the ups and the downs?
I think the Fed is going to do everything in its power to try to avoid generating volatility it does not want. It wants to avoid volatility at all cost. It wants to just respond to the market rather than being an influencer of the market. However, I don't think they're in kind of that position to do that now. Now the markets are hanging on every word they say. They've actually encouraged it to have us hyper interpret all their language, and that's been building up over years. So now they have a highly attuned market, and it's almost inevitable that we're going to read into what they say. So they're going to be as explicit as possible, which means they're going to make surface level promises, which they're probably not going to be able to keep, and it's just going to generate more volatility in the long term.
Well, Reagan, to that point, do you think the bigger concern for markets with regard to the Fed, and perhaps what's been driving this volatility, is the fact that the Fed has signals that it's going to be raising rates and conducting tightening, or is it the fact that there's still uncertainty about just how tight and how hawkish the Fed is going to go?
Yeah, it's a great question. I think, we're all wondering that, but the Fed has done I guess a good job in one way. They've signaled their intentions pretty deliberately. And that probably takes some of the volatility out of the market, rather than surprises where they just come out and tighten 50 basis points and surprise the market, which I think would cause even more volatility. So, but the concern is they're telegraphing it well, but they were wrong last year, and they sort of missed all the signals on inflation. So my worry is that they will be wrong again. They'll either have to aggressively hike rates, or they'll miss that and have to hike rates aggressively later. Either way, it's a delicate balance. So I think John makes a great point that all eyes are on the Fed, and I don't think we have that luxury of the Fed put anymore unless things get really ugly. So look, again, all eyes are on the Fed, but all eyes should be on inflation, which ultimately dictates what the Fed will do.
And to follow up on that, Greg, is that one of the reasons why your advice to some of us might be either store some value in gold or in Bitcoin?
Yeah, definitely. I mean, I think you have to think about, alternatives at this point, right? Still stay long the market, with cyclicals. That trade has worked. Obviously, energy and banks did really well last year, and they've actually continued to hold on this year. But I think that, ultimately the cyclical trade will run out of speed. You do have some headwinds in terms of, earnings maybe not being quite as spectacular this year as last year. So I would definitely have an alternative basket in your portfolio, whether it's gold, Bitcoin, other real assets. I really like, just if you can invest somehow directly or indirectly in LNG infrastructure. There's a lot of geopolitical issues going on right now with energy. We're having a major crisis here in Europe, where I am right now. I'm in the UK, and I think that has to be taken seriously. So LNG infrastructure, social infrastructure like housing, affordable housing. There are a lot of areas right now that need capital, and a lot of capital is pouring in, but they're inflation protected, and the companies and projects have the ability to raise prices along with inflation.
All right, let's pause this conversation for a moment and head over to Yahoo Finance's Jared Blickery, standing by with earnings results from Microsoft. And Jared, that stock is trading lower. What are you seeing?
That's right. And I'm looking at all the key headline numbers and even some of the other ones, lots of beats. So have to really dig into this report. You can see it's down about 5% in after hours trading after being 2.5% down today. So revenue for the second quarter, their second fiscal quarter, came in at $51.73 billion. That is up 20% year over year, and it is greater than the street estimate of about $50.87 billion. Now, breaking that down by segment, we have productivity and business processes revenue. That came in at $15.94 billion, very small beat over the estimate, also up 19% year over year. Intelligent cloud, that's a key one. That revenue coming in at $18.33 billion, 26% gain year over year, and the estimate was for, well, we're going to call this in line, $18.32 billion. And then a nice beat on personal computing, $17.5 billion versus $16.67 billion. That's up 15%. Operating income, $22.25 billion, and that is greater than the $21.06 billion the street was expecting. Capital expenditures, looks like a small beat there, $5.87 billion. Estimate was for a little bit lower, $5.83 billion. And they also returned $10.9 billion to shareholders via repurchases and dividends in the second quarter. Now, I want to go through a quote from Amy Hood, that she's our Executive Vice President and Chief Financial Officer. She's saying solid commercial execution represented by strong bookings growth driven by long-term Azure commitments. That increased Microsoft Cloud revenue to $22.1 billion, up 32% year over year. And just to go over that headline number one more time, revenue of $51.73 billion. That is the first time they have topped $50 billion in any quarter in their history. So pretty impressive there. Not really seeing any negative news of note, but we will continue diving through this report. You can see it's still down about 3.5% there on your screen.
All right, Yahoo Finance's Jared Blickery, thank you so much. John, I want to turn this question over to you. When you hear these results coming out from Microsoft and we see the stock reaction that we have now that is off in late trading, similar to what we saw after Netflix's earnings results last week, even though, of course, that company did miss on subscriber numbers. I'm wondering, what do you think this signals to investors about where tech stocks may be going? Because, again, at least on the headline numbers, pretty solid results here from Microsoft.
Yeah, in the past few years, particularly post-pandemic, there was just such an appetite for the momentum plays of the big market caps. And I just feel that the markets are much more cognizant of the exposure that they've built up and moved away from more of the value play and more getting into the growth play, which made a lot of sense with the amount of capital and liquidity that was floating around the system. But now that you are seeing these forecasts, and it's still a good number, of course, but the forecasts that we're seeing from particularly tech and other, in the meme sector as well, is starting to really flag alongside growth forecasts generally from the likes of the IMF. We have US GDP on Thursday. It's probably going to show a slowdown. People are just much more aware of where they're at in the market cycle, much more aware of their portfolio holdings, and see that we have pulled back 10% plus from these major indices, and they have to make a critical decision of whether I want to book some profit or just protect capital for a little bit of time, especially when I see some of these major events like a FOMC rate decision, just see how the market plays it out, then reinvest myself.
Greg, I don't want to put you on the spot specifically with Microsoft, other than, let me phrase it this way. So we saw that revenue growth with Azure year over year was up 40, it's so small and I'm so old now, like 46%. They're in a race with Amazon. Could investors possibly be not pleased, despite that 46%, that that's not sufficient to help them catch up to Amazon's cloud?
Yeah, it's tricky. I mean, remember, Microsoft had this decade of underperformance in terms of the stock value. So even though they just print money, like Apple and like some other big tech stocks, it's not a guarantee that you're going to make money on that investment or on that stock. So I think I would, like John said, I'd be cautious about tech. You can't fight the argument that as rates go up, long duration equities, which basically is tech, are going to be a challenge. So look, you're not going to get killed on Apple and Microsoft and other completely solid companies that continue to print money. But, if you're looking for upside, I would do it more in banks, energy. I know that trade worked well last year, and maybe it's a little crowded right now. But, be careful with tech. You can't, again, for a very long-term play, Microsoft and the like are great investments, but I think there's better places to put your money right now. And also just be careful and hedge, buy the VIX or have some puts in your portfolio.
Greg Swenson is Brake McAdam founding partner, and John Kicklighter is Daily FX chief strategist. And we thank you both so much for joining us. Coming up, we'll have a deeper dive into Microsoft's latest earnings. Stick with us.
Oh, we're going to keep talking about this Microsoft earnings report because not only did Microsoft close down before they reported at 4 o'clock, we're seeing a bit of a sell-off after hours. And it's not dramatic, but it's enough to make you go, I mean, they beat in so many ways in this report. Revenue, 51 plus billion. Dan Morgan is the senior portfolio manager at Synovus. And Dan, I want to jump into something because, and you made me look a lot smarter than I am with our previous guests because I was using the notes you sent us when I asked them a question about Azure growth and cloud growth and trying to understand why investors might be saying, I'm going to take a little profit from Microsoft today. Is the pace at which Azure may be growing, I think they said year over year it was 46%, the revenue growth. Is that sufficient to help them catch up with what we're seeing with with Amazon's cloud growth, or is there something else that might be upsetting investors?
Well, I mean, the number was good, like you said, 46%. You have to bear in mind the first quarter of 2022, they did about 50% growth in Azure. If you go back and you look at the market share data right now, AWS, which is, of course, Amazon, is about 33% of market share in the data center space. And then Azure is about 20%. So you bring up a good question, which is how long is it going to take when you're down that amount to actually catch up to AWS? And, to be quite honest with you, Adam, if you look at Azure, it's actually growing faster than AWS. AWS is growing between 30 to 35%, and Azure is growing between, let's say, 46 to 50%. So they are seemingly gaining some ground on Amazon. It'll be interesting to see how long it takes for them to catch up, but they are doing a very good job. Office 365, which is their software as a service entry, is doing extremely well also. So they're kind of a 1-2 punch between data center and software as a service. So you think of AWS as strictly a data center play, but you bring up a good point, which is how long is it going to take for them to catch up? And they are making big strides in terms of new wins. So I would expect, Microsoft and really Amazon to be the two leaders in that group right now.
Dan, I want to ask about Microsoft's, of course, acquisition, $69 billion of Activision Blizzard. Now, of course, that isn't set to close until fiscal 2023, so we aren't seeing any impact from that in these results. But when you think about the future of Microsoft, do you think this is something that's going to complement Azure and its existing cloud computing platforms, or is it going to signal to investors that the company's perhaps going in a little bit of a different direction for growth?
Well, that's a good question, Emily. I mean, when I saw the deal, I thought it was a good deal. I think it's more complementary to their more personal computing group, which has Xbox in it, because they have something called Game Pass, which you guys probably talked about before. It's kind of like a Netflix subscription revenue where you can subscribe to games. And I think that's where they're really going to get the boost. They also talked in the conference call, if you had an opportunity to see the notes, about metaverse and what it could be done in there in terms of gaming. I don't look at it as much as a complementary to the intelligent cloud group, which is where Azure is, but I look at more in terms of boosting growth in terms of the more personal computing segment, which is a little bit downtrodden right now, just because we've seen a big drop off in terms of demand for PCs and laptops. Although when you guys read the numbers, they actually beat on their more personal computing group in terms of expectations. But the growth has definitely been slowing down in that segment since we had the big back to work from home initiative has kind of been slowing down.
It's helpful to have an expert like you to put this into context, because when you bring up what Emily asked about the Activision Blizzard deal, and that's still not going to close for another year, but you've got Xbox. They talked about Xbox content services revenue increasing 10%. Put that into context for people, what that means today, but what that could mean. What kind of growth would we expect once this is all incorporated a year and a half from now?
We bring up a good point, Adam. That is that Xbox and Sony, they're the two big console makers. Microsoft, obviously a big player in the group. If we push out a year from now, this deal goes through, you have some 300 games that are going to potentially be added. So you could see a big push where they really tie in the Xbox to the Game Pass, which is just a subscription revenue program, charge you $10, $15 a month. You have unlimited access to all these games. So they're trying to tap into that reoccurring revenue model. Right now, it doesn't generate a huge amount of money, but when you start to put the Xbox as your hardware, along with the Activision as your content, all of a sudden you've got a dual force together that they can really market. So it's really an extension to what they're already doing with Xbox and some other things. But it is a new caveat and direction for them, because we don't think of Microsoft, other than LinkedIn, as being a reoccurring revenue subscriber story. We think of them more as a cloud story, as an enterprise software play, right? So it's a little bit different for them.
For the next year, maybe a couple of years for Microsoft, do you see most of its growth coming organically, or do you start to see more acquisitions coming in and more growth coming through that channel, especially considering its cash pile right now?
Well, Emily, it's interesting. They have $130 billion in cash on their balance sheet at the end of last year. Of course, they're doing this deal with Activision. It's what, $75 billion, which is a huge deal for them. I would expect them to continue to acquire companies. I mean, I always thought that Microsoft would take out some of these cloud companies. I always thought that they would have open season on them and kind of build market share, like Adam was mentioning, against AWS with Amazon, or add more to the software as a service. But I think going forward, Emily, the future, obviously, they want to develop organically, but they want to make strategic acquisitions that add legs of growth to their different franchises. And I would expect them to continue to do that. You mentioned earlier that they, $10 billion they did in form of dividend and stock repurchase on this quarter. So they still have a lot of money that they could use to continue to do complementary acquisitions. So I would expect that a big part of their growth plan going forward.
Dan, you've been very helpful, and please consider this the invitation to come back definitely.
Thank you.
When the next earnings report for Microsoft. Dan Morgan is a Synovus Senior Portfolio Manager. All the best to you. We're going to take a bit of a break, but a recurring fan of our program, and we are a fan of Dr. Hiral Tipirneni, going to join us to talk about the latest on COVID and if Omicron has peaked.
Welcome back. COVID-19 deaths in the U.S. reached the highest level since last February after Omicron, though milder for some, spread with record-breaking speed. Yahoo Finance's Anjali Kamlani joins us now with the latest. And Anjali, these numbers have been staggering with this highly contagious variant. Break this down for us.
Absolutely, Emily. So we know that, of course, unfortunately, deaths lag the other metrics that we use, which is a surge in cases or hospitalizations. As it stands right now, we are seeing a record number again, more than 2,100 deaths on Monday, and that is a high for this current wave. But we do know that we saw sort of the highest last January, and that record number was more than 3,000. So we haven't quite hit that yet, and we are still waiting and watching, though it does seem like this wave from Omicron is not necessarily going to get there. We also know that cases have started to come around. Nationally speaking, there are still pockets where it may surge still. Hospitalizations also down just a bit from a high of a couple weeks ago, and now at around 147,000 rather than more than 150. So we're keeping an eye on those numbers. As we've seen throughout previous surges, it could go either way. So that's where things stand right now. Meanwhile, we're also watching the Pfizer and BioNTech news today, which is the start of a trial for their Omicron-specific vaccine dose. And that is going to be pretty helpful if we look at the need for it, if in fact this variant does in one instance possibly mutate more, or just others that are related to it, it might be helpful. So that's something to keep an eye on. The initial timeline was supposed to look at probably data out by March, but based on what regulators might need, it might even go out until June. So we'll keep an eye on things there. Back to you.
Yahoo Finance's Anjali Kamlani, thank you so much for that report. Let's bring in our next guest for more on this topic. Dr. Haral Tiperneni is an emergency medicine physician based in Arizona. Thank you so much for joining us. As we continue to hear about the surge in cases due to Omicron, what have conditions been like on the ground where you are?
Well, thank you for having me. And you know what Anjali said is accurate here on the ground as well. We're seeing that we're probably going to be, coming down from that surge over the next few weeks, as we've seen that Omicron peaking in other parts of the country. It's important, though, that we don't take anything for granted and we don't make any, hard and fast assumptions, because as we know, we've certainly been surprised before. But the numbers are still large. As we know, transmission is much greater with Omicron. So even though the virulence is less, the numbers of folks who've been infected are much greater. And therefore, that's why that percentage of folks that were hospitalized was so much greater as well. So I don't want anyone to think we can just ease up on the precautions. It's still time to be very vigilant. But we do think that we see a light at the end of the tunnel. And I believe Dr. Fauci confirmed that he thought for the country as a whole that we would see those numbers really kind of coming down after that first week of February. So we're hopeful on the ground as well. But again, as I think he mentioned, we need to be vigilant. We need to maintain all the protective defenses that we know work against this virus, which means vaccinations, which means masking in indoor public spaces, making sure that we're being mindful of those vulnerable populations in our community, making sure we're testing frequently, especially now that the government has put out that website for a free test for every household. And also now that we have these therapies. So there's a lot of things in our arsenal that we have to still continue to use.
Tucker? You talk about light at the end of the tunnel, and just as the light goes on, 2 cases, Washington State, of this new, call it, subvariant, BA.2 of Omicron. What do we know, and what's the future regarding this subvariant?
Yeah, you're absolutely right. And that's why we can't really let up. We can certainly be hopeful, and we know much progress has been made. But as you mentioned, in Washington State, they have identified another variant, BA2, appears to have a difference from the original Omicron with a mutation on the spike protein. And this is not something that we haven't anticipated. We know that new variants will crop up. That's why it's so important to continue to work on vaccinating not just our nation, but all around the globe, because as long as there are hosts for this virus, as long as there are opportunities for it to replicate in a rapid fashion, variants will continue to come up. So we are looking at this, trying to find out, is it more virulent or less so? The other thing is, what we're concerned about is it escaping our immune system? For those folks who are vaccinated and have antibodies against the coronavirus, is this new variant escaping that level of immunity? Is it escaping those antibodies and that surveillance? And that, of course, is incredibly critical, because if we end up with a variant that completely evades that vaccinated immune system, essentially that would put us back at square one. I'm not saying that's where we are. I'm just saying that's why it's so important that we continue to vaccinate and protect and boost. And now we know that the full state of vaccination includes a booster to be fully vaccinated.
Well, and to that point, Pfizer and BioNTech said earlier today that they've begun a clinical trial to test an Omicron-specific COVID-19 vaccine. Are we going to get this in time to address the worst of this current outbreak? And even if not, do you see this still playing a role in addressing future variants?
Yeah, absolutely. I think I imagine any of the progress that we're making, we will be able to apply and extrapolate from, if not in this acute surge, then certainly in the future. All of this research is incredibly vital, and it has been very meaningful. As we know, where we are now is an amazing, really testament to science, with the development of the vaccines, of therapies, of other interventions, monoclonal antibodies, all of those things. So, to your question specifically, it sounds like they may not have this specific version of a vaccine maybe until after March. A lot of it depends on, having ability to test and make sure that they can perform these trials to make sure they can confirm safety and efficacy. So that is a big concern. But, I think what we know is that our current methods have to continue to stay in play. We have to continue to be vigilant. And I think that we have, we're continuing to gain more tools in our arsenal with this additional vaccine, with more therapies. All of these things are additional tools, but what we know work: vaccines, boosting, wearing masks in indoor public places, frequent testing, and making sure that we're being protective of all those who are vulnerable in our communities. We continue to do that. We will, I think, continue to see progress being made, and hopefully find our way out of this surge and into a more tolerable state. As Anjali mentioned, we lost 2,000 Americans yesterday,
Right.
and that's not acceptable.
So I'm going to steal a headline from the New York Times. What does it mean to be done with COVID? I'm curious for you, what does it mean to be done with COVID?
Yeah, I think it differs for a lot of people. And I think what is important is that we never think of it as just a personal decision. We have to realize that this is something that impacts our entire community. So it's not something where I, as an individual, can just say, well, I'm done. I'm just going to, I'm confident that I'm not going to get it, and I'm just going to go about my merry way. That's not okay to say. We live in a community, in a country where there's this social contract that we look out for each other. And we know what the consequences are when we don't. And so it's really important. And as healthcare workers, all we ask for is that everybody do their part. Everybody who can get vaccinated gets vaccinated. Everybody who is vulnerable, please, be mindful of those folks in your community. Wear masks indoors. And, you can still live your life. You can go and do the things that you want to do to a relatively, different degree, but still enjoy yourself. And remember, it's not just about you. It's about your family, your community, your entire neighborhood, and making sure that everybody is able to reclaim some part of their regular or normal life. So it's not a solo decision, and it's something that we should be mindful and conduct ourselves knowing that our entire community is counting on us.
All right, Dr. Hiral Tipirneni is an Arizona-based emergency medicine physician, and we thank you so much for your time this afternoon. Coming up, we'll discuss whether utility companies are equipped to take on threats to the electric grid during extreme weather events. Stick with us.
So it wasn't too long ago that a lot of people in Texas were having to deal with frigid, record cold temperatures after they lost electricity, which brings up the question about what kind of threats does the electric grid, although Texas is on its own grid, pose, and what kind of reliability do we have? So let's bring into the stream Nigel Voss from Publicis Sapient. He's the CEO. And we should point out that in partnership with Energy Central and APO, she conducted a survey about threats to electricity reliability back during the summer of 2021. Where do we stand today, as we are now in the winter of 2022, about the threats to our electric reliability? I mean, our world can't live without it.
Yeah, and you're absolutely right, Adam. And when you think about the survey results, right, 1% of U.S. utilities surveyed indicated they were fully prepared to provide accurate times of restoration following an extreme weather event, and 2% said that they were prepared to gather data from customers. So we're a long way from where we want to be, considering the fact that extreme weather now is causing an increased number of outages across the United States, but also across the world. And unfortunately, a lot of the research shows that customers have been significantly affected, for the most part, are from disadvantaged communities, that are affected the most. And when you think about all of us as people, right, we in our lives are reliant on energy and power ever more than it's ever been before. And today, we as customers really care about our utility company at two times. First, when there's an outage, and secondly, when we have a wrong bill. So frankly, the most important thing is customers want to know when there's an outage is when will the power come back? And the reality is right now, most utilities don't actually have a accurate way of sharing this information. Then, put that into perspective, right? Our expectation as consumers is being shaped by standing in the rain, waiting for a taxi is not good enough. Today our phone will tell us exactly how far our Uber is, and it'll tell us how far our Uber is, factoring all the kind of traffic information. So when you call your utility and say, when's the power coming back on, and they can't give you an accurate answer, that's not good enough. And largely with the work that we do in our utilities and energy practice, we find that systems that bring all of this data together fundamentally to help them become a digital organization is just not where they're at today. They've got too many different systems, data fragmentation across the enterprise, which leaves them vulnerable to not being able to answer that extraordinarily critical question.
So Nigel, based on your findings, how long would it take to conduct this type of modernization that you're talking about, to actually implement proper preparedness and data to be able to talk about these restoration times in an accurate manner? And what would the cost be to utilities?
I think the first thing, you have to break this down in two parts, right? First is we've got to start to modernize the grid. We need a much smarter grid, and we need to be able to collect data from all of the devices on this grid to understand how they're performing in real time, and doing some sort of scenario planning to estimate risk and response time. And we don't have that. And that is, of course, an effort that's underway in many parts of the country, in many parts of the world, but that's a multi-year journey. The second piece, which I think is something that a lot of the utility companies have got to start to focus on today, is actually how do they actually start to bring together all of the data they have about their customers into a single space. And these are problems that can be solved in a matter of months, in some cases in specific contexts, perhaps years. And the cost relative to the impact of not meeting service levels that utilities have and losing customers to unreliable service is a fraction of that. So frankly speaking, I think a lot of the work needs to start with these two areas. And while it is happening, I feel like fundamentally one of the biggest challenges you have is this is a part of our ecosystem, similar to where banks were a few years ago, that has just not moved into the digital world. A lot of these businesses are still running with large computing systems that were built to be standalone and oftentimes decentralized, not in the cloud, and certainly not connected across their enterprise.
As we wrap this up, what faith do you have? I mean, we're about to spend billions and billions of dollars from the infrastructure bill to address these kinds of issues. What faith do you have that they will be addressed in a timely fashion?
I think timely, Adam, is the critical word, right? Because I feel like they will be addressed eventually, because customers aren't going to stand for the fact that they can lose power and not know when it's going to come back on. But the reality is how quickly and efficiently we can do this relies on these businesses recognizing that as the world becomes increasingly digital, from a Publicis Sapient perspective, a lot of the work we do across industries is helping enterprise customers move into this digital space and really become digital businesses. And that starts with the two areas I was talking about earlier.
We wish you the best, and thank you for joining us. Nigel Voss is the Publicis Sapient CEO. When we come back, we're going to be revisiting what happened with 3M's earnings today.
The materials company 3M reported better than expected earnings and revenue in its latest quarterly results this morning. 3M saw strong demand for its N95 masks, respirators, and air filters, but the company also faces rising costs, inflation, and a host of supply chain challenges. CEO Michael Roman had this to say about the company's latest results. Take a listen.
There's a lot of uncertainty as we come into 2022. I would say there's some positives. We're well positioned as a company to deliver on growth in the new year. We've got that strong performance that we delivered in Q4 on top of the total year. We've been investing in areas for growth. We have some fast growing trends that we're investing in. We've got areas like our automotive electrification up 30% in 2021. Our biopharma business is up 26%. Our home improvement business continues to grow at double digits. In fact, we're investing, we announced this past week that we're investing almost $500 million in a new factory in Clinton, Tennessee to support that growth and demand. So we're well positioned from what we've been investing in from a growth standpoint and those trends that we're seeing in those end markets that can leverage 3M capabilities and strengths. Now, the outlook for the year, the macroeconomic outlook for the year still looks fairly positive, both industrial production and GDP, I would say even down to some of the individual markets like build rates for automobiles. It's the uncertainty in the near term that is really the challenge. What's going to happen in supply chains? We managed through challenges in Q4. It's still with us. We're still seeing constraints and disruptions in supply chains. And now you have some questions in the outlook for the overall market as we go into the new year. I would say we saw in Q4 and that strength in December that I talked about, strong demand in our end markets. Our customers were still demanding product and focused on serving them was really a priority. And that's got us positioned well, not to take away anything from the uncertainty related to the pandemic, the supply chains, the challenges that we might face in the markets as we go into the year.
Mike, are you seeing anything in your business that would suggest that we have hit a peak in inflation and things might cool down a bit?
Yeah, we talked a little bit about this, Brian, on our call this morning. We saw inflation continue to step up in Q4, although the rate of increase slowed. So maybe the first indicator that inflation is slowing as we get through the end of the year, the increase of inflation is slowing. Just a reminder, when you look into 2022, we called out inflation as having a bigger impact on us at the end of Q1 in 2021. So we were saying it's coming, and we saw it step up in Q2 of last year, Q3, and then again in Q4 at a slower rate. So the year-over-year comp is going to be significant as you get into 2022. And so we expect to see an impact from inflation even at a slower stepped up rate. So that continues to be one of the challenges. We also continue to see disruptions in the supply chain. So that serves up challenges in logistics and getting products. And we're investing either in how we run our factories or how we get product to our customers. That's another part of increased costs in our supply chain that we have been investing as we've gone through the year to really deliver for those customers.
The supply chain challenges you're still dealing with. Since we last spoke, so many folks say this will be the year things get better. By mid-year, the supply chains will be back to some form of normal. How do you see it?
Yeah, I think there's estimating the duration of some of the impacts. We do expect it to get better as we go through 2022. We're seeing a convergence of COVID-19, a snapback in demand, and I would say just some of the constraints that are on raw materials and labor as we have worked through some of those same issues. And we would expect that to get better as we go forward. Starting the year, we are anticipating continuing to having to manage through that. So it's a matter of how soon and how much better it's going to get as we move through the year. And we didn't do a lot with guidance on our call this morning. We're going to come back on February 14th. We've got an outlook meeting with investors. We'll lay it out in more detail how we look at the year and how we look at the impact as we progress.
And I have to give you a hat tip, Mike. You and your team are investing $500 million to build some new manufacturing capacity in Tennessee. And that comes really hot on the heels of Intel investing $20 billion in Ohio to build out its manufacturing capabilities for its chips. As you take a step back and talk to your peers in the manufacturing industry, do you think we're seeing an American revival in manufacturing?
Well, for 3M Company, we've always been an investor in the region of the world where we do business. So we invest to serve our customers from production in the regions of the world that their markets are. And that's true for the U.S. We have about 40% of our revenue in the U.S. We actually produce about 55% of our supply out of factories in the U.S. It's maybe the one exception where we do export. So we're one of the top 100 company exporters out of the U.S. as a result of that. So we've always invested in the U.S. to serve our customers here as well as around the world. We do produce the majority of what we sell in Europe, Asia, in factories in those parts of the world as well. We don't export out of those regions very much. So our supply chain challenges as we've gone through 2021 are often getting product from our U.S. factories to customers overseas. We have challenges getting product from our factories to customers in the U.S., but also in getting them overseas. So we've had that idea of investing where we can deliver the greatest value for our customers globally, and the investment in Clinton, Tennessee that you mentioned, that's related to our iconic brands in home improvement, our Command damage-free hanging, our Filtrete home filtration products. Those are strong growth drivers for us as a company. There's trends in the U.S. that create increasing demand. And so that's really an opportunity to invest in a factory in the U.S. to serve customers in the U.S. So we're excited to make that announcement. It's one of the areas that we prioritize coming through the pandemic, and it is helping to position us well as we go into driving growth in 2022.
That was 3M CEO Michael Roman on the company's latest quarterly earnings results and outlook for the future. That stock closed just marginally higher today on the heels of that report. And coming up, Adam and I will take you through what to watch in markets tomorrow. Stick with us.
All right, so as we get ready to finish the day, we need to take a look at what's happening for tomorrow, and obviously the FOMC meeting, which is underway right now. We will get the statement 2 o'clock. We are going to have coverage right here on Yahoo Finance Live. Brian Chung will bring us the statement. We're going to be looking at the wording of this statement, but what everyone seems to be paying attention to, Emily, is how aggressive are they in signaling the not only the taper, but the potential liftoff in March. The other thing we haven't talked about a lot today or yesterday in these market sell-offs and then the recovery yesterday, not today, but is just how quickly might they do the roll-off? Remember roll-off rage not too long ago. Everybody's very concerned about shrinking that balance sheet, 8.8 trillion. How fast do they intend to do that? Because that's something that could take decades. So we're going to be watching FOMC tomorrow, Emily.
Well, Adam, a lot going on tomorrow because in addition to the FOMC meeting, we also have a couple of closely watched earnings results coming out from some major companies. Tesla is, of course, one of them. Now, this company is going to be reporting fourth quarter results with some considerable momentum coming after it reported record deliveries for the fourth quarter and for the entirety of 2021. Those full year deliveries had been at 936,000 cars. And that was an 87% jump over the previous year, even as Tesla and, of course, many other automakers were contending with chip shortages. And for the fourth quarter specifically, Tesla has already reported those deliveries up 71% to about 308,000. And moreover, of course, profitability is going to be in focus because in the third quarter, Tesla had brought in $1.6 billion in GAAP net income, or more than double what it had brought in for all of 2020. Now, speaking of chip shortages, we'll also be getting results out from Intel. The company is expected to post a back-to-back quarter of year-over-year sales declines. Sales are expected to drop by 1% to reach about $18.4 billion for Intel's December quarter, and commentary around chip shortages, supply chain disruptions, and of course, PC and auto chip demand are going to be in focus in that earnings report tomorrow. Adam.
All right, so let's see where we settled today. And this was the day, of course, we got the Microsoft earnings, still 51.73 billion, but the street not so happy, and they were selling off after we had the closing bell in that report. Here's where we settled. Dow off 66 points. The S&P 500 was off about 1.25%. You had the Nasdaq off 2.25%. We're going to go at it again tomorrow, bright and early, right here on Yahoo Finance. Don't forget 9 a.m. with Julie and Brian, and then of course the important FOMC statement 2 o'clock right here in the stream. We'll see you tomorrow.